Thanks, Amy. I appreciate it. Welcome. Good morning, everybody. Welcome to the 41st Annual Eide Bailly Bank Seminar. At this time, I would like to recognize our partners and associates of Eide Bailly who support this event. Thank you all for your service that you provide to our firm and to our clients. Thank you for attending and welcome to the 41st Annual Eide Bailly Bank Seminar. My name is Gary Smith and I'm the partner in charge of the Financial Institutions Service Group, and I'm excited to be your host today. Our motto for this year is community, and we recognize how community banks have brought unity back to the communities across the United States. Whether it was with the PPP loans or helping businesses and individuals survive and thrive by providing unwavering commitment to the communities that you serve. We are very excited to have you join us today. We would like to give back to you today with a full day of content that is eligible for CPE, as Amy mentioned. Today, the Eide Bailly Bank Seminar has turned from a hybrid event to a 100% virtual event. We appreciate your attendance and hope you join us for our 4 virtual format in November series as well. You can go to eidebailly.com/bankseminar2021 to register. We appreciate your attendance today and look forward to having you here to interconnect with your colleagues, friends, and professionals in the banking industry. Before we get to our keynote, I would like to a special thank you to Cheryl Knutson and Amy DeGeorge. Thank you guys for all that you've done to put this from going from in-person to virtual. It's been a challenge, and we do appreciate, all our group appreciates what you've done. I also want to send a special thank you to Ken Johnson. Ken will be retiring at the end of April 2022. Ken has been so instrumental in building a great practice with Vavernick, Trine, and Day, which merged with Eide Bailly back in July of 2019. Ken is not only a great partner, but a great friend. He truly cares about all of the staff, and he really cares about his clients. All of the Eide Bailly family would like to wish Ken his best in retirement. Ken, you will be missed. Now I'd like to turn it over to Ken to introduce our keynote speaker.
Thank you, Gary. My name is Ken Johnson. I'm a partner with Eide Bailly in the Laguna Hills office. At Eide Bailly, we're in the top 25 accounting and consulting firms serving over 900 financial institutions in the United States, ranging from size from de novo up to over $10 billion in assets, as well as over 30 banks in the state of California. I'm honored to introduce our keynote speaker to kick us off this morning at Eide Bailly Bank Seminar, Doug Duncan. Doug is a senior vice president and chief economist at Fannie Mae, where he is responsible for forecast and analysis of the economy and the housing and mortgage markets. Doug also oversees strategic research regarding the potential impact of external factors on the housing industry. He leads the House Price Forecast Working Group, reporting to the Finance Committee. Under his leadership, Fannie Mae's Economic and Strategic Research Group won the NABE Outlook Award, presented annually for the most accurate GDP and Treasury note yield forecast in both 2015 and 16, which is the first 2 years this award was awarded. In addition, ESR was awarded by Pulse Economics for Best Home Price Forecast, named one of Bloomberg Businessweek's and 50 most powerful people in real estate. Doug is Fannie Mae's source for information and analysis and demographics on the external business and economic environment. The implications of changes in economic activity on the company's strategic and execution, and for forecasting overall housing, economic, and mortgage market activity. Prior to joining Fannie Mae, Doug was the senior vice president and chief economist at the Mortgage Bankers Associations. His experience also includes work on the Financial Institutions Project at the U.S. Department of Agriculture and service as legacy fellow and staff members with the Committee on Banking and Finance and Urban Affairs for Congressman Bill McCollum in the U.S. House of Representatives. Doug received his PhD in agricultural economics from Texas A&M University and his Bachelor of Science and Master's of Science in agricultural economics from North Dakota State University. We'll have time for questions at the end of Doug's presentation. Please utilize the Q&A function in the Zoom meeting. At this time, I'm going to turn it over to Doug to talk about inflation joint supply as economic and housing focus.
Thank you, Ken, and thanks for that introduction, which I don't know if my mother would approve all of that. She always told me, keep your introductions short because when you open your mouth, they'll make up their own mind. So hopefully I'll provide some useful information as you're making business decisions over the course of the next year or two. I'll kind of talk about the rest of our thought on 2021 and our thoughts on 2022 and maybe a little bit beyond that. The reason for the title here is that the questions that I'm hearing, whether it's from the media or from the business community, really revolve around three things. Most recently, the number one topic has become inflation. That has been closely aligned with, in the housing sector in particular, the issue of supply, but more broadly now over the last, say, 6 months, supply in the entire economy. And then the third thing is, well, what does all that mean for interest rates and economic activity? So that's really what's attempted to be captured here in the title. So I'll walk you through some of our thoughts on this. Let's see if I can make things move here.
Click on the screen for me.
Oh yeah, sorry, thank you.
Nope, you're good.
This basically says Fannie Mae will deny I was ever here. Basically that it's my forecast. And someone once said, if you want to know what an economist's real forecast is, ask what they're doing with their own money. Mine reflects what's in this forecast, just so you know. So right now, economic growth is pretty much back to where it was prior to the pandemic. There's two different ways you can measure that. One is by personal consumption expenditures, which the Fed tracks pretty closely. They also watch GDP adjusted for inflation. So whichever one of those that you look at, we're pretty much back to where we were. It is interesting to note here you see in the 2005 to 7 time period, those numbers actually ran a little bit above the long-term trend line, and there was a counterbalancing running below the trend line in the period after the 2007 to 9 down period. One of the things to think about there is the role of housing in that, and we'll come back to housing in the post-pandemic period, partly because in that 2005 to 7 time period, there was a run-up in house prices that was actually a little greater than what we've seen over the last 2 years, but not too much greater than that. Households acted as though that was permanent because there had never been a national period of house price decline. There had been regional house price declines, but they took the price appreciation as though that equity were actually permanent and consumed off of that huge volumes of cash out refinances, which pushed sales up, made the rest of the market believe that this was a sustainable path of growth. Salaries went up, employment went up. Then when it was revealed that credit conditions had become much too loose, and in fact, a lot of that price appreciation had been illusory, there was a reset across the economy, and the expansion after that was the weakest expansion that we had since World War II. So that's a reason that people are asking about house prices today, and I will come back to that in a little bit. So There we go. Whoops. Triggered too fast. Amy warned me to go slow on the trigger, and I apparently didn't listen. So on the supply side, this is an example taken from the survey of small businesses about what they think about their current inventories, and which reflects the supply available for them to sell. And as you can see, it's completely off the charts from an historic perspective. So that's not just in the small business community, it's across the economy, and it's not just housing, it's broadly in an array of products. You've all heard and read, I am sure, about the chip shortage that's impacting the supply in the auto industry. Well, those same chips, not the ones that go into trucks and cars, but the same logic chips are also in short supply for other products, including some types of building materials or technology tools in other sectors. And so it's a broad-based issue on the supply side of the economy. And it's faced with historic levels of stimulus on the demand side of the economy. So of course, that's raising prices when demand accelerates faster than supply accelerates. The response in markets is that prices go up. So one of the questions then is this price rise transitory? A word which I think the Fed is now starting to potentially regret. I saw one of the regional presidents saying that he was labeling it a dirty word. But that is, the question is this simply a function of supply-demand imbalance, which will be leveled out once supply catches up? Or is there inflation at work over a longer time period? I looked up the word transitory in the Oxford English Dictionary, and it says not permanent. So that sounds like a bunch of economists giving themselves some wiggle room in terms of timing on when we will have an answer to the question of whether inflation is going to be sustainably higher. From the household perspective, and certainly those of you, most of you are all in or work related to the banking community, households have way above normal levels of money in their checking accounts. One of the interesting things in this time period, which will be interesting to watch over the coming years, is that the federal government has learned that you can actually impact the public by directly using IRS technologies to inject money onto household income statements directly, as opposed to the thought that you had to stimulate the economy, and as a result of the stimulation of the economy, there would be a rise in employment and income at the household level. This is an interesting innovation, and it will be interesting to see how that plays out over the years. Nonetheless, households have cash available to spend, but as you can see, the confidence level that they have has certainly been impacted by the initial phases of the pandemic and then the Delta variant of the pandemic again. So the question is, how does their behavior change going forward? The employment remains below pre-pandemic levels, and the pandemic certainly was a shock of a type that has never been seen in the recorded data before. So, of course, the economics profession had to go back and study the alphabet to determine how to describe to the public what their expectations were in terms of the nature of the recovery. So you saw discussions of V-shaped recovery or a W-shaped recovery or a K-shaped recovery or a Nike swoosh. My personal favorite was the square root symbol, which is a little bit what things look like. We're clearly not back to the level of employment that we were at the outset of the pandemic. And there has emerged a question about whether we will get back to that because of exits from the labor force. So the labor force participation rate has fallen, and given the rise that we've seen in wages, particularly in the service sector, there is a question about whether some of those individuals will be given incentives to come back off the sidelines and into the workforce. And you see the stories on employment on both sides of the equation, that there's a shortage of workers, and yet there's some 4 to 5 million less employed people than there were at the outset of the pandemic. There are various explanations have been given to that. Among them, I think the Atlanta Fed did some work that suggested something around 2 million more people than expected retired or left the workforce permanently, which would argue on the side of a more permanent reduction in labor force participation rate. On the other hand, there is a question about whether housing costs in some geographies are so great that the service sector workers that would be expected to fill those open positions can't afford to live there in proximity to where they would have to work and make the economics of that work. So still information being sorted through on the employment side to see how the further recovery of employment will work through its way through the system. One of the things that we do know from some survey work is that the work remote phenomenon has resulted in people actually working more hours. It is one of the things that we were thinking about within Fannie Mae was after several months of working at home within the pandemic, we of course were surveying our own staff, of which we have about 7,500, to understand how their attitudes and activities were changing as a result of working remotely. We heard about a rise in the stress related to work from working at home. One of the things that we believe we understand is that for those who commuted to a workplace, there was a transitional period when they left the responsibilities at their home and commuted to the office. There was a mind shift that took place where they were then deploying their mental energy into the work at the workplace, having left aside the responsibilities from home. Then at the end of the workday, transitioning back home, they reversed that transition, left work at the office and transitioned to their responsibilities at home. Working from home suggested there was no transition. And the survey data suggests that part of that transition was simply immediately going to work and not making mental transition away from the home responsibilities because you were still there. So I think the economy and businesses and households are still sorting through all of the implications, and they probably vary by the type of household, whether there are children resident or not, children not resident, the type of work that is expected. And so I think more to be learned on that front, but some early data suggest that people are actually working more hours than they were. Clearly, the sector of the economy that was most directly impacted was the service sector, particularly leisure and hospitality. And really that includes any kind of service that was provided which required people to congregate in groups. So obviously restaurants and hotels and airplanes and sporting events and concerts and theaters, all of those places where people have to be in close proximity to receive the services that they're paying for. And that was the sector that took the biggest hit. One of the surprises in the housing sector was how well housing did and is still doing, given the downturn and the loss of employment. But in fact, the homeownership rate among workers in that leisure and hospitality space is something like in the low 40%, whereas nationally the homeownership rate is about 65%. And that's because many of those jobs are held by younger people or by people that are in transitional employment categories and tend to be renters. And that's why, as compared to the 2007 to 2009 downturn, when you didn't really hear much about the rental market, what you did hear this time was moratoria on eviction, because the renting population was significantly impacted in the employment space. So that the labor market recovery varies geographically. Because there's a significant section of folks attending today from the West Coast, I put in some West Coast data: California, Oregon, Washington, Idaho. For those of you from flyover country, just so you know, I'm from Minnesota originally, so it's not as though I'm insensitive to those in that area. And you saw I have a couple of degrees that I snuck through North Dakota State and received. But some very interesting dynamics on the West Coast. As you can see here, for example, Idaho has been a tremendous beneficiary of the shift of related to two things. One is probably working remotely, although this shift was underway well before the remote work issue arose. And it has a lot more to do with the cost of living. And you can see the change in non-farm employment from January of 2020. So just before the pandemic started, I've segmented out that portion of time. And you can see the impact on Idaho, for example, which is well above what its employment was prior to the pandemic. And you can also see here in the higher cost areas, the fact that the recovery in those areas has not been nearly as rapid. In fact, and it is in fact lagging the recovery of employment nationally. States that are heavily dependent on tourism, which is in the service area, does or have continued to experience high level of unemployment relative to others, but that's not the only factor that's driving the slow recovery. It's also more broadly in the service sector, things like restaurants and theaters and sporting events, although some of those are now reversing themselves. But in addition, the severity of the lockdowns and in response to COVID has also impacted the pace of economic recovery. And there is a fairly significant difference in the economic recovery pace in those states which had more severe lockdowns from those which had less severe lockdowns. I mentioned auto sales, the semiconductor shortage significantly impacting that, leading to a big spike in used car sales. It's still some time until we see full recovery in that sector, at least through the end of next year, and possibly even longer to come back to get supply and demand back into balance in the auto sector. Air travel has been hit hard. I just flew to San Diego on Saturday, back on yesterday. The experience of wearing a face mask for 5 or 6 hours continually, especially when seated shoulder to shoulder with other passengers, is not a pleasant experience. So it's not surprising that we're still some way from full recovery on that front. And the fact that your hosts today had to shift from a in-person to a virtual environment is related to that, to the Delta variant surge and some of those conditions. So a lot of businesses have actually reversed themselves as a result of that. It's also the case that even though there was a tick up in restaurants over the Labor Day weekend, that has reversed itself. Although I will say, in Little Italy in San Diego yesterday, there was no evidence of slowdown in restaurant activity there. It was really hopping. So what does all that mean? Pull that together for our outlook, and then I'll talk a little bit about what the Fed thinks about that. And I should note two things here. One is we do not have in this forecast a $1 trillion infrastructure bill, and we do not have a $3.5 trillion additional spending bill. We think we do not think the probabilities yet are high enough, nor the composition well enough known to actually give an intelligent estimate of what is likely to result. If parts or some elements of those things pass through, we will probably know something more within the next 6 weeks or so. But you should know that those are not in this forecast. And the other thing that you should know is in our macroeconomic forecast, we impose, in terms of interest rates, the forward curve from the last business day of the previous month. Now that's important in looking at our October forecast, because as you know, in the first couple of weeks of October, the 10-year Treasury ran up 20 or 30 basis points or so. So that is the latter part of September and the first part of October. So to the extent that we see additional changes in the Treasury, particularly the 10-year Treasury, that will be reflected in the subsequent months' interest rate forecasts. So you can see here that our expectation is that over the year of 2021, the average of the 10-year Treasury will be about 1.4. As of the end of September, the expectation in the forward curve was that would average about 1.7 across 2022. For those that, and obviously if you're in banking, you have to think about this. We did have a run up at the beginning of 2021. The 10-year ran up to about 1.8, I think 1.75. Then it fell back closer to 1. So it has run up again past 1.6, maybe 1.7. I didn't look this morning at where the 10-year sits. The story is a little bit different today than it was at the beginning of the year, in that that headline that I put on this presentation, starting with the word inflation, is more prominent in the discussion in the markets today than it was at the beginning of the year. That you can see then that looking at core CPI, or if you look at the headline PCE, which is the Fed's preferred measure, you will see that it runs through 2022 in our forecast, and actually beyond that, above the Fed's target level. So we're probably above consensus in this, and part of it is related to housing, which I will get to in a couple of minutes. You see the unemployment rate coming down. Whether that is a function of people leaving the labor force or whether it is economic growth, I think is really the $64 question. And I think given the forecast, you can see we're expecting a little less than 5% growth in 2021 and about 3.5% growth in 2022. Chances are that the set aside fiscal policy changes, the risks are probably slightly to the downside to those numbers. So what does the Fed think about all this? Oops, trigger finger too fast. So, excuse me, 3 months ago, a couple of days before the CPI measures came out, we put out a paper that said, we think that market participants are underestimating the impact that housing will have on underlying inflation, partly because of the supply issues on the for sale market, but partly because the rents component operates with a lagged on a lagged basis in the federal statistics. Basically, rental agreements and lease renewals operate on an annual basis. And while at the outset of the pandemic, there was a short dip, rents have been appreciating fairly strongly since then. That will not be picked up until late 2021. We've now started to see some indications of the housing component picking up, and through 2022. To some degree, it's the headline rent increases that you see will be a little bit overstated because concessions are also quite strong. So sort of giving with one hand or taking with one hand and giving back with the other. Nonetheless, rents are appreciating on net, and that will show up in the inflation numbers. So you can see if you went back 3 Fed meetings, there wouldn't be any dots in the dot plot in the 2022 range. And in fact, just at the end of 2023 was where the thinking was in the Fed at that time. That has changed significantly. As you can see now, roughly half the Fed's Federal Reserve Board members suggest at least one increase probably in 2022. We actually have in our forecast the Fed making their first Fed funds target move in November of 2022. So we think they'll wait till after the election, but we do think that they will start to move. They will have, which means they will have ended the tapering. That is the slowing and ultimately the stopping of treasury and mortgage-backed security purchases to add to their portfolio. They will have ended that by that time. There we go. So right now, inflation is running, no matter which measure you use, is running above their 2% target. And at his most recent press conference, Chairman Powell suggested that their inflation rule or decision point had been reached, and they were waiting to see whether their employment target would be reached. And he said at that time that it would not take a gangbusters, I don't remember the exact word that he used, but it would not take a real strong employment number for that measure to have been reached as well, which would then set up the onset of their tapering. The employment report last month, under 200,000 added at the payroll level, was less than what the consensus in the market expected. The consensus had expected somewhere around 500,000. So from relative to consensus, it was a pretty weak employment report. Nonetheless, Fed speeches subsequent to that employment report suggest that that is not going to be a hindrance for them to begin the process of slowing their purchases to add to their portfolio in the November timeframe. They have not given a specific date at which they will commence that, nor have they given a specific date by which they expect to have completed that. But the expectation is that they will slow their purchases, and in the minutes released from their last meeting, they suggested about 10 million reduction monthly in treasury purchases and about 5 billion. how many zeros did I use there? About 5 billion reduction in mortgage-backed securities purchases on a monthly basis, which would get them to a position of not adding any additional securities to their portfolio in the middle of 2022. And in his press conference, Chairman Powell suggested that they would not raise the Fed funds target range until such time as they had ended the purchases, adding treasuries and mortgage-backed securities to their portfolio. In answer to the question of what the Fed was thinking about with regard to shrinking the size of their balance sheet, his answer was that they have not even discussed that because that would be something that would be subsequent to their decision to make changes in the more traditional tool that they use, which is their Fed funds target rate. Now, it's not just housing and the supply problems in general in the economy, but there's also the case that particular sectors, as we head into the winter season, we've seen a run up in natural gas prices, which will, if they stay, which we expect they will stay somewhere in that range, that will reduce the funds available for consumption in other categories at the household level. So and you have seen some commentary from some of the members of the Federal Reserve Board on the role of energy costs. Often people strip out energy and food and talk about core PCE or CPI by stripping out energy and food, but those things certainly have costs in those spaces have risen recently, which the Fed will not ignore. They are concerned about how businesses and individuals perceive this, and there has been, in terms of short-term inflation expectations, they have drifted up. Consumers are well aware of the changes in those costs, and as I mentioned, on the renewal of leases signed in 2020, that will move CPI and PCE rent measures higher. We have started to see evidence of that as we suggested we would some months ago with our public statement. So amidst all of that, the inflation concern, the Fed's taper, as you have seen, certainly in your businesses, the 10-year Treasury has started to move up, and so the question is how far and how fast, because those two things will be determinant for where we go in the future. In particular, I'll turn my focus now to housing and the mortgage market. And I would note in leaving the Fed that Chairman Powell was on the Fed board. He was not chairman, but he was on the Fed board in 2013 for the example of the Taper Tantrum. That is when in May of 2013, Chairman Bernanke made a speech in which he suggested that at some point the Fed would start to taper its purchases on the idea that monetary policy had been effective and less support was going to be needed going forward. That led to a 100 basis point rise in mortgage rates over the next 6 months and a 7 to 10% downturn in housing activity in the first half of 2014. In 2018, Chairman Powell was still on the board, and the Fed decided that it would start to reduce the size of its portfolio. As they allowed maturing securities to run off without replacement, again, mortgage interest rates ran up about 100 basis points over a bit of a longer period. Nonetheless, at the beginning of the next year, it did slow housing activity. So he has been on the board for the two periods when there was a natural experiment run, or a policy experiment, I guess you would say, that was run with what happens in the housing sector when rates rise a significant amount in a short time period. And the answer to that is it slows housing activity. With house prices rising 15% in 2020 and probably 20% in 2021, is that going to be something that's going to be top of mind as a problem to the Fed? It was interesting that at the most recent press conference, there wasn't a single reporter question about housing. And the chairman didn't volunteer any commentary on housing either. But my thought is, or our thought in our forecast is, that would not be, from their perspective, a big problem if the rise in rates were to significantly slow housing in some way, given the outsized increases in house price and the reemergence of the house price bubble terminology. So what I've shown here is the price growth in some of the Western markets, and they're pretty astounding. Now, one thing to bear in mind is the level of house prices in California relative to the level of house prices in Coeur d'Alene, Idaho. Let's go back 3 or 4 years. The dramatic difference, if you exited a house in California, you would have a lot of cash to buy a very nice house in Coeur d'Alene. So part of the increase in some of these metropolitan areas, the smaller areas, is a function of the relative levels of house prices at the place where there has been an exit and the place at which to which those people are exiting, and you can see the significant changes that have taken place in house prices in the West. So that has certainly been a contributor. Not only that, but the fact that interest rates in the most recent couple of years have been lifetime low levels, enabling the mortgage costs to be substantially lower until you incorporate the house prices of the most recent couple of years. So that incorporation basically shows us that the low third of house prices have appreciated the fastest. The middle third of house prices appreciated in the middle, and the highest house prices have appreciated the least. This is the confluence of the millennials as first-time homebuyers driving the demand curve, those very low, historically low interest rates, and the fact that part of fiscal policy was targeted towards salary earners, that in particular the PPP households and those millennial households who are below the income thresholds, where if they had been saving to buy a house, the supplement of the additional stimulus money put them in the money to become homeowners. Of course, that also was paired with the fact that the boomers were doing what they had always suggested they were going to do, which was they were going to age in place. So the supply of existing homes, which is where the first-time homebuyer population usually targets, was at historic levels. In fact, there was a headline, one of my favorite headlines recently, was that there were now the same number of houses for sale as existing homes available for sale as there were realtors. So in essence, each realtor had one house to sell. That was an historic low on the supply side for existing homes. So many of the first-time homebuyers were moving into buying new homes, And traditionally, builders focused on building for move-up buyers, which had more amenities and characteristics than entry-level homes. So the builder community, not only having a shortage of materials and labor and higher cost land, also faced the challenge of figuring out how to build to the entry-level buyer, which was not their the typical client group. So there, as you would expect, those MSAs which saw higher home price growth also saw higher single-family permit growth, although, well, the location of those things mattered a lot based on the development costs or the time that it took to get through the permitting process to actually be able to build houses. And what you see is that the expansion of permits occurred, as you would expect, faster in those markets where the development process is less burdensome. This is my favorite chart. If you're going to take one chart away from this collection to understand the dynamics in the housing market, this would be the chart. I've suggested it's my favorite chart. I'm an economist, so I get to have a favorite chart. I suggested I was going to put it on a t-shirt. That might have pushed things a little too far, but it tells a number of things that gives you a good way of understanding the dynamic that has evolved over the last couple of decades. So what it's showing, the dark line is the year-over-year change in inflation-adjusted house prices. The orange line is single-family housing starts per 1,000 households. So what the chart is attempting to say is that when house prices give a signal to builders to enter production, does the supply curve respond? And what you see is in those instances when the price signals were strengthening, you also saw on a lagged basis the strengthening of housing starts. And when prices were signaling a slowdown or a reduction in demand, you saw a reduction in housing starts per 1,000 households. That was quite tightly correlated all the way out until about 2009. Then, post-2009, what you see is a temporary price signal. I'll come back to that in a second. And then you see a very strong price signal, which started to see some narrowing of the difference between the signal for supply and the development of supply, but then that was reversed again with the pandemic. So so what happened in 2010? We see this price spike in the year-over-year change in real house prices. Well, since I'm not standing in front of you in person, I usually, when I'm speaking in person, I'll say this will be on the quiz. This is a lesson in temporary versus permanent changes in behavior. So a temporary tax credit for first-time home buyers was passed. So there was an immediate response on the demand side of the equation, reflecting that, which resulted in that spike in price because the supply curve for housing is inelastic. What that means is it takes a while to build a house. You can get an immediate response because on the demand side, it's a question, can you get the mortgage credit or do you have the cash to make a purchase? But you don't get an immediate influx of a bunch of houses to meet that. So what you see is a temporary spike in price. And then once the program expires, you see a return to the previous price path. So it's a lesson in the difference between passing temporary and permanent programs. Temporary programs get temporary responses, permanent programs change behavior. So then what you started to see in the 2012 And 13 time period was the reduction in households that were underwater. Huge share of houses that were householders that were underwater in the 2007 to 10 time period. That started to be solved in the 2011 and 12. Toward the end of 2013, we put out a press release from our National Housing Survey in which we said it's now the case that housing is on track to recovery. And about a year later, having observed the change in consumer attitudes, we said now the problem is going to be supply, because we could see that the supply curve was simply responding very slowly and irrespective of the change in pricing. So while last year prices in 2020 prices rose about 15%, and this year about 20%, the house prices have been rising above the long-term inflation-adjusted average since 2014. And this chart makes that quite clear. You can see in 2018 what I referred to earlier about the Fed running off some of their portfolio, which actually slowed demand in the housing sector. And you can see that price and supply started to move closer together. Then we got the pandemic. In the pandemic, what happened? The job loss, as I mentioned earlier, was heavily among renters, as opposed to people who were potentially homeowners. You saw interest rates in 2020 drop to levels that no one had ever seen in their lifetime. Mortgage 30-year fixed rate mortgage rates between 2.5% and 2.75%. They're still at around 3.25%, which in the absence of 2020, we would be saying they're still at the lowest that we've seen in our lifetime. And that again accelerated demand tremendously. Supply can only respond so fast. And you saw the tremendous spike in house prices. So what does that suggest are the risks? With that rise in house prices, offsetting some of that benefit of the low interest rates, if low interest rates then start to come up, you would expect to see some slowing in the housing sector. And we do expect to see that. This chart just suggests that, not surprisingly, in regions with higher net population change, you're going to see a larger growth in permits, and you can see the areas where employment did not grow, and those areas which did grow, and you can see the change in housing. You see Texas out there at the far right with permit growth and population growth leading the way. And Austin's kind of in the middle of that. You also saw in the Southeast, Charlotte, Tampa, Atlanta, the business-friendly and more business-friendly environments seeing the pickup in employment and also being impacted in the housing sector. So it's still the case that housing is, from a mortgage payment perspective, is still affordable, but that the rise in rates, along with the very strong house price appreciation, is going to constrain affordability going forward. And as I said, I don't think that the Fed, at least in the near term, the Fed is not going to be overly nervous about that, given what house prices have done in the most recent couple of years. We do not expect that house prices will fall. Our expectation is that in 2022, house prices will actually rise probably about 8%, which is less than half of the rise that we will have seen in 2021. But that house prices are sticky downward in part because of the asymmetry of tax policy, which allows for the exemption of capital gains up to a certain level, but it does not allow for the deduction of capital losses. So in those markets where there is a price decline, it does take some time for prices to recover. But like I said, we don't expect a national house price decline. We expect a slowing next year and then a flattening in the subsequent years as incomes catch up to the very substantial house price increases that we've seen in the most recent couple of years. One of the things to note, excuse me, is that that the stimulus certainly has had an impact. In fact, in first-time home buyers, if you look at the first-time home buyer data, the average down payment is about 10%, $10,000 greater than you might have expected. And if you take a look at all of the stimulus that was provided for a household of 3, where the income is below the thresholds in each case, that couple with 1 child would have gotten about $11,400 in stimulus. If you convert that to a 3% down payment, if you have good credit, you can get a 3% down payment. That's a $380,000 house. So unquestionably, the fiscal stimulus has had some impact on the demand curve and the impact on house prices as well. So the end of that stimulus, in addition to tightening on the Fed, certainly we should expect some slowing in the housing market over the next year and to 2 years. That the month supply, however, still at very low levels, though coming up. One of the issues on the new homes supply side is that last year the highest share of new homes sold ever were homes that were not even started, and so we expect some slowdown in the 2021 numbers leading into 2022, simply because builders have to actually build the houses that they've already sold but not yet built. So inventories still remain very low. These are some of the West Coast markets. As you can see in for example, Seattle, Portland, Boise, outside the California markets, very low levels of supply available. And I mentioned some of the challenges that the builders have faced. One of the things that was noted significantly was the rise in lumber prices. Part of that has come back off, not all the way down to where they were prior to the pandemic, but down significantly from where they were at the May 2021 peak. However, other input costs have continued to rise. So the cost to build new homes also being impacted by the supply chain for inputs into the construction of new homes. The concern about the house price bubble from our perspective ignores to some degree the fact that average DTI and LTV particularly in the GSEs declined pretty significantly in 2020. In other words, in terms of credit quality, the credit quality is quite strong. It's nothing like what it was in 2007 to 2009, when there was a significant easing in credit quality and layered risks. Those things are not part of the current market. As I mentioned, the financial strength of some of those first-time homebuyers is pretty substantial. So we don't expect that there's a credit issue that's likely to change the direction for housing, but rather simply the constraint placed by the acceleration of house prices and a rise in interest rates, which will which will make it more difficult to qualify for borrowers at the margin if, as we expect, credit conditions are held constant. The monthly survey that we do on households, we survey 1,000 households a month. And we ask them a series of questions. We have some standard questions that we ask. Is it a good time to buy or a bad time to buy? Is it a good time to sell or a bad time to sell? Among those who said that it is a bad time to buy, 67% listed home prices are high as the reason. Among those who said it was a good time to sell, 59% of those stated it was because home prices were high. So you have in both cases the recognition of the impact of house price, both on the demand and the supply side. So that 15% increase last year and the 20% increase this year certainly have an impact on households, and from our perspective, will constrain start to constrain the pace of sales. You can, excuse me, you can see in this little series of charts what I was talking about on the supply side. Average days in the market at really all-time lows, the inventory at all-time lows, the percentage of homes sold above list price, over 50%, the percent of the houses off the market within 2 weeks at very high levels, all signs of supply side constraints leading to those very high home price increases. So I think I will, now this, one of the questions that comes up is the expiration of the foreclosure moratoria. Will it lead to additional REO inventory? Chances are it will add to REO inventory. How much will it add to REO inventory is really the question. So from our perspective, there's 4 potential outcomes. One is, and we've already seen a lot of this, a household that took a forbearance, sees a recovery of their income, brings the loan current, or maybe never went delinquent, but took forbearance as a precautionary move, simply bring the loan current and move on. Some households who did have income curtailment took a forbearance because of that. With the growth of economic activity and incomes and employment coming back, were able to restore their income and now have become current. Another group, or perhaps, in fact, got a restructured loan if their income wasn't fully restored, and under the restructured loan are able to maintain the payments. A third category would be households that have seen a significant decline in their incomes, or maybe no restoration of their income, but actually have equity in the property, have the opportunity to do a pre-foreclosure sale and exit the property, paying off the mortgage obligation, taking the equity to reposition themselves. And then there will be a fourth group who may be in one of the few places in the country that has not seen price appreciation and did not get a restoration of their incomes, and consequently would go through the foreclosure process. But we do not see the foreclosures as becoming a driver, given the supply shortage in the marketplace and the single-family rental investors sitting on the sideline waiting for distressed properties to add to their portfolio. Let me jump just to the close out with the forecast, and then I'll take questions if there are any. So in 21, which we're now, obviously there's only 2 months left. So pretty much anything that's going to be that's going to close in terms of mortgages this year, we're pretty much toward the end, maybe another month of data to come in, which gives us a pretty good feel for what the totals will be for the year. So around 1.8 or 1.9 trillion in purchase mortgage originations, about 2.5 trillion in refinance activity. That's down, that refinance portion is down about 12% from 2020. But 2020, from a nominal dollars perspective, was the biggest year in the history of the mortgage industry. If you adjust for inflation, I think 2003 was actually just a little bit bigger. But in terms of dollar volume, in nominal terms, 2022 will be the biggest year that we will have seen. We expect in 2022, we expect about a 9% increase in purchase mortgage originations. That, as you can see, that's largely a function of holding loans to value constant and another 8% or so in house price appreciation, because the total existing home sales we actually expect to fall a little bit, partly just because of the supply constraint, but also partly because of a modest rise in mortgage rates. Now we expect, whereas in 2021, the number of new homes sold will be down about 4% from 2020, because, as we said, builders have to actually build the houses they've already sold. We expect a pickup in 2022 on that front of around 13%. So awfully hard to say any of those are bad years. In 2022, with that modest rise in interest rates, we do see a decline of about 47% in the dollar volume of refinances, but it's still a big year. And coming off of a couple of huge years to something that is probably more normal from a longer term perspective. And that's with interest rates, mortgage interest rates averaging about 3.3% over the years. So they probably be a little higher than that at the end of 2022, maybe 3.5 or a shade higher than that, but still a good year. So with that, let me end my comments and then see if there are some questions.
Doug, we did have some questions. I think we're up on our time, so we might just go ahead and move forward. But
sorry about that.
No. It's the standard questions. When's the next recession? And then when should I lock my 30-year? So those are the standard questions, right?
Okay, that makes good sense.
Well, on behalf of the firm, Doug, I'd like to thank you for joining us today. And again, for those of you out there that have not been pleasure to see Doug in the past, he will be back with us again on November 18th. So I encourage you, if someone on your board or would like to attend that, please pass that sign up. Again, that's at www.ibailey.com/bank seminar 2021. So Doug, thanks for your time, and I'll turn it back over to Ken.
Thank you. Thanks for the invite.
Have a great day.
Okay. Our next speakers, we're going to transition from an economic forecast to the tax update. First is Paul Sirek. He's a partner in our Minneapolis office with more than 20 years of public accounting experience. He serves as the firm's financial institutions industry tax department head. Paul provides consulting, tax planning, and tax compliance services to financial institutions, ranging from startup banks at $25 million to more than $2 billion. He's also a frequent presenter for various bank association and conferences on bank tax topics. We also have with us Bettina Brown, a senior manager out of our Sacramento office. She supports our California, the California banks in preparing tax returns. She navigates through complex tax issues to minimize corporate taxes. Her experience has been not only on the tax side, but on the audit side, which really gives her a unique insight into bank issues that help her better navigate the tax code. Bettina will offer clients an easy understanding or explanations to their questions. And she communicates filing requirements and deadlines to make sure clients are never caught off by surprise. So at this point, I'll turn it over to Paul and Bettina.
Thanks, Ken. Oh,
Thanks, Kim.
am I coming across okay? I'm getting kickback on my mic.
No, you sound good.
Loud
Okay.
and clear.
Sorry about that. Just wanted to make sure before I started talking and nobody was hearing.
You are good. And Bettina, you do have control.
Awesome. Thank you so much. So as all of you know, because you heard me say this last year, we've had more changes in the past 2 years to taxes than I think we've had in the 20 years that I've been doing this. So here we go. What's new for this year? Fasten your seatbelts and we'll start on your taxes. So we've got two bills in play right now. There's the infrastructure bipartisan bill that includes the $1.2 million in spending. $1.2 trillion in spending, sorry about that. You can also find transportation, water, broadband, energy investments. The cost is fully offset, but yes, that is in quotes. It includes crypto reporting and Superfund taxes with no other tax raisers. Now, next we have the Democrats' reconciliation bill deal. Now, higher spending on this one, it's at 3.5 trillion. Now, if the framework of the plan is accepted, I think we can expect that the details are going to continue to be negotiated. Now, not sure how big of a deal this actually is, but there are definitely revenue raisers in it.
It's already shrinking, right? It's already,
It is.
The rumors coming out, it's already been negotiated down, supposedly down closer to only 2 trillion in
Yes.
spending. So how big of a deal it's going to be, from a tax perspective, we know what's in the legislation that came out of the Ways and Means, and Bettina's going to go through that. But what's going to survive, the legislation, we don't know yet. But we'll tell you, Bettina will tell you what we know right now.
It will be different. So take it with a grain of salt. When I talked to Mel this morning and said, when can we expect a vote? He kind of laughed at me. So I would say, off to the side, what's the status? Don't expect a vote soon, or if you do, everybody in Washington will be surprised.
Right now, the goal is to have something passed by Halloween, which is not far off. That's 13 days by my count.
Yeah, Mel kind of said he thought December was more likely. So we'll see. We'll see who's right on this one. So let me get us to the next slide. So what's on the table for corporate rates? Nope, too quick there. So we're looking at currently is this 21% flat rate. The proposed rate changes put the corporations back in a graduated system. So if your taxable income is $400,000 or less, you'll benefit from a lower 18% tax rate. Income between $401,000 to $5 million is going to stay at the current 21%, while income over $5 million and up to $10 million will be taxed at the higher 26.5% rate. So taxable income over 10 million to 19.567 is going to fall into a 29.5% rate. Now, this higher rate's designed to eliminate the benefit obtained from the lower rates. And once your taxable income is over 19.567 million, well, every dollar is effectively going to be taxed 26.5%. 26.5%. Under the current proposal, this will be effective for tax years beginning after 12/31/21. And if you have a fiscal year, you'll need to calculate the blended rate for the tax year that includes 12/31/21. So think back to 2018 and the process is going to be the same.
Yep. So we get to go back to playing games with tax brackets again for C corporations. Yes. So really, Bettina, go back to those C corp rates. I mean, if you had exactly 10 million of taxable income, right, that would be an effective blended rate, federal tax rate of about 23.63%. Not a real steep jump, right, from our current flat 21%. And as Bettina, you'll notice what didn't happen on there was, way back at the end of May, it was very highly publicized, and a lot of you probably heard, the Biden administration proposed a 28% flat corporate tax rate that was published in the Treasury's Green Book with their budget proposals back at the end of May. That didn't happen, right? That didn't make it into this legislation. Also missing on our bullet points there, you'll see is any kind of a corporate AMT. It was pretty well publicized that the Biden administration was looking to do, put in or implement an AMT for corporations based on book income. You know, the proposal was book income of 2 billion or more, right? So he's going after the Apples, you know, of the world, where, you know, they have large book income, you know, reported, but then minimal taxable income. But that was also missing, you know, so it was, again, an earlier proposal that didn't make it into this legislation. So I'll let you go into the individuals.
Individuals. So we're going to reinstate that higher marginal tax rate of 39.6%. As you can see, the individual rates stay the same until you hit taxable income of 400,000 if you're married filing jointly. And there's also a proposed 3% surcharge levied on modified AGI in excess of 5 million. So what's modified AGI, you ask? Well, it's whatever they say it is. And in this case, the current definition is it's going to be AGI less investment interest claimed as an itemized deduction. Now, if you're single, whoa. Okay, there we go. If single, you still have the same high marginal rate of 39.6%, but you're not going to hit a change in your rates until you're over 200,000. That same 3% surcharge will apply, and there's going to be no change on that $5 million limit for single.
So you kind of see the theme from those two slides, right? 400 grand, you know, married filing joint, 200 grand, you know, filing single. Kind of the definition, right, of a high income taxpayer, you know, that's being kind of that's from that point on, we're going to see some tax impact to those folks.
So what are we looking at for capital gains rate? Well, the top rate of 20% is proposed to increase to 25%. And before you go out and sell all your investments, in order to prevent significant market movement, the effective date has been set at September 13th, 2021. Yes, that was about a month ago. Now, there's an exception for binding contracts in place before September 13th, 2021. You just want to make sure the transaction closes by the end of the year and you recognize the gain on your 2021 tax return in order to benefit from the lower rate. But I have already heard news that the September 13th date might be changing, but I wouldn't expect it to change to a date that's going to give you any more flexibility, because that was their whole point in setting the date back, is they don't want people to go crazy on this. Okay, so what's on the table for our S Corps and partnerships? Well, you're going to note that the pass-through deduction is still in place, and that's the 199 cap A deduction on qualified income. But the deduction is limited to $500,000 for married filing joint and $400,000 for single. The limits are without regard to AGI. Now, there are no proposed changes to the rules for specified services businesses. So it looks like they're going to stay in place, and the same restrictions and the same limits are going to apply to those.
Yep. The only thing is, so if you have a K1 coming from a pass-through, like an S Corp bank, and if it's under 2.5 million, right? If you're a married filing joint taxpayer, this really shouldn't impact you. So different S corporations are going to be impacted by this proposed provision that Bettina just talked about in different ways. Widely held S corps with several K1s with smaller numbers on it probably won't be impacted at all. But more closely held, right, in profitable S corporations, this could be a pretty big deal, this limitation.
And there's a polling question, so if you haven't answered it, make sure you look at the screen. Just a little hint there. Okay, so now we've got the 3.8% net investment income tax that's extended to individuals who are active participants in the pass-through. Now, the phase-out range that they're putting in place is fairly narrow. And if you're married filing joint, the phase-out range is between 500,000 and 600,000 of modified AGI, singles between 400,000 to 500,000 modified AGI. Again, the question, what's modified AGI? Whatever they want it to be. In this case, they're looking at AGI less wages subject to FICA and net operating losses. And to the extent you're in an S Corp that has PTI that's being distributed for prior years, that may be able to be excluded as well. And as we said at the beginning, please keep in mind, everything that we've done on these slides is what's proposed. And I think the only thing we can promise you is that we're going to be wrong when the actual things come out.
Or it'll be different, right?
It'll be different.
But On this proposal, on the second proposal, Bettina just talked about the net investment income tax. You know, those of you that are S corporations, you're already aware that really that only impacts your passive shareholders. And remember, our bogey was always 100 hours of active participation in the business. You know, we always encouraged people that were directors and maybe active on some committees, maybe they're on the ALCO committee, credit committee. You know, journal your hours, make sure you're tracking those hours to get to 100. So we could avoid, you know, or you could avoid this 3.8% extra tax, if you will, on your K1 income. Well, this proposal, depending, as Bettina mentioned, for those, again, identified higher income taxpayers, you wouldn't have to do that. It wouldn't matter anymore. Active and passive shareholders alike would be subject to that.
So if the tax rates are going to increase, what should you do? Well, the goal is going to be to accelerate income and defer deductions. There are a few thoughts on possibilities on this slide. Now, one thing I do want to note that is if you're looking to do any estate and gift planning, you want to do that now because time with your CPA and attorney is going to be at a premium, and making changes to trusts before the end of the year is definitely going to be a race to the finish line. So what does reverse planning and accelerating income and deferring deductions look like? I'm just not used to this mindset, sorry.
Didn't we just do the opposite of this like 4 years ago?
I just played the conference from 2 years backwards. So here's a list of some of the possibilities. You can file a 3115 to change an accounting method. Just know that any unfavorable adjustment add back is going to be spread over 4 years. And if you file a 3115 to change an accounting method, it does lock you into that method for 5 years. Another less restrictive option is making an election on a current year tax return. The election usually only applies to the year elected, so you're not committing to a method longer than you choose. And the last option is simply by changing the facts and circumstances of possible deductions that would push the deduction into a future period. So let's go into some of these in more detail. Capitalized loan cost. Deduct or capitalize. So years ago, PNC Bancorp case restored the current deduction for loan origination costs. Now, as you know, for GAAP purposes, when you book a loan, in addition to capitalizing the loan fees, you also capitalize the loan cost and you amortize this expense over the life of the loan. Now, for tax purposes, this internal standard loan cost is deductible on the tax return on the year the loan is booked. You don't need to take the deduction over the life of the loan as it's reflected on your books. So if a 3115 was filed in prior years to utilize this method, then on the bank's tax return, it will reflect a deduction for the amount of the current capitalized loan cost. But an annual election is available that would allow the bank to forego the current year deduction of capitalized loan costs for loans booked in the current year. This will result in increasing capital income for taxable income for 2021 or whatever year the election is made, and deferring the deduction related to these costs into future years, keeping book and tax the same for these loans. Now, the only year affected is the year the election is made. So please be aware that for calculating current and future returns, a detailed report of unamortized loan costs will need to be available that can be sorted by year. And this is going to allow the tax preparer to sort loan costs by years to determine what's the deduction for loans made prior to the election, the deduction for loans that were made during the election, and the deduction for the loans made after the election. So there is a little bit of housekeeping that we need to do if this election's made. So here's an example of what it would look like. So if the bank incurs loan costs of $750,000 of standard loan costs, $400,000 of costs allocated that are under $5,000 a loan and still deductible, $250,000 costs that are over $5,000 a loan and have to be capitalized for tax, or $60,000 in commissions paid to outside third parties. These also have to be capitalized for tax. So if the bank is currently deducting allowable loan costs, the tax return would reflect a deduction of $1,150,000, which is the $750 plus the $400. Now, if the election is made, instead of deducting $1,150,000, this amount would be deferred and would now be deducted over the term of the loan following book treatment. Now, as you know, standard loan costs for 1 year's worth of loans can be significant. So if your taxable income puts you in a tax bracket that is higher than the current 21%, this could be a viable election that will allow you to save on the tax rate differential. Bond market discounts. All right, so if the bank acquires a bond at a discount, for book purposes, the amount is accreted into income over the life of the bond. And if the bond was acquired at original issuance, the amount's considered OID, and there's no book tax difference on these. But if the bond was acquired after its original issuance, this market discount is not taken into income for tax purposes until the bond matures or is sold. This is going to create a tax deferral for the book tax difference of the accreted discount. Now, there is an election available to recognize the income over the life of the bond, keeping book and tax the same and not deferring the income until maturity or sale. Now, as with the prior elections we discussed, it only applies to bonds acquired in the year the election was made. So the prior year bonds will keep the same treatment they currently have, and bonds acquired in the year the election was made are always going to be book taxed the same. So I'm not sure how much of a tax saver this is going to be, because it might not be a big amount, but still something worth considering. We try to tell you everything that we can think of so that if it strikes a chord with your bank, you know to ask us about it. We know taxes, but you know your bank. So if we can get our brains together, we can do a much better job between us. So bad debts. What are our options with bad debts? So everybody pretty much knows the basics of bad debts because you've been hearing them year after year after year. But just to make sure everybody's on the same page, the IRS allows a deduction for a bad debt that is wholly worthless in the year it becomes wholly worthless. So if you have a loan that is fully charged off, the year that is fully charged off is when we deduct it on your tax return. And the IRS also allows a deduction for a bad debt that is partially worthless, but the deduction cannot exceed the amount that was charged off for books. Now, this partially worthless charge-off contains more flexibility than a wholly worthless charge-off. So if you charge $200,000 off on a $1 million loan, the tax return is not required to reflect this $200,000 partial charge-off if there's reason to believe that the full $200,000 does not meet the rules for being deducted. Now, do note that if you have a partial charge-off 1 year and you defer the charge-off into a subsequent year, if that loan is subsequently fully charged off, whatever year it's fully charged off, any prior charge-offs that haven't been deducted have to go through that return. But let's circle back to the flexibility. So what does the IRS look for? So when we're looking at a partial charge-off and any reason that might exist that makes one think, my cursor, makes one think that the partial charge-off might not be deductible, I just want you to come back to the favorite IRS phrase, which is facts and circumstances. So for those of you that have had IRS audits where they look at your loan portfolio and they look at your charge-offs, you know that the IRS has previously been on the side of arguing that you deducted your partial charge-off too soon. And when they decide this, they look at value of collateral, they look at bankruptcy of the borrower, they look at any legal action pursued by the bank. Even the cooperation exhibited by the borrower has been reviewed by the IRS. So now, in the past, I've had conversations with banks that if the bank is taking a partial charge-off and the charge-off is deducted on the return, then there shouldn't be a loan file write-up that indicates that this is a really good loan, we're feeling really good about it, and we expect to collect this in full. Because those are the things that the IRS does look at and they don't read. So I would just indicate the same in this instant. The tax treatment that we follow on the return should be consistent with the internal loan write-up that you have at the bank. Now, I've also never been in a situation where an IRS auditor chastised me for not taking a charge-off deduction, but this is a different situation. So it's unknown to me if the IRS would argue that a charge-off didn't happen soon enough if it's delayed by a year into a subsequent year. But I think the ending statement is that if the tax treatment is consistent with the loan documentation, you're going to be fine if anybody ever questions it. All right, now let's visit the conformity election, because some of you may have elected the conformity election in prior years. Now, if a bank made a bad debt conformity election, they did it in prior years to kind of protect the charge-offs that they've booked. So to refresh your memory, a conformity election can be made when a bank requests and obtains an express determination letter, or EDL, from the federal regulators at each and every federal exam. Now, once the conformity election is made, the regulators are in essence telling the IRS they agree with every charge-off, the EDL, and the bank is deducting the same amount of loan charge-offs on the books as on the tax return. Thus, there is no flexibility in reviewing partial charge-offs and not deducting them in the current year. What you deducted on your books is the same as the amount on your tax return. So therefore, the information I just talked about doesn't apply. It's not available if you have the conformity election in place. But what do you do if you want this flexibility because there are significant charge-offs in which you think taking the deduction might be premature? Well, there is the ability to revoke the conformity election, either by filing a 3115 change in accounting form to revoke the election, or by simply not obtaining the EDL from the federal regulator at the exam. Now, before you get too excited about this idea, remember, there was a reason the conformity election was made in the first place. It was so that if you were audited by the IRS, they would not comb through your loan files and challenge you on each and every partial charge-off you deducted. If you revoke the conformity election, you are opening this door with the IRS. Now, if you revoke it using Form 3115, you're going to be locked in for 5 years, and you'll not be able to put the conformity election back in place for at least 5 years. If you revoke your election by failing to obtain an EDL, you'll not be able to make the conformity election again until your next federal regulatory exam in which you do obtain an EDL. Now, as you know, if you're a state bank, you only have federal regulators out every several years as they alternate with the state. Now, please don't understand me. I'm not saying this is a bad idea. I just want to make sure up front that you understand that in that prior list that we gave you possibilities, this is in the first bracket, as it affects more than just the current year.
So on the conformity election, as Bettina stated, a lot of our bank clients made this election back in that kind of the 2008 to 2012 timeframe. If we think back to those years, there were a lot of loan charge-offs, or a lot of our bank clients did experience some pretty heavy charge-offs, and IRS examiners were out there trying to challenge any bad debt deduction they could. So that's when this election became fairly popular, because like I said, as Bettina said, if you can get that express determination letter, or that EDL, from your federal level examiner, and that express determination letter, basically, what could you say? It says, Bettina, in a nutshell, that, hey, we're the federal examiners. We've already examined loan files. We've already examined their charge-offs, and this bank's doing everything A-OK, signed the FDIC or the Fed or the OCC, and then you like I said, you provide that. You can, if you're making the election, you provide it to the IRS. If you've made the election, you still got to get it every time. But you just, file it away and you have it, if you need it. But I did have some, I know our firm had some clients that weren't able to get those express determination letters during that time frame because they were amending call reports, back posting charge-offs. So it's not an automatic, but it serves its purpose during certain cycles, put it that way. So as Bettina said, maybe this is not one of those cycles, right, where it's essentially needed. So, but you can go back, like Bettina said, you can revoke it and then go back at a later period.
Mm-hmm. So how are you deducting your bad debts? Well, if you're an S-Corp or a large bank, which is a bank with over 500 million in tax basis average total assets, you're deducting using the direct charge-off method. This means that whatever you deem as a tax loan charge-off or a tax loan recovery flows directly through your return. But if you're a C-Corp small bank, then you're using the reserve or experience method. Now, this calculates your tax deduction using a 6-year average of net year charge-offs to eligible loans. Now, for those of you using the reserve method calculation, you know that your tax deduction might be more or less than your actual charge-offs, and the amount's going to fluctuate depending on the activity of the prior 5 years as well as the current year. Now, the prior information regarding how do we determine a tax loan charge-off still applies, as the flexibility of current year loan charge-offs will still determine the tax loan charge-offs that feed into your 6-year calculations. But a bank using the reserve method is going to have less of an impact. So if you change your charge-offs, as you know, depending on what you had prior, the 6-year average, it may or may not have a significant effect of what it calculates out as your tax bad debt deduction. But think of the reserve method calculation. You've got a 6-year net charge-off divided by 6-year eligible loan times the current year loan base. And this is your allowable tax reserve. You compare your allowable tax reserve to the current year reserve to determine your bad debt deduction. So if your allowable reserve calculates at $1 million and your current reserve is at $800,000, then you can reflect a $200,000 on your return. But the statute can be read to suggest that a zero deduction should be okay. So instead of taking a $200,000 deduction, you'll take no bad debt deduction, and the tax reserve will stay at the $800 balance to carry into the next year.
You might want to consider, if you are a small bank, you're still defined as 500 million or less. If you're a small bank, but if you think you're approaching that threshold, you think you're going to exceed it pretty soon, maybe you're growing and approaching it, or maybe you're planning an acquisition that you're going to go over that mark, you may want to consider recapturing that tax bad debt reserve started in 2021 if you want, right? It's a 4-year spread, your typical 481A adjustment. It's an automatic change to go from that reserve method that Bettina talked about to the specific charge-off method. That shrinks your deferred tax liability then if you're a C corporation, increasing your deferred tax asset. So you have over 5 million of income, taxable income, that will increase your pickup then, right? When we're adjusting our deferred tax assets. So it's just something to consider. If you're approaching 500 million, you might want to slide a year of that recapture into 2021 if that's the situation you're thinking about.
Mm-hmm. So what are tax planning ideas for bad debt? Well, you're going to want to review your charge-offs, consider deferring if feasible, possibly revoke your conformity election to gain flexibility in determining your charge-offs. And if you're on the reserve method, consider taking the minimum deduction. Now, in the year after the tax rate increase, you're going to want to maximize your calculated deduction and review any prior loans with book charge-off tax differences. Note these loans will need to be reviewed annually until all of the prior book charge-offs are no longer deferred. And keep in mind that the same review of the loan that dictated not deducting the charge-off, facts and circumstances, need to determine the timing of the actual deduction. Simply deducting all of the prior year loan charge-offs the next year shouldn't be done unless warranted. So make sure there's some thought, and more importantly, some documentation considered when you deduct your prior year loan charge-offs. All right. Now we're going to move on to our fixed asset considerations. So as you all know, IRS allows a bonus depreciation deduction. It's equal to 100% of the cost of the fixed assets for calendar years 2018 through 2023. Now, bonus depreciation is available for assets with a less than 20-year tax life. This includes canned software, equipment, furniture, fixtures, and qualified improvement property. Now, the bonus depreciation is assumed deducted unless an election is made to opt out of bonus. Now, here's an example of what it looks like to opt out of the federal bonus depreciation. So if $1 million worth of 5-year equipment is acquired in 2021 at a 21% tax rate, the tax return calculated tax deduction would be reduced by $210,000. If an election is made to opt out of bonus depreciation, then the deduction is going to be spread over 5 years. Now, if the tax rate increases to 26.5%, here's what the deduction and reduction of tax on the tax return would look like over the 5-year period. Now, acknowledging that there is a cost to paying tax today that you'll get back over a 4-year period, the net present value of the tax difference has been calculated using a 4% rate. So based on a 4% net present value calculation, the difference in the tax rate savings is $26,361. So still something that's worth looking at and seeing if it's going to be feasible. So what are some other cost considerations for fixed assets? Well, there are different elections that can be made that only affect the current year return, as the bonus. The bonus only affects the year that you make the election. There are elections to deduct repair costs or de minimis items that can be skipped. If you acquired a building or performed significant improvements to a building in 2021, you might want to consider getting a cost seg study to break the overall cost into smaller tax lives. And that affords the opportunity to either claim or opt out of bonus depreciation, however it works better, it gives you some flexibility. If you acquired a branch in 2021, you'll want to look at how the 15-year amortization is going to affect your tax numbers. So these are some things that you'll want to review with your tax preparer, just to make sure that you're kind of maximizing all of the planning that you can. And on to prepaids. Okay, prepaids. If you are currently following the 12-month rule, this means that you're deducting qualified prepaids when they're paid and not over the term of the prepaid. So what's a qualified prepaid that you deduct? Well, it's a prepaid with an original term of less than 12 months, or I'm sorry, of 12 months or less, my wording right. It's not connected to a long-term contract, and it's going to be fully amortized for book by the end of the next tax year. So in the example given here, the $10,000 insurance premium is deductible in the year paid, even though the book deduction is going to occur over the next 12 months in the next tax year. There is an election available to not follow the 12-month prepaid rule and to keep the tax deduction the same as the book amortization. Now, as other elections discussed earlier, this only affects the qualified prepaids paid in the year the election is made, and it's going to defer the prepaid deduction into the subsequent tax year, which possibly will have a higher tax rate. Reoccurring item exception. Now this relates to accruals. So if you are a cash basis taxpayer, this will not apply to you. This only applies to accrual basis taxpayers. Now, the general rule under deducting your accrued expenses at the end of the year is the accrual is deductible if the expense is paid within a reasonable period of time, no longer than 8.5 months. There's another polling question. Make sure you get it answered. If economic performance has occurred, which means that the services have actually been performed, the item is reoccurring and the nature and the amount is not material. Now, in the IRS world of facts and circumstances, a review of the accruals can be performed to determine if any of the accruals do not meet the rules to be deducted in the current year. If they don't meet the rules to be deducted in the current year, then the deduction is going to be moved to the subsequent year when the payment is actually made that clears the accrual. Bonus accruals, kind of the same thought process that you're working on with your accruals is you want to look at facts and circumstances. So this slide is referencing short-term bonus accruals and not deferred comp plans covered under 409A. And the bonus accruals, they are near and dear to my heart as I bother my clients every year to know what their fixed and determined amount is. Because the current rules are that a bonus is deductible if a bonus accrual is deductible if the amount is fixed at the end of the year and it is paid by March 15th. Now, this fixed and determined rule would apply if there's, say, a fixed calculation to determine the bonus payment, such as a set percentage of income, or if there's a bonus pool amount set. For instance, if the bank sets a bonus pool amount prior to year end, then pays the amount either equal to or greater than that amount by March 15th, then the bonus pool amount that was established at the end of the year is deductible. Now, the rules that determine the ability to deduct the accrual also determine if the accrual is not deductible. So what can you do? Don't approve the bonus pool, approve a small bonus pool, or approve the amount in January and not December. Now, I won't suggest you don't pay your bonus until after March 15th, because if your employees are used to getting their bonuses in January, I don't want them coming after me. But yes, this is an option. And the reality is if the bank doesn't meet the qualifications to deduct the year-end bonus accrual, the amount will need to be deducted in the following year when the payment is made, and this is going to defer your deduction until next year. And at this point in time, I'm going to turn it over to Paul, and he's going to keep giving you helpful information and wrap us up.
All right, very good, Bettina. I think there we go. So we're still in the mode that that Bettina started, right? What can we do if we wanted to defer deductions, right? Reverse tax planning. We want to, for a C corp especially, we want to grow that deferred tax asset. We want a future deduction. Same with an S corporation. We'll share or pare down our required S corp distributions if we defer deductions into subsequent years with higher, I should say, with higher tax rates. We want to defer those deductions. So another thing, kind of along the same line as Bettina just talked about, is the bonus accrual. Accrued qualified retirement plan contributions is another item, that's on the table or for consideration. Under section 404A6, right? For a qualified plan, if you want the item deductible, for example, in the 2021 tax year, you'd have to make it either during 2021, the contribution, not the accrual, but the contribution to the plan during 2021, or you could make it after your year end, but you cannot make it after the due date, including extensions of the corporate tax return. So there is a possibility there. One thing to be wary of, though, it's a case where it may be a good tax plan, you get the result you wanted there, but a little further down in the slide, we make reference to Internal Revenue Code section 415C. Now, there's annual limitations for the individual participants, how much can be contributed, on their behalf for annual additions to their plan. So as you can see, it's 58 grand, or if it's lower, their total comp for the year. It's be unusual, right, if their additions would exceed their total comp, but not impossible, I guess. So just be kind of aware of some of these other provisions. If you are approaching, it that way, or deferring, if you don't normally defer, right, to the next year with your pension plan contributions as part of your tax plan, make sure there's no ancillary unintended results as a result of that, because you're effectively kind of bunching up contributions that way. So you go to the next topic here. For those of you that have Esops in place, Esops are kind of a unique animal. They have their own set of rules and some special deductions available, special provisions available. Same thing there, right? ESOP contributions, you have to make them just like the other, the qualified plan contributions I just referred to. But there's some, if you want to call them, additional deductions that could potentially be available for ESOPs. The first one mentioned there, 404K, there's a deduction for dividends paid. If you're a C Corp, this is only for C Corps. If you pay dividends to an ESOP, there is a special deduction potentially available. And then 404A9, there's an extra deduction of up to 25% of employee wages for contributions that you'd pay to the ESOP if it's a leveraged ESOP. If the ESOP took out debt, to purchase, shares and then allocate them to participants. You have to kind of be aware of bunching, there as well. It's only deductible to the extent principal is reduced and shares are released. So we'll go to the next slide there. So that, again, for that type of a deduction, you're limited to that year, 25% of that year's employees' wages. So if you defer that payment until the next period, you might bump into that limitation. So beware of that. And then the section 404K deduction, that's when a C corporation, again, only a C corporation, pays a dividend to an ESOP. And that's it's one way to qualify for the deduction is, I'll go right to the second to last bullet point. That's the most common situation we run into. But if the dividends paid are used by the ESOP, it's a leveraged ESOP, and they use the ESOP uses those dividends to repay debt, there is a tax deduction available for those dividends paid to that ESOP to reduce debt. There's another less common way to qualify for this ESOP dividend deduction under 404K. So if the C Corp pays dividends to an ESOP, either they could pay directly to the participants, extremely rare. I've never seen that structure, but you could also pay it directly to the ESOP, and the ESOP would then may have an election available for those participants that either they get that cash distribution or they can elect to use their allocated cash to reinvest into employer securities, within 90 days of year end. That dividend in that case would need to be paid within 90 days of year end. Thereby is the opportunity then that if you normally are doing that and taking that deduction, if you are projecting or thinking you're going to be in some of those higher tax brackets, in the next year, here's another opportunity. If you're taking that 404K deduction, if you're meeting one of these two qualifications, that your ESOP is leveraged and you're paying down debt, or you're giving participants the option, it's elective for them to either get the dividends or to reinvest. You would again have that opportunity to defer that deduction if you don't meet that 90-day requirement. Real quickly here, some of you may be reconsider. We just talked about this. It seems it was 4 years ago, right, when we had some pretty substantial tax legislation again going the other way. This is something that should be discussed all the time, by banks and holding companies and their shareholders. If we are eligible, if the bank is eligible to be an S corporation, what's the optimal tax structure? And, as Bettina did a great job of covering, we're expecting tax rates to go up for C corps, maybe, depends who you are, right? If you have over 5 million of income, S corps, again, depends on your shareholder mix, your shareholder base. What is the impact going to be on them? But again, what is your strategy, your operating strategy, your ownership strategy? The strategy of a bank that's looking to grow, right, or expand and make acquisitions, maybe capital retention, right, is the number one objective of that bank. Well, if you're not, distributing capital or distributing earnings, and you're not really looking to sell, anytime soon. So we have the bullet point, long-term capital gains rate, that's expected to increase. So one of the great benefits of an S corp is the shareholder basis increases every year for undistributed taxable income. But if the ownership group, if their plan is it's going to be a generational thing, right? Maybe those shares are going to pass through estates and get a step up in basis. An S corp basis build up maybe isn't worth a whole lot, if that's your strategy. So the biggest thing is to determine first what your strategy is, your ownership strategy. Is it to distribute earnings, substantially? You earn 5 million, distribute 4, right? You don't need to retain capital, and that's not your objective. Well, then maybe an S corp is the way to go. You can get that cash flow out to your shareholders more efficiently as an S corporation. Again, if you're qualified, the 100 shareholder limit, one class of stock, etc. So again, there's a myriad of things to consider. We're not going to belabor it today, but again, it should be something that's continuously on the table. If you are a corporation that has the right mix of facts that you could make an S corp election, just to make sure that owners and the board and the management team are all on the same page. What is your strategy? Is it capital retention? Or are you going to sell soon, and take distributions as in larger volumes? Different strategies tend to marry better to an S or a C corporation strategy. So strategy first, and then after that, we can decide what is the optimal framework for your organization. Employee retention credit for banks. Quickly, this is a payroll tax credit, not an income tax credit, that came with some of the COVID-19 relief back in March of 2020. There was a proposal. Bettina mentioned there's 2 bills, right, on her first slide back then. That first bill, there was no income tax real revenue raisers, but there was a payroll tax credit revenue raiser in the form of, they're suggesting to get rid of the fourth quarter of 2021 for the employee retention credit. Again, hasn't passed, and the later we get into the fourth quarter here, the less likely that's going to survive. But What is this credit? You know, if you haven't heard about it yet, in 2020, you know, this payroll tax credit was for the year was a credit of 50% of up to the first 10 grand of wages per employee. So it was a 5 grand credit for the year. If you were under, it was, I believe back then it was under 100 employees, only wages paid to employees not providing services would qualify. So I think that bullet point that we ought to type, it should be under 100 employees for the 2020 credit. For the 2021 credit, goes up to 500 employees. It applies now to larger employers. And the credit got supercharged in 2021. It's now 70% of the first 10 grand of wages per employee, and it's per quarter. So it's up to 28 grand per employee per year, you know, with 4 quarters. It's not all gravy, right? The corporate income tax deduction for wages is reduced. If you qualify for the credit and take it, you have to reduce your deduction for that payroll tax credit. But again, the eligibility is determined on a quarterly basis, and you got to meet either. There's 2 ways to qualify. One, there's a gross receipts reduction test. I'm going to talk about that on the next slide. Or less applicable, as we found for community banks, is you have to have a full or partial suspension of business operations in 20 and 2021 due to a state or local government order related to COVID-19. Basically, a state or local government would have to say, you got to limit your operations. You got to close your branch down. You can only have your branch open 4 hours a day, something like that, a direct order from a government. You know, meeting social distancing, you know, guidelines, you know, issued by the CDC or social distancing guidelines, you know, from your local government. It's not necessarily an order that they're telling you that you have to limit operations. So we kind of banks, you know, like I said, it was tough to qualify under that method, right? Because there weren't many government orders out there that we're aware of that told banks strictly to limit their operations. But there are some banks qualifying in our experience under the gross receipts deductions test. There's various interpretations of how we define gross receipts, right, for tax purposes. One of those areas of tax law, I guess, where there is no hard and fast, clearly stated, I guess, definition of how you compute gross receipts. There's room for some interpretation in how you calculate that. Now in 2020, the gross receipts, you have to measure the gross receipts on a quarterly basis. And in 2020, to qualify, you had to reduce gross receipts by at least 50% from the same quarter in 2019. So you'd go quarters 1 through 4 and compare 2019 to 2020. Did we decrease by 50% or more? That's a pretty steep drop off. Not many banks, you know, hit that bogey. Now we go to 2021, and you compare gross receipts again. 2021 quarters 1 through 4 to 2019. We skipped 2020 and compare to 2019 what we could deem a more regular or more normal year, and they only have to decrease by 20% this time. So a little less of a hurdle to qualify during 2021. And there is a special election in 2021. You're able to elect this test. You can use the quarter prior to your current quarter to meet that test. So if you met that test, the 20% decline in the 4th quarter of 2020, you can elect in the 1st quarter of 2021. I'm going to use that 4th quarter and take this nice 70% credit. I'll leave that 50% credit. Or you didn't qualify. Maybe it's only a 20% decline. You didn't have a 50% decline, but you qualified under these new rules. You could elect to use that 4th quarter of 2020 and take that credit for the 1st quarter of 2021. So that's something, if you haven't looked at your gross receipts and measured that, that's something you're going to want to consider here. We do have some time. You got, is it Bettina, is it 3 years to claim that credit? So but be sure you're looking at it and not leaving it on the table should you qualify. A lot of banks are thinking, we're having great years, right? There's no way we're going to meet that test. But again, depending on how you're defining gross receipts will depend on whether or not you may potentially qualify for that payroll tax credit. Real quickly here, I see there's another polling question. For S corporations, there's at the federal individual tax level, there's a $10,000 cap on state and local taxes for itemized deductions. So if you're an S corp bank shareholder, you get a K1 and you pay the state taxes on it, you're not getting any federal tax benefit for it. And that started with the Trump legislation from December of 2017. That's when that was put in place. We call it the SALT cap. So to work around that, many states have passed legislation that allow the S corporations, the partnerships, the pass-throughs in their states to pay state income tax at the entity level. Then the entity, the S corp or the partnership, takes a deduction, a federal deduction for state taxes paid. They're working around that $10,000 cap. Several states have passed that legislation. So it's generally on an elective basis. So we just want you to be aware, if you are an S corporation and you're profitable, your shareholders are paying taxes, be sure to discuss with them, consider this valuable, potentially valuable election. If you're an S corp or maybe your shareholders are involved with partnerships, it could benefit them in that respect. Some other really quick proposals: estate taxes. As Bettina said, if you're going to do some estate planning, you better get on it. We don't know, again, are these proposals going to be real or not? Right now, it's just written in proposed legislation that's frankly not moving anywhere right now. They're suggesting to basically cut in half the lifetime exemption, the unified credits. Now it's 11.7%. Legislation says 5 million, but index for inflation, so it's calculated to be about 6,030,000. You might ask, why don't you just say that, right, in legislation? But that's where we're ending up. It's basically getting cut in half. And they are putting some restrictions on the use for some estate planning techniques that have been popular, grantor trusts and such, that it allowed a taxpayer to move large quantities of assets out of their estates into a grantor trust with very minimal gift tax impact. So they're looking to shut some of those things down. This is an awful proposal, and it's not even in the legislation. This is just in the newspapers right now, and there's been a lot of discussion on this. I think I just read a letter this morning signed by 101 trade associations saying that this is a horrible idea. Some Democrats are pushing for it to kind of narrow that, what they call the tax gap. I think they're estimating that it's over 7 trillion of unreported taxable income. If it's unreported, I don't know how you can quantify it, but somebody did. It's estimated to be about 7 trillion. That if a bank would prepare a new 1099 for all customers that reports the ins and the outs of over $600 is what's suggested. Some people are saying, well, $10,000 would be better. I think it's, I don't know how much better that would be, but I think the IRS or the congressional goal would be to catch some of the big fish out there, right? That their bank provides a 1099 with, 12 million of cash coming in, but then they file a return with only 900,000 of gross receipts. Something's up there. We're not quite sure, what the methodology would be to tying 1099s to these returns or anything. But again, it's not included in this recent legislation. But again, it's out there, and some Democrats really want that in there. But it's meeting some pretty stiff opposition. We'll just put it that way. Meals and entertainment, we're out of time, so the only thing I'm going to talk about there is the new Section 274 N2D, basically saying that was recently added in late 2020, meals purchased from a restaurant during 2021 and 2022 are 100% deductible if they would have otherwise been 50% deductible. So it doesn't automatically mean that a meal is 100% deductible. It would have to otherwise qualify as a 50% deduction. So during just those 2 years, it would have to qualify. Again, there's a recent notice that qualified 2021-25. Believe it or not, we have to define what a restaurant is. So we'll let you read it on the slide, on the materials there, what that is. There are some employer providing eating facilities that may not qualify, as is on that slide there. But again, just want to reiterate that it has to otherwise qualify for the 50% deduction in other years to qualify for the 100% deduction. For example, a 50% deduction, the expense is not lavish or extravagant in the circumstances, as it says on the slide there. That's the old Ken Johnson provision, as we call it at Eide Bailey, right? Ken's meals are generally non-deductible 100%, and they still will be, even if he buys them at a restaurant, because we're not meeting that qualification. So that's just an example of something that wouldn't be deductible regardless where you buy it. So I think, Bettina, we're about out of time here.
Yes, we are. I would say review the slides, especially the slides on meals and entertainment, because I know I get a lot of questions from clients on those, and they really kind of outline out what the rules are and what the pronouncements are. And if you have any questions, please reach out to your tax advisor. That's what we're here for.
Thank you.
Thank you, Paul and Bettina. We didn't have any questions. The only comment I'll make is that the whole reason, and you can correct me if I'm wrong, the whole purpose of doing some of these changing of deductions from one year to the next and accelerating income, deferring deduction, is really basically for every $1 million that you can move, the bank is going to receive a $55,000 potential $55,000 permanent benefit.
Right.
You know?
Yep.
And that's the whole purpose of doing it.
It's permanent until they shift tax rates again.
Right. Exactly. Then we go through the whole thing over again. Okay, so with that, we're going to have a 15-minute break. So our next section, we're going to have a presentation on internal controls over financial reporting, as a lot of the banks are growing to that $1 billion mark, and that's a new additional feature that they've got to document and go from there. So we have with us today, we have Erin Villafana, a partner out of our Laguna Hills office. Erin provides a public accounting services with a focus on financial institution industry. In addition, Erin spent more than 5 years actually working in a community bank, which kind of provides her a real world perspective of the audit process. She provides audit and advisory services to financial institution clients throughout California, ranging from de novo banks to publicly traded companies with assets in excess of $6 billion. She is knowledgeable in the SEC and other regulatory reporting, Fedexa and SOX 404 compliance. She is also active in internal staff training, mentoring, and college recruiting efforts. Andy Hendricks currently is a director with Financial Services Advisory Partners. That is a kind of I would call it a boutique firm that offers services to banks in helping them do the type of work that we cannot do from an independent standpoint. So he can actually help prepare financial statements, do 10Ks, 10Qs, and assist with ICFR reporting. He spent his career working with companies in the financial industry. Andy also spent more than 16 years with Crow, where he was an audit partner in the firm's financial services group. After starting his career with Crow in the Midwest, he actually relocated to Orange County and now currently is in Laguna Hills. After starting his career with Crow in the Midwest, he worked primarily on financial services companies, including banks, auto finance companies, and mortgage companies, credit unions, and broker dealers. He's also assisted clients and audit teams with various technical accounting matters, including in the CECL model, allowance for loan losses, stock-based compensation, leases, derivatives, and hedging. His clients have ranged from $500 million to $20 billion. He has a Bachelor of Arts in accounting from Bethel College in Indiana, and he's licensed CPA here in the state of California. At this time, I'm going to turn it over to Erin and Andy.
So during our presentation, we're going to provide a brief introduction to Fiducia Part 363 rules, and then we're going to go over internal controls over financial reporting. We really wanted to focus a little bit on that ramp up to $1 billion asset size and sort of the challenges that institutions face as they're getting ready to implement ICFR in their institutions. And we're gonna, between Andy and I, we're gonna talk a little bit about some of the best practices that we've seen out there. And then we'll also hopefully briefly touch on SOX 404 compliance for those institutions that are public filers or thinking about going public, and maybe some of the differences that we see with regard to Fiducia versus SOX. So that's the objectives for today. Fiducia stands for the Federal Deposit Insurance Corporation Improvement Act of 1991, and FDIC Part 363 implements that FDI Act. There's two important thresholds that we all need to be aware of with regard to Fiducia. First, we have the 500 million asset size threshold, and then second, we have $1 billion asset size threshold. So once an institution reaches that 500 million asset threshold, there are various requirements that kick in, one being the requirement of audited financial statements. There's also stricter audit independence rules. So we follow SEC independence guidelines. After 500 million, there's also changes in the audit committee composition where you now have to have independent members on the audit committee. And management begins to provide an assessment of their internal controls over financial reporting. At that $1 billion threshold, which is what we're focusing on today, the biggest change is that you will now be required to have an external integrated audit of internal controls over financial reporting, which falls under the audit standard SAS 130. Oopsies. So just briefly, wanted to go over the filing deadlines for the Fiducia annual report. It's required to be filed within 120 days after the fiscal year end, unless you are a public company or a subsidiary of one, which there are some exceptions, meaning you have to file within 90 days of your fiscal year end. The current year Fiducia status. So back in October of 2020, the FDIC gave institutions a bit of a reprieve in their reporting requirements due to COVID. So we saw a lot of, bloated balance sheets and banks that were tripping these thresholds inadvertently due to COVID. So the reprieve was that it allowed institutions to use their December 31st, 2019 asset size to determine their 2021 filing requirements. Currently, I do not believe that I've seen anything indicating that the FDIC is going to be providing another reprieve for 2022. So just be aware if you are in these threshold categories that, at this point, I'm not sure that there's going to be an additional extension of this FDIC ruling. All right, now we're going to talk a little bit about internal controls. With regard to the management report that you have to file, it needs to include a paragraph where you identify the internal control framework that you used to evaluate your ICFR. You need to provide an assessment of your ICFR, and you need to conclude on whether you think your ICFR is effective. Be aware that if you have a material weakness, and we'll talk a little bit further along about what a material weakness is, you cannot say that your ICFR is effective. The assessment is as of the end of your fiscal year. And then once you reach that $1 billion mark, you're required to have that external integrated audit. The independent auditor will attest to the effectiveness of your internal controls. Again, if there is a material weakness in your ICFR, this does result in a modified opinion of a modified auditor's report. The independent auditor's responsibility is to express an opinion on the ICFR. So as I mentioned before, the auditor cannot issue a clean report if there's material weaknesses that exist. The current internal control framework used widely by entities and auditors is called the COSO framework. This framework is used for designing, implementing, and evaluating internal controls for organizations. If you haven't heard of COSO before, it stands for the Committee of Sponsoring Organizations, and it includes the AICPA, the IIA, the IMA, the FEI, and the AAA, all shown here. The goal of COSO was to create a framework for providing guidance on internal control, allowing organizations to establish controls throughout their organization. There's 5 principles to the COSO framework. There's the control environment, which, establishing controls across the environment ensures that standard practices are used throughout the organization. This includes a set of standards, processes, and practices. Then you have the risk assessment. All organizations have risk, and you should perform appropriate risk assessment procedures. Control activities are those activities that are taken to help mitigate risk at all levels of the organization. Information and communication include both internal and external communication, and monitoring activities include monitoring of internal control systems to ensure that the controls are operating. This cube diagram, if you haven't seen it before, this is a really good visual representation of the framework, which includes the objectives at the top relating to operations, reporting, and compliance. The side of the cube depicts that objectives may be set for the entity as a whole, like targeted to specific divisions or operating units or specific functions within the entity. And then on the face of the cube are those 5 components that I just mentioned in the previous slide. The core definition by COSO of what internal controls are is that it's a process affected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives, and that includes operations, financial reporting, and compliance. What do good internal controls look like? So controls should be properly designed to mitigate those risks, those financial statement risks and fraud risks. And good controls within an organization should cover all of those components that are in that COSO framework. The controls need to be properly implemented, and they need to be operating effectively. So when I teach this to our staff, it's one thing to design a control, it's another thing to make sure that control is actually implemented within your organization. And then it's another thing to make sure that that control is actually operating and doing what it was intended to do every time it occurs. And the last bullet point here is that the control needs to be documented and it needs to be auditable. So it means that there needs to be evidence of that control taking place. I'll give you an example. A very common control at a bank is in your loan department. We have someone who inputs a loan to your core system, and we have someone who calls it back or checks it back. We have segregation of duties there. The one thing we need to make sure is that if we're going to use this as a control in our ICFR testing, there has to be some sort of evidence to show us that there was someone who input and someone who checked it back, and that they were separate individuals. So there's various types of controls, and a good control environment is going to include a mix of all of these types of controls. So we have preventative, we have detective, and then we have what we call compensating or mitigating controls. Some examples of the preventative controls would be segregation of duties, having an approval process for a particular function, access controls to ensure you're restricting access to those individuals that require it, change controls, disaster recovery type controls, and any type of security controls can be considered preventive controls. Detective controls are sort of on the back end. So a good example would be reconciliations. They're there to detect any type of exceptions or issues. We've got surprise cash counts. That can be a detective control. review of access. So IT review of access is actually a very important control to have in place. Video surveillance can be considered a detective control. Review of error reports or exception reports, and any type of analytical review of financial data can be considered a detective control. And then mitigating or compensating controls are those that are there to assist with the preventative and detective controls. And they're really good to have because they add another layer of defense. So in the event that you have a failure of a control in the preventative or detective controls, it's always good to have a compensating and mitigating control there, just as an extra layer of defense to ensure that we have controls in place to hopefully keep us from having a significant deficiency or a material weakness. So some examples of those would be manager supervisor review, requiring a second signature on something, exception reports, some sort of independent detailed review, or maybe a random review of transactions can be considered mitigating. And then lastly, we have two different types of controls: entity level controls and account level controls. So entity controls are those that are far reaching across the entire organization, whereas account level controls are very specific to individual accounts. And the one thing I will also point out, the difference when we get into internal control testing, it's good to remember that internal control testing is a pass or fail test. There's no materiality, if you will, with regard to testing. So it really is a pass or fail. It's the controls are there and they're in place, or they're not and they're not working. So I'll pass it on to Andy here to continue on.
Great, thanks, Erin. Wanted to, I guess, point out here when we find that there's an issue with your internal controls, as Erin was just mentioning here, those are classified in one of three ways, or I should say to start, that's referred to as a deficiency. So when a control isn't designed effectively or isn't operating as it's designed, that's referred to as a deficiency. And then management and the auditors need to classify that deficiency in one of three ways. And so here are the definitions from the AICPA AU 265. A deficiency, as the slide notes, is a situation in which internal control over financial reporting doesn't allow management or employees to prevent or detect a misstatement in the normal course of their operating duties. As Erin referred to earlier, there's sort of the definition here refers to two different situations of the design deficiency and an operating deficiency. So a design deficiency is when just the control, like the name suggests, is just not a good design or it's designed badly. So even if the control is working as it's designed, that control won't serve to prevent or detect a misstatement. So an example of that is a file maintenance control, as an example, where the reviewer is simply just reviewing for reasonableness rather than vouching those changes back to supporting documentation. So even if that control is done daily and it's done just according to the wording of the control, it's not gonna pass muster because it's not designed properly to prevent a misstatement. An operating deficiency is sort of the other side of the coin there. So it's when you've got a good control, it's designed properly, but it's just not being performed at all, not being performed effectively. It's letting errors through, etc. On the opposite end of the spectrum of just a plain deficiency is a material weakness. And so again, like the definition implies here, like it's written, it's a deficiency or a combination of deficiencies such that there's a reasonable possibility that a material misstatement of the financial statements won't be prevented or detected on a timely basis. And as Erin indicated earlier, if there's a material weakness, the company's report on internal controls as well as the external auditor's report on internal controls of the financial reporting need to be modified to reference that material weakness, and they can't say that the controls are operating effectively. I think it's important to point out too in this definition that the definition refers to a reasonable possibility. So I think one mistake that gets made quite a bit when audit adjustment is identified and an error is noted through management's testing, it's easy to focus on the actual error and say, well, it's not a material weakness because the error wasn't material to the financial statements. But really the definition refers to a reasonable possibility. So the evaluation needs to focus on not just the actual error that was observed, but how big of an error could have made it through that control that failed, and at what point would have then that error been caught. And if that number is a material number, then that's a material weakness. The definition of a significant deficiency is sort of just in the middle of these two. So again, as the slide says, it's a deficiency, but it's not a material weakness, but still important enough to merit attention by those charged with governance. One other important thing to note here before we move on from deficiencies is that at the end of your evaluation, or really throughout your evaluation of internal controls, you also need to think about not just individual deficiencies noted, but the aggregation of those deficiencies, and do when all of the deficiencies taken together that you found result in something that's more significant with material weakness. So just as an example, if you're going through your testing in the lending area, let's say, and you found 5 deficiencies in that area, including one that's over the IT system, over the core system in the lending area. Even if those are individually, you've gone through your evaluation individually, those are all considered deficiencies. You still need to consider when taken as a whole, those might be aggregated to a material weakness because they impact the same risk, or because when you consider them, like I say, consider them together, they wouldn't serve to prevent a material misstatement. I don't know if I have the slide. Oh, there we go. Okay. Next, we're going to talk about some considerations here for institutions that are ramping up towards $1 billion, and talk about implementing fiduciary here for the first time. And remember, as Erin pointed out, the fiduciary requirements are effective the year following the 12/31 date at which the bank passes the $1 billion threshold. So the first item here on the slide, planning and risk assessment process. Planning is really key to the effective fiduciary documentation. Determining the resources that are going to be needed is a big step, or a big starting point in this process. This is typically beyond the resources that a bank that's approaching $1 billion probably is already staffed up to handle. It may also be beyond the scope. Oh, it's hard to hear me clearly. Let me try to move a little bit closer here. Apologies. You would think after 18 months of Zoom calls, I'd have this sorted out, but here we are. Hopefully that's better. I'll try to speak a little more loudly as well. You also may need to consider if your typical internal audit that you may have implemented after you've crossed the 500 million threshold, that may be more operationally based and not good. I'm getting feedback that it's better. Great. Maybe more operational and maybe less fiduciary focused. So you may need to tweak the internal audit services. If you're outsourcing those services, you may need to tweak that as well to be more fiduciary compliant. This may require hiring additional folks internally, additional FTEs. You may outsource some of this to a third-party firm. You can't have your external audit firm, perform these services. So as Erin indicated earlier, the SEC independence rules apply here. So you can't outsource this work to your external audit firm, and you can't rely on the work that they do for their attestation services on your internal controls to be a part of your opinion or documentation as well. Documentation of this risk assessment strategy at the outset is really important. You want to document what you consider to be material to your financial statements, or what a user of your financial statements would consider to be material. That's going to drive not only what you test, which accounts may be scoped in or out, it's also going to be important when you go to evaluate deficiencies as well, and the significance of those deficiencies. You also, I think, want to make sure that you discuss this plan internally across leaders, of various groups throughout the bank. This is not just an accounting responsibility or something that's only going to impact your accounting department. This is really going to be impactful to many different groups inside the institutions: lending, deposit ops, IT, etc. A lot of these folks may not be that familiar either with the fiduciary requirements, or familiar with dealing with your auditors, etc. So it's good to bring those groups on board early in the process, explain to them what the fiduciary requirements are and how you plan to address it, so they're ready and able to assist when the time comes. The next phase after planning is the documentation of the processes and the controls. So this is where you go through your organization. You've documented which of your accounts are considered to be key accounts, which of the risks impact those accounts, and then you start to document the controls that you've got in place to address those risks. This can be done, as the slide notes, in a variety of ways. You could do narratives based on interviews with the process owners and the control owners, where you're writing out the processes that as they're being performed. They can be done via flowcharts, where you're documenting in a flowchart each of the significant steps and then where the controls are in that process to be able to prevent or detect misstatements. Risk control matrices, where you're documenting the risks for each area and each risk, and then documenting the controls in place to address those, or some combination of the three, depending on the department or the complexity of the control. You also want to make sure as you're going through this process that this isn't a sort of point in time evaluation. You want to keep these documents refreshed, either through quarterly certifications or annual updates, or et cetera, just to make sure you're capturing any potential changes to the control due to personnel changes or new business lines, et cetera. The next phase then is the testing of those controls. And so you want to make sure, during the planning phase, you're documenting how you intend to test those, your sample size, the timing, if you're going to test them throughout the year. Remember, this is an as-of evaluation, so both your report and your auditor's report will say that your controls are effective or not effective as of, if you're a fiscal year end, December 31st. But that doesn't mean that you can just test every control in the bank as of December 31st, and assuming they're all good, give yourself a clean bill of health. The testing really should be throughout the year, and especially through year end as well. Again, documenting or deciding in this step, part of that process is whether you're going to do the testing internally, whether you're going to do the testing or hire someone to do the testing. If you're planning to do the testing internally, remember that it can't be tested by somebody with control responsibility, though. That would kind of defeat the purpose if they're testing their own work. I'll probably mention this 3 or 4 more times throughout the rest of the presentation, but I think in this step, it's important, really in steps 2 and 3, to coordinate this with your external audit firm so that they can weigh in on your process of which controls you've considered key and how you plan to test those controls. Again, they need to be independent of this process, but there's many ways that they can be involved in the process without abutting those independence rules. Even things as simple as just scheduling walkthroughs at the same time as your external audit firm. So when you're sitting down, with the personnel, you're not interrupting them, twice to basically ask the same questions. You can get it out of the way once. There may be situations in which the external audit firm can rely on the walkthroughs you've done, or certainly at least read them prior to doing their own walkthroughs, so they have an understanding of how the process works. It can be more efficient. There might be scenarios in which they can rely on the testing that you've done, et cetera. So again, I'll probably mention this a couple more times, but I think coordination with the external audit firm as you're going through this process is really key. And then finally, the 4th step is evaluation of deficiencies, and it's 4th on the slide, but really this ought to be kind of an ongoing process as well. As you're going through the documentation of the controls and the testing of those controls, you ought to have a running list of what those deficiencies are that you've identified, what the plan is to remediate them or make changes to the existing controls so that you can remediate those key controls. Again, I'll probably talk about this a few more times as well, but another benefit of starting this process early is you give yourself plenty of time to identify any of those issues and then respond to them as well. All right, next we're going to talk about some best practices for entities going through this process for the first time, what they've learned, and some common pitfalls as well. Like I just kind of alluded to, I think the biggest recommendation I can make is starting early. 12 to 24 months early, it probably isn't too early. That really gives you, I guess, it's a big change. This is a big change for the organization, again, particularly for groups that haven't necessarily been subject to audit like this before. And so it takes some time to acclimate to these new requirements. If you start 12 to 24 months early, that really gives you time to self-identify any issues that you may have, any deficiencies, and then give you time to correct those as well without those corrections being sort of live or on the clock, meaning that your external auditors have identified them. If you're able to identify them a year before they're required to attest to your internal controls, that gives you plenty of time to make the necessary changes. It also just gives you a chance to go through the cycle of the previous slide that we just talked about there, sort of the planning, documentation, testing, et cetera, and then just make adjustments. So if it worked well, you can keep going, if you need to reallocate resources, internal, external, bring on more people, or maybe say, you know, we outsource in year 1 and bring it back in-house year 2. It gives you plenty of time to kind of think through how that's going to work going forward. As I kind of alluded to a second ago, I think one of the biggest decisions to make is how you're going to manage this whole process internally, separate from the auditor's evaluation about how management's going to document and test its own controls so that it can do its certification. Are you going to hire additional folks? Are you going to hire a third-party firm to do the documentation or the testing or some combination of that? Either way, it's a big time commitment. So, you know, again, getting that process started early on is key. Again, you know, coordination with between internal audit and external audit is going to be key. Again, the external auditors, Eide Bailly, needs to be independent. They certainly can't design your program. You can't rely on their testing, but you know, external audit firms also aren't prohibited from, you know, commenting certainly on drafts, you know, giving you feedback, things of that nature, sample sizes, timing, etc. And John, I don't want to put words here in Erin's mouth, so she can feel free to jump in here and correct me if I'm wrong. But I think firms like Eide Bailly and other firms are generally very open to this and would rather have you, you know, communicate with them and let them know. Again, especially if you start early, so they're not, you know, they're not in the year of the audit for the first time. It's the year before. Probably a little bit easier to provide feedback and things like that. Erin, before I move on, you want to chime in on any of that?
Yeah, I would just echo what Andy has mentioned. I mean, this is a huge change for your organization when you get to that $1 billion mark, and it's never too early to start. I think that, you know, what catches organizations by surprise is the amount of the burden that it places upon your existing personnel, and let's just throw it out there, the cost. This is a significant costly venture for an organization to comply. So, I mean, don't be caught by surprise. But going through these steps, these best practices, you know, start early, the 12 to 24 months, you know, again, what Andy mentioned, get your external auditors involved. You know, when I work with my clients, especially those ones that are getting ready to implement Fiducia, I am always happy to go through and review the controls, and we go through, you know, walkthroughs together to make sure we can, that we're comfortable with the identification of the controls, making sure there's no gaps. If there's gaps, let's identify them and let's get controls put in place. Sometimes the processes need to change a little bit so that we implement those controls. But again, if you start early, prior to going live, we can catch those gaps or help with the design, you know, make sure that the controls are designed and doing what they are meant to do. And again, like Andy mentioned, controls are fluid, they're ever changing. They need to be evaluated regularly to make sure that what's documented is actually what's occurring within your organization. You know, too often I see where, you know, I think organizations think that we've documented controls once and they're good to go, but then we get in the following year to try to test, and then all of a sudden, oh, well, that control isn't in place anymore because we, you know, implemented a new one or a more efficient one, or we changed it to a system control. The system does that for us now. So it is really important to make sure that you understand that even if once you implement Fiducia, once you implement internal controls, you have to continue to evaluate it regularly, do those walkthroughs. And then again, the other one that I wanted to point out was, you know, how is this Fiducia, you know, implementation going to look within your organization? Like what's mentioned here on the slide, there's so many different ways that you can structure Fiducia within your institution. One being you can bring the entire process in-house and hire FTEs to assist you in-house with, you know, identifying controls, testing controls, and all of that. We have several institutions that are what I would consider co-sourced, where they've hired pieces of their Fiducia or ICFR testing to be done by an external firm, and then some of it is also done in-house. And then, you know, it's perfectly acceptable to completely outsource it to an external firm to assist you with this as well. So those are the types of decisions that need to be made prior to going live, as we call it, with Fedexa. You know, how is this going to look within your organization? That's it, Andy.
Thanks, Erin. There we go. You know, next we thought it'd be helpful to cover some common shortfalls or things that need to be, I think, most commonly addressed or shored up for institutions that we've worked with that are hitting this threshold and applying the ICFR requirements for the first time. I'd say the biggest one is the first one on this list: insufficient documentation or review controls or precision. And I think what we find a lot of times are that these reviews are happening, particularly over significant estimates or complex areas, but it's hard to document. So remember, somebody needs to come back behind the operation of all the controls and be able to objectively tell whether that control operated and at what level that it operated. So I'll give you, I think, one of the more common examples that I see is where you've got a control that says the CFO reviews the allowance, or something to that nature, right? And maybe the CFO spends 6 or 8 hours, reviewing the allowance every quarter end and does a pretty thorough review. But the evidence is just an email that says, okay, I'm good. Go ahead and book the entries. That's not going to probably cut it for Fedexa, because it's hard for somebody to come behind, just look at that email and say, well, what really was the control here? How did the control operate? That doesn't mean that the CFO or the reviewer needs to print that thing out and check every number and write a 10-paragraph memo about what they did each quarter, but it's got to be some kind of evidence of what was reviewed and how it was reviewed and at what level it was reviewed. And again, this is really difficult in the most complex and most significant estimates. Like it's difficult to document how a thought process occurred, right? It's a little easier when it's just checking, do these two documents agree to each other? I think that's pretty straightforward, but it's much more complex to document the thought process or judgments. Some examples we've seen are, if like for the allowance as an example, if you've got an allowance committee that evaluates the allowance, or you meet to discuss the allowance, just keeping minutes of those meetings so you can understand, an auditor can understand what was actually discussed, at what level it was discussed, what was the evaluation that you went through. Sometimes the CFO will type up a paragraph and say, hey, at the quarter end, this is what I evaluated, these were the decisions I made, I saw this judgment for a qualitative factor, here's how I thought about that, etc. Or any detailed notes kept during the review of back and forth between the reviewer and the preparer, handwritten notes on a document, things like that. Again, something though to evidence and make it clear how the control operated and how it served to prevent or detect a potential misstatement. One other thing I'll mention about precision is sometimes clients want to, or institutions will want to have a compensating control that says, well, yeah, this control failed, but we've got another control where the board reviews the monthly financial results every month during their meeting, or quarterly or something. That's really a difficult control to rely on and document, because typically the evidence or the precision of that review isn't clear, and so it's hard to really tell at what level the board members had reviewed the financial statements, how they knew that information was accurate, and how they executed and like I say, how they went through that evaluation. So that's likely, it's a common example or a common thought process, but probably going to be hard to document at a level that's precise enough. Along those same lines is the lack of evidence of the operation of the control. So again, is the approval, has it in the past historically been verbal or through discussions, or more informal? Sometimes the documentation is not retained, or it's not retained for a long enough period of time, a month or two. Keep in mind, sometimes this testing will occur 6 months, 8 months after the controls actually operated. So if you're testing a sample from February, but you're testing it in October, November, that's not terribly uncommon. So you may need to think about how long you're retaining some of that support. And then just again, the evidence of how the control works. So is the documentation just a sign off on a front page of a reconciliation, or is a memo, or is there more detail on what was reviewed? Certainly as the level of complexity grows or the level of judgment required is increased, I think you probably want to make sure that your documentation is more robust in that area. Another really common deficiency or area that needs to be shored up in a first or second year Fedexa process is segregation of duties issues. And typically, I think this is just because at an institution that's 800, 900 million, $1 billion, for the first time, just doesn't have the staffing of the various levels of staffing, rather, to have super robust system of checks and balances. And so we'll find areas where, like, a reviewer can make changes, for example. So, like, back to my file maintenance change example, if the reviewer of the file maintenance change report also has access to make changes, that's probably not going to pass muster and probably be considered a design deficiency. Typically, it doesn't matter if the person, like in this example, does actually make changes. Your auditors and your internal auditors are going to more be looking for whether they have access to make those changes. So a lot of times too, we'll find, frankly, that just the person that knew, or the person that's actually doing that has that segregation of duties may not even know that they have that responsibility or have the access, I should say. So and again, another reason to kind of go through that process early to flesh out some of those issues. This happens a lot in IT systems, like I mentioned, as an example, a loan department manager has administrative access to the core system because they're the ones that approve, new hires, terminations, et cetera. So they know who in the department needs the different responsibilities within the core. And that's probably right that they should be involved. But to the extent that they also have, conflicting review responsibilities, approvals, setups, et cetera, that's probably not a good situation. Kind of continuing along that IT example, I think another area that we see needs to be shored up a lot in year 1 or year 2 are just general IT controls. You've probably already got controls over making sure that for your key systems that you've got that you're getting the SOC reports from the service auditors on those systems and making sure that there are no deficiencies in the way that the system's designed and that you're responding to the end user control considerations. System reports is probably another issue. If it's a canned report from the system that you can't change or modify anyway, probably generally okay to rely on those. But to the extent you've got reports that are produced manually or customizable, or you've got a bolt-on report writer system, you may need to think about how you're documenting that in a control environment to make sure that that report is complete and accurate and you can rely on it. I think, like I say, we probably keep banging the same drum, but I don't think it can be overstated here that coordination early in the process with your external audit firm is important. Make sure you've got the right coverage in place, that they don't think there are areas that maybe you need to shore up or add. Maybe you've concluded that aren't material, but they think they are, or that the wording of some of your controls maybe need to be enhanced. All things like that are great things to discuss early on in the process. And again, maybe Erin, I'll throw it over to you again here to see if you have anything to add on the shortfall side as well.
Yeah, one that I just thought of as we were covering this is, we talk a little bit about insufficient coverage of controls over material accounts or material risks. One of the ideas that you need to think about is if you have any types of unusual transactions that affect your organization. Let's take, for example, an acquisition. So if you have an acquisition which is considered a significant unusual transaction for your organization, that too would be needed to be included in scope for Fedexa internal control testing purposes. So anytime you have something that's sort of a significant or unusual transaction, that would also require some level of controls in place that would mitigate risks of potential misstatement. So always kind of be on the lookout. Again, that's what we're talking about with controls being fluid and changing. And sometimes items fall in scope versus out of scope. And then, again, Andy kind of mentioned it, IT systems, that is really becoming more and more relevant with regard to internal controls. As our systems get more complex, they also get smarter and more efficient. There are opportunities for you to place reliance on system controls. Some systems actually have controls in place, and the nice thing about system controls, if you can find one, is can if it's operating effectively, it operates without human error. So system controls can actually be somewhat more accurate than human error. So system controls can actually be a really good addition to your control environment. So it's always good to be on the lookout for whether we can implement any of those in your organization.
Yeah, great. Thanks, Erin. Okay, moving on then, we thought we'd talk a little bit here and discuss the differences between Fedexa requirements and SOX compliance, and how those are similar, but how they're different as well. The rules are definitely similar, but the application can be different. So we thought we'd talk about that as well. I think if you were to ask a newly public company or a new company, I should say, that's applying SOX for the first time, probably the biggest difference they tell you about is more testing. So increased, more controls probably right off the bat than you're probably used to have, more accounts that are in scope that used to be maybe out of scope, probably a lower materiality than you had under just Fedexa, probably more testing closer to year end and just more testing in general, higher sample sizes, et cetera. So I think that's probably one of the biggest key areas, just because the scrutiny gets dialed up a little bit higher than it would under maybe just only Fedexa. The next biggest one is the precision of controls. And this is definitely a real hot button area for the PCAOB and by extension, audit firms of public companies as well. So the way I think about precision of control is just always asking the question in my mind, how do you know? How do you know? And just keep hearing that question over and over again. How do you know that you can rely on a report? How do you know what the control, operator actually did? How do you know at what level they actually did that? And how do you know the support was accurate, et cetera? I mean, that question really just drives in my mind the precision of when you're documenting that. The precision, how do you know? Not just in the narratives, but how the company documents its controls as well, especially over significant key estimates like the allowance for loan losses, CECL, fair values, et cetera. Any of those kind of key judgment areas, as you're thinking through how the control is documented and how the control operates within your organization, really think about how do we know that control is truly effective, and how are we documenting that? Data completeness and accuracy is right up there with precision, I would say, in terms of the level of focus at this point. So again, kind of how do you know that the data that the system is producing is complete? Probably easier if it's a CAN system report, like I mentioned earlier, but if it's a manually produced report or a report writer, probably needs to be a separate control. Again, if that's a significant key area for you, a key estimate, et cetera. This gets doubly difficult, I think, when you have a situation in which you don't have reliance on a system, especially if it's a key system for whatever reason. If there's an error, an issue with the SOC 1, or if it's a system that everybody has access to, or there's a segregation of duties issue, et cetera, this gets much more complex in terms of documenting the accuracy of the data within that system, or the computations or the information that the system produces. Kind of on that same note, just more focus on IT controls in general, I would say, under SOX rather than Fedexa. So more focus on the access, who has access to these systems, and what can they do with that level of access? Can they change the programming of the system, or change what the system does or the reports that it produces? You're likely going to scope in other IT systems in a SOX environment, because potentially you have a lower materiality, some more areas are scoped in. Under Fedexa, you may be able to test around a system, whereas in SOX, you may scope that in. And so, and again, it's looking at what a person, in terms of access, looking at what a person does have access to do in a system, not necessarily just what they do. Moving on to emerging growth companies, we wanted to talk a little bit about an EGC, what the rules are, how that applies. So an emerging growth company, or an EGC, as the slide points out, is a newly public company with annual revenues of less than 1.07 billion during its first fiscal year end, and so, as a public company. So if you apply as an EGC, you get that exemption for the first 5 years after your IPO, and then you don't have to have the external audit attestation part of SOX. So your external audit firm isn't required then to have that included in your 10K, where they report on your internal controls. But I think there are a couple important caveats here to notice. the fiduciary requirements still apply. That's not changed. So if you're a bank that's over $1 billion, even if you're an EGC, you're still required to have the fiduciary audit. Those rules still apply for you. You're not exempted from that under the EGC rules. You're also still required to do the management certification in your Qs and Ks. So you still need to have your evaluation. Again, you're going to have it likely under fiduciary as well, but even if not, you're still required to have that certification. And I think most importantly here, your external auditors are still subject to the PCAOB audit standards. And those standards require, even in a financial statement audit, that you obtain an understanding of internal controls, which would include likely a lot of the same documentation of narratives or flowcharts, et cetera, of the controls you've got in place. That requirement is still there. And so they also, in addition to that, may likely test a lot of those controls as well for the purposes of those financial statement audit. And so it'll be similar, very similar to SOX, I guess, particularly for those controls that they plan to test. And then finally, they can't ignore, and again, Erin, I'll let you chime in on this if you think I'm taking this a step too far, but they won't be able to ignore anything in the fiduciary audit as well. So if they find an exception in your fiduciary audit testing, we really can't ignore that for your financial statement audit as well. And Erin, maybe I'll just pause there and let you, as an external auditor, let you weigh in on that.
Yeah, and actually we have a question in the chat, very similar, talking about EGCs. So the question is, what do you believe the merit is for a bank to file under emerging growth company status to defer SOX compliance? And to answer that question, I would say, under the EGC status, what it does is it allows your institution time to ramp up from Fiducia to SOX 404B filing. Again, what we mentioned on the previous slide, there is, we talked a little bit earlier about ramping up from, to $1 billion in asset size and implementing Fiducia. And then there's also a ramp up to SOX 404 compliance. Again, that previous slide had, increased testing, the sample sizes increase, so both on management's end and on the external audit side. So definitely increased testing of controls, typically an increase in the number of controls that would need to be required under SOX. So a little bit of a burden there with regard to ramping up from Fiducia to SOX compliance. In addition, like Andy mentioned, we've got precision. That is sort of it's a hot topic with the PCAOB right now. So we definitely want to make sure that the documentation also is beefed up a little bit as you go from Fiducia to SOX to ensure that those controls that are in place are precise enough, as well as our documentation is documenting that precision, as well as more scrutiny over the IT systems. Again, like Andy mentioned, more in-scope items under SOX than potentially Fiducia. So I guess my answer to that question is that, again, that ramp up to SOX can be a little bit of a burden, and the EGC status does allow you time, that 5 years, to sort of ramp up slowly, so that you can get your processes in place, your documentation enhanced, and make sure that if you have additional FTEs that are warranted in your institution to assist you with SOX compliance, you can get that all in place. And I would mention kind of the issue, and Andy and I talked about this before, is if you are an EGC, so you're not yet you don't need to be in compliance with SOX 404B yet, but you are Fiducia compliant, there is a level of expectation that your documentation will be somewhat more robust, even just for a Fiducia filer if you are a public company. So again, when we're, as your external auditors, we're performing an integrated audit. An integrated audit means that we are placing some reliance on that internal control testing to satisfy our audit procedures for the financial statement audit. So, there is some level of expectation that the control environment for a public company will be somewhat more robust than a non-public company. I think we had one other question, Andy, that came through. Any best practices you can share on management documenting completeness and accuracy of key reports used in the operation of controls?
Maybe I'll take a stab at that, Erin, and then let you have a crack at it too. I guess I would say, I mean, as I alluded to, I think if it's a canned system report, meaning that like you're probably a lot of your core system reports where the report is produced by the system, you can't edit it. Those are pretty easy. A lot of times they're listed in the SAC report or in the operating guide for the system itself. And so it's pretty easy to say that you can put reliance on those. I think where it gets more complicated is a report writer or even a manually prepared or assembled report. I think the way I've seen that overcome, again, particularly for the more key, I'm thinking like loan grades, watch lists, things like that, that may be manual, quote unquote, reports or lists, is just having a separate control whereby you have someone that takes that manually prepared list, someone separate from the preparer, and then compares it to the information that's stored in either in the system or in the other system of record, I guess, if it's not, if it's an Excel or something that's subject to another control. So you're kind of bridging the gap between what would exist just through a canned system report. Usually, you're implementing a second control or a third control to say, we need to have a specific control over just making sure that this report is accurate. And usually that's fairly quick for the most part, depending on the control, but it is probably an additional step. I don't know, Erin, if you want to add to that or.
Yeah, I would just add, yeah, like Andy mentioned, system reports are obviously, if they're canned, that they're coming right out of your system. There's, the ability for us to rely on that SOC 1 report in most cases that indicate that, your service provider is acknowledging the completeness and accuracy of that report. Where it gets more difficult is when we start getting into query type reports that are running out of the system and whether or not those queries are complete and accurate. And I would say, at that point, you need to start focusing on the parameters of those reports. So making sure we understand how that report was run with regard to the query. And like Andy mentioned, sometimes it involves adding an additional control so that we can test that completeness and accuracy. I would also say, I've seen many times where I would say the segregation of duties of the person that's querying the data then becomes segregated. So, it's the person who wants the data, whatever it may be, if it's loan grades, like Andy mentioned, keeping it sort of segregated so that it's the same person doing the query. So again, there's all different methods to documenting completeness and accuracy, but as we get into the world of queries, because I do know that systems are becoming a little bit more like data warehouses where they're just holding data, and then you as the organization have the ability to manipulate that data. This is becoming an ever-changing and more evolving complex piece to the control environment.
It looks like there's one other question that says, what's the cost to comply in the first year after crossing over 500 million and $1 billion? You want to take a crack at that one?
That really ranges, I would say, because it really depends on what we kind of talked about earlier on how that structure is going to look within your institution. So, if you're going to hire staffing with in-house, obviously the cost of that staff and their time is going to be an upfront cost. If you're going to outsource to a different audit firm, I can't estimate that, but I will just say that it is a fairly costly venture, but spreading it out, over that period of time, like we mentioned, when you're ramping up, will help with that. And then obviously from an external audit standpoint, because there's additional procedures we have to perform as an external auditor, the external audit fee will also increase.
It's hard to say, but definitely more. probably ranges, as Erin said, in terms of how you choose to apply it. I think that's it for questions. So I guess Ken, turn it back to you.
Thank you, Andy. Thank you, Andy and Erin, for that. And I guess we got another polling question that just popped up, so you can answer that. And then at this point in time, it's going to be time for lunch. Okay, thank you, Amy. Our next session is going to be on blockchain, crypto assets, and the evolution of banking. Ron Q, I'm not going to try to pronounce your last name, Ron, because I know I'll do it wrong. Possesses almost 3 decades of experience in global financial services and technology industries. He currently serves as the chairman and chief executive officer of the Wall Street Blockchain Alliance, the world's leading nonprofit trade association promoting the comprehensive adoption of blockchain technology and crypto assets across global financial markets. Prior to this, Ron served as the CEO of Derivatrust Technologies, a pioneering software and technology firm for financial market participants. Ron is the editor and contributing author of the book Blockchain in Financial Markets and Beyond, Challenges and Applications, published by Risk Books, as well as contributor to the Blockchain Cryptocurrency Regulation of 2019, published by Global Legal Insights. In addition, he was recently named the top 100 most influential people in accounting list by Accounting Today in 2018. He is a frequent guest of major media outlets, including Bloomberg Radio, and is a sought-after speaker and writer regarding the financial technology and innovation. Ron also serves as an advisor to multiple startups and corporations focused on fintech innovation and blockchain technology. Thank you for joining us, Ron.
Ken, thanks so much for the kind introduction, and thanks for just saying Ron Q. That always works for me. As I've often joked with Cheryl and Gary, I think I was about 8 years old before I can pronounce my own last name as well. Thank you all for being here. Really appreciate the opportunity. Thanks to the entire team at Eide Bailly, who we're privileged to have as members of the Wall Street Blockchain Alliance. And I'm really looking forward to this conversation about blockchain and crypto assets and the evolution of banking and the evolution of markets very broadly. And I believe we're reserving some time at the end for questions. And certainly anyone on the call, please feel free to reach out to me afterwards. Happy to answer questions you might have as well. So a little bit about the mission of the Wall Street Blockchain Alliance. As Ken mentioned, we're a not-for-profit trade association really focused with a mission on guiding and promoting what we're calling the comprehensive adoption of both blockchain technology and crypto assets across global markets. And despite our name, it certainly started with Wall Street, but we have banks and financial services firms, law firms, accounting practices, digital media firms. And our take is that really blockchain and crypto assets and other things that I'll talk about later in this presentation, like DeFi and NFTs, really are evolving how we engage with each other, how we bank, how we share value across different industries as well. So I've got several objectives, pardon me, for this particular presentation. Really, I want to set the baseline, start with the definition and history of blockchain. It may seem familiar to many of you. I believe many of you might have heard my original presentation. It feels like 100 years ago. It was 2018, I believe. Talk about the origins and the uses and the benefits. And I'll try to give a little bit of perspective on how those conversations have evolved in the past several years. I've been involved in the crypto asset and blockchain world since about early 2013, which seems an entire lifetime ago. And the conversation really has evolved significantly. I'll talk about the blockchain in the global marketplace. And it's funny, I just caught myself saying the blockchain. There are many. There are many technological implementations of blockchain and different types. I'll talk a little bit about that. This certainly isn't meant to be a deep technical conversation. I'm not a deep technologist. I've just managed enough technology teams to ask really dumb questions over the years, but really understanding the types of technology, who's offering this technology. I think you'll be surprised at some of the participants in the game. And I want to talk a little bit about use cases and trends. You'll see the slide a bit later on. There are many use cases listed. I won't get into all of them, but I certainly want to speak to several of them. And I think the proliferation of these use cases really begins to show how blockchain and crypto assets are evolving global markets. I have an entire slide on crypto assets themselves, and you'll see I will spend a bit of time talking about where the value is, why it's moving the way it's moving, what the value was when we first met to talk about some of this stuff, and why I think that again, that word evolution is important. I'm going to talk about blockchain, and clearly, given the audience, blockchain in the banking industry. There are no conversations that we have with banks, large and small, that don't in some way involve understanding the evolution of the marketplace, understanding the tools and capabilities, both in the back end and the front end, related to the banking industry and blockchain. And I think hopefully I'll offer an interesting perspective on customer perspectives on blockchain and crypto assets that would be valuable to you as well. For those of you who haven't seen some of these words or acronyms, CBDCs, central bank digital currencies, DeFi, decentralized finance, and stablecoins, they're all over the place. They've really exploded in view, certainly in the past 18 months or so. I still have colleagues across different industries who don't understand what they are. It's even for me, and this is my full-time job, just keeping up on the evolution and the changes, the dynamic shifts in those spaces is difficult. But I'll talk about what they are, why it's important to focus on them as well. I'll talk about the regulatory landscape also. Certainly from the perspective of banking, none of you on this call, I suspect, are strangers to regulatory conversations. We have the privilege, I guess privilege is the word, of having conversations with OCC, the SEC, and the CFTC. The regulatory conversation around blockchain and crypto assets is accelerating rapidly. And I think it's important to understand where we stand with regulators, particularly in light of a new administration that's maybe not particularly friendly to things like crypto assets, and why it's important to understand where that's going over time. And then finally, I'll talk about how to adapt, what it means for your business at a holistic level, the things that we're talking to our members about and our colleagues and partners about regarding how to strategize about this, how to look at the next 2, 5, 10, and 20 years and understand what our businesses will be in that time frame because of these innovations, because of blockchain and crypto assets and other technological capabilities that that blockchain brings to bear. So let's start with our definitions. Blockchain, and many of you have probably seen these words that I've used before. Blockchain is a public ledger, a distributed secure database that records transactions. The computer science colleagues of mine, they always kind of get a little upset when they see me use the word secured database. At a very technical level, it's technically a transactional timestamp register, one of my computer science colleagues told me. For our purposes and for the purposes of the Wall Street Blockchain Alliance and the banking industry, it's a secured database that records transactions. And it leverages cryptography and peer-to-peer technology to group data into blocks and to store them in what we're calling an immutable chain of transactions. Immutable meaning uneditable, can't be changed. And there are challenges with understanding why that's important. But it's important to realize the benefit that immutable technology allows, an immutable chain of transactions. One of the hallmarks of blockchain is that for the most part, it accomplishes this without any trusted central authority. And we don't even begin to touch on the origin story around the Bitcoin blockchain, which was designed to be fully decentralized. But every time I talk about doing something without a trusted central authority, it's almost a weird statement because so many of our colleagues, so many of the business and work that we do, so many of our careers have been based on trusted central authorities. And the conversation we're now having is, how is that changing over time? And what does that mean for our businesses, our roles, and what we deliver to customers and colleagues in industry? Maintenance of blockchain is performed by a network of nodes, and consider that phrase network of nodes. It's important because over time, you'll all be answering questions about who's in our network of nodes in a blockchain. Is it regulators? Those are conversations that are happening now. Is it partners? Is it data providers? The network of nodes will define the ecosystem we're all participating in. Information then is uploaded to the blockchain that's validated and approved by all the nodes prior to what we're calling final approval and addition to the blockchain. And please do understand, this is a vast oversimplification of the deep technology work that happens behind the scenes. And I'm happy to take that conversation offline with anyone who's interested. We could do hours of talking about what that validation process looks like. I think for the purposes of this meeting, it's important to realize that for the most part, particularly on a public blockchain, once it's written to the blockchain, it's confirmed as accurate. And you'll see a bit why later on in the conversation. Keep in mind that additions are broadcast to the network in real time. And what that ultimately means is that every node, as you'll see in this graphic, has a complete identical copy of the data. For a long time, I've been in Wall Street, as Ken kindly mentioned, over 30 years, and I can't believe it's been over 30 years. I remember the conversations around what's the golden copy of the data. Blockchain gives us a new perspective on what a golden copy of data is. We all share the same data set. And this is an interesting graphic It goes back a couple of years, presented by the Federal Reserve Bank of Chicago. And the description of consensus is interesting, where each node communicates with the others to ensure quote unquote consensus after addition to the ledger. We all know consensus as the descriptor for what's occurring. We all agree, we all reach consensus. I think it is important to understand that in the context of blockchain technology, consensus or consensus methodology is a very technical thing. There are different consensus methodologies, things like proof of work associated with the Bitcoin blockchain, proof of stake, pure proof of stake, all that tie into how secure and how powerful the blockchains you will be participating in are. And again, happy to have the conversations on what consensus is. There are plenty of resources on at a product level, understanding what consensus means for your bank, what consensus means for your organization. I wanted to stop for a moment and talk about two of the things I mentioned earlier, cryptography and peer-to-peer networks. It's interesting when you look at the innovation that blockchain represents, it was really a combination of two pretty old technologies, all things considered. The Satoshi Nakamoto white paper, whoever he, she, or they are, that created the original Bitcoin blockchain. Cryptography goes back a very long time in human history, the allowing for secure communication, leveraging things like codes, for example, which provides data confidentiality, data integrity, authentication of the data, and something called non-repudiation, no givebacks or takebacks. But cryptography combined with peer-to-peer technology, the ability to work with a network of, again, that word, interconnected nodes that share the resources amongst each other. Nodes in the blockchain share the burden of confirming information that's submitted to the blockchain. And given some of the work that happens there, there are different ways of doing that. Rewarded with Bitcoin in the Bitcoin blockchain, for example. There were other types of rewards. And again, I don't want to bore you with the technical details, but it's the shared burden of making sure the network works that incents nodes to participate and make sure that the transactions are being processed. And again, operating without the use of any centralized administrative system. A bit later on in the presentation, I'll talk a bit about why that's a true benefit, because centralized administrative systems from a cybersecurity perspective, from a data management perspective, are costly, are inefficient, are many times ineffective, and it's worth understanding why that there are portions of the centralized administrative work that we've been doing in all of our careers that are worth evolving away. I often like to use graphics, as Cheryl and Gary have probably suffered through this graphic for many years. But when we talk about blockchain, I like to visualize a blockchain as a file or a register of transactions on a computer or computers, in the case of nodes, that contain blocks. And you can visualize the blocks in a blockchain the way you'd visualize pages in a book. Each block in a blockchain references the previous block using a fingerprint for the most part. In technical terms, it's something called a hash. And again, deep technology involved there, happy to have those conversations. But think about how the pages in a book are related to each other. Pages in a book have fingerprints as well, the page numbers that connect each of them. And again, page 10 always comes after page 9, for example. In a blockchain, the same truism applies. Every block in a blockchain knows something about the previous block. And as that chain builds over time, you begin to approach a point where it becomes almost impossible to change the data, particularly at size. The Bitcoin blockchain, the Ethereum blockchain, you've probably heard in popular media that the Bitcoin blockchain was hacked, for example, in the past. That's not technically correct. Someone lost their private key, for example, the password that allows them to have access to their blockchain, to their wallet rather. But the blockchain itself has never been hacked. In all of the years that the Bitcoin blockchain is running, it's been running securely. And I think it's an important perspective to keep in mind. There are real benefits to blockchain technology. So being decentralized, not needing to trust a central authority. And so many of my colleagues, when they see me talking about not trusting a central authority, there's this perspective of, well, you're disintermediating us away. And that's not necessarily what I'm talking about particularly. What we are talking about is the risk of being controlled or having access to a central authority that is not immutable, that is subject to risk, that is subject to cybersecurity risk. The challenges around central authority data management really begin to go away in a decentralized blockchain capability. Being distributed means it's more reliable. Component failure is minimized, particularly when you have a large public blockchain. I remember back in the day when I was working literally on Wall Street and we had lost access to the New York Stock Exchange for an entire day, and someone had inadvertently cut one wire. That is the most extreme example of component failure I've ever seen. And it meant billions of dollars couldn't be transacted. This was in the 1980s. That goes away in a distributed ecosystem like blockchain. This idea of dispersed consensus, the equal distribution of consensus authority, again, not relying on the golden copy coming from one source, the ability to leverage a community of commerce, colleagues or partners or customers, other providers that really verify the data and have the equal authority to do so. Data that's immutable, data can't be modified or is tamper-proof. And again, there are challenges associated with that because you often hear, well, what happens if the data is wrong? And when you write it to a blockchain ecosystem, I think it's important to keep in mind, depending on the blockchain, it wouldn't have been a transaction that was validated if it was wrong. And again, blockchain really starts to push us towards a world where we look at how do we do what we do in banking? How do we do what we do in trading, in law, in accounting? And how does that change because of a decentralized capability? And then finally, transparency, the transaction history more easily audited, more accurate, more consistent over time. One of the biggest strengths of public blockchains, particularly certainly many implementations of private blockchain, is that transparency. You can literally go online today and look at the very first Bitcoin blockchain transaction. And I think it's interesting, regulators have begun to see the benefit of leveraging this. And I'll talk a little bit about this later, tying into, you may remember the Colonial Pipeline hack, and it was a ransomware and a pipeline was shut down unless they paid Bitcoin. All of that Bitcoin was recovered. And that transparency was part of the reason that Bitcoin was able to be recovered. Pardon me, I want to talk a little bit about public versus private blockchains as well. I've been using the word blockchain and I've been meaning public blockchains for a long time. Think Bitcoin again, think Ethereum, the other public blockchains you see. But the truth of the matter is we don't live in a fully decentralized world. Private blockchains are a critical part of the global blockchain ecosystem. These are not fully public, decentralized networks where the system creates access permissions that are controlled. The right to modify or read blockchain is restricted to a few users. Pardon me. Now, for the purists in the blockchain world, this is practically anathema. This is not why public blockchain was designed. But our argument is that private blockchains, which is the focus of not just most of the financial institutions that we know, but every enterprise in some way, shape, or form is looking at private blockchains. Private blockchains maintain the guarantees of authenticity and decentralization that blockchain provides, but it fits it into the world that we know because there are rules, there are regulations, there are fences around which we can't go. There are challenges around things like illicit finance, for example, or regulatory reporting, tax avoidance. So all of these have to be incorporated into how private blockchains engage in this world. And you're beginning to see different implementations. There are several consortium blockchains where the consensus process is controlled by a pre-selected set of nodes. Think a group of banks, for example. There's no, consortia are not new to the world that we've all operated in. Now imagine consortia that are based on blockchain, where each operates nodes, and again, it's considered partially decentralized. We're also beginning to look at what we're calling, and I don't note it here, apologies for that, but this idea of hybrid blockchains, where private blockchains are able to interact with or connect with public blockchains for things like data anonymity, data security, data auditability, but maintain the privacy concerns that many participants have. Pardon. So blockchain use cases, I will not, I promise you, go through all of these particular use cases, but I do want to hit on a couple of them because I think it's really important. And again, post this event, anyone who wants to talk about the specifics here, I have colleagues in virtually every one of these use case silos. I'm happy to talk about that as well. But when you look at things like anti-money laundering tracking and management, I want to talk about the Colonial Pipeline hack. There are companies right now that are offering forensic tools and capabilities to government regulators and law enforcement agencies. They're offering them to banks. They're offering them to stock exchanges. Pardon me. to be able to track transactions. One of the most interesting is a full disclosure, a member of the WSBA Blockchain Intelligence Group. There are others like Elliptic, for example. They offer AML tracking tools, and these particular tools we use to track that Colonial Pipeline ransomware attack and recover all of those funds. And it's interesting, one of the complaints about blockchain and crypto has been, well, it's invisible, it's anonymous. But anonymous is not invisible, actually. Anonymous can be tracked. We're looking now at OFAC lists of prohibited transaction wallet addresses, prohibited accounts, and prohibited participants. So blockchain and crypto assets do fit into the world that we operate in from a regulatory perspective. A little clunky, has some work to do to evolve and grow, but our prediction and our work is really focused on making blockchain and crypto fit into the regulatory frameworks we all need. Cross-border payments are evolving, financial instrument trading, smart contracts. For any lawyers who are in this session, I know several lawyers several years ago who said smart contracts on blockchain, Ron, they're not smart and they're not contracts. And today the conversation is they are pretty smart. And according to jurisdiction, they are contracts. In matter of fact, in the United Kingdom, certain types of smart contracts are valid under UK case law. And that's beginning to permeate throughout the world as well. Things like supply chain management or medical data, real-time IoT systems. Bankers will need to understand over time what happens when the Internet of Things impact how people pay their bills, how people borrow or send money or remit payments is. Things like real estate and land ownership. We're beginning to see the process of everything from real estate paperwork to lending practices associated with real estate being written to immutable chains of data on blockchain. Even things like trade finance or voting mechanisms. The one field I haven't gotten into is voting mechanisms, but my colleagues are telling me that so much work is happening to leverage immutable blockchain technology to manage voting, which is always problematic. It's obviously been a challenge here in the United States, but it'll be interesting to see where that goes over time as well. So I remember when I first gave this presentation, and Gary and Ross and Cheryl will probably remember, I think I had a slide similar to this, and I said, crypto asset markets, they might be here to stay. Crypto asset markets can no longer be ignored. They are here to stay. As of the time I put this presentation together, which was about 8 days ago, the entire market cap globally for crypto assets was $2.3 trillion. I think it's actually slightly higher now. The last time I gave this presentation, it was 1/10 of that, about 200 billion or so. So the market cap is being noticed and it can't be avoided. There are now over 12,000 different crypto assets globally that can be bought and sold and stored and traded and used as collateral in some instances. And again, that number was only 2,100 when I gave this presentation in 2018. So this is a new asset class in many ways. And I don't want to overstate that, but I think it's important for bankers to be aware. There was this conversation about fitting crypto assets into existing frameworks. And again, I certainly don't mean this to be negative to any particular regulator. We work with them all the time. But to the SEC, everything's a security. To the CFTC, everything's a commodity. To the IRS, everything is property, at least from the perspective of crypto assets. But how those frameworks change and grow over time to manage the innovation of blockchain and crypto is really important. What's equally important is how many major corporations are taking on the world of crypto assets in unique ways. Many of them are holding crypto assets in company treasuries. And you've probably seen the news about Tesla or MicroStrategy. And I can tell you there are so many others, including private companies, that are holding crypto in their accounts. A bit of a challenge. I'm not an accountant by training, but if I remember reading some of the stuff from Tesla and certainly my colleagues in the accounting space, you can only recognize the downside if the company, if the crypto on your treasury accounts goes down in value. You can't recognize the upside. Hopefully that changes. We've actually commented to FASB on some of that. But what I would argue is that the backswell of companies engaging in crypto and holding them in treasury is much larger than I think a lot of people realize. And again, companies like Visa, MasterCard, PayPal, all being much more accepting of cryptocurrency, allowing certain cryptos to be part of their payment rails. Again, things like what I mentioned earlier, and I'll dive into a bit more detail, central bank digital currencies, decentralized finance, stablecoins, how we talk about banking and how we talk about financial markets is changing. And I would argue that blockchain is now already beginning to be integrated into quote unquote regular banking processes, things like trust and custody and settlement and clearing. You'll see in some of my commentary later on that blockchain is already part of the work behind the curtain. And I think it's important to remember that. Fidelity regularly does a really interesting institutional investors digital asset survey, just to build on this conversation a little bit. And the question they asked was about the appeal of digital assets to institutional investors. It's interesting. When I began in this field, crypto assets were really, for the most part, a retail conversation. And now, I think this was earlier this year, I want to say April of this year, the percentage of US and European investors at the institutional level who find digital assets appealing is now 78%. If I recall, the first of these surveys I had seen several years ago, it was well below 50%, probably in the 20% range, if I remember correctly. And it's also interesting to see the reasons behind it. Of course, we see the high potential upside. Who doesn't want to turn down double or in some instances, triple digit yield on some of these instruments? And we'll talk about that a bit later. But being uncorrelated to other assets, and more interesting to me, believe it or not, the innovative tech play. Institutions are beginning to look at blockchain technology and realizing innovations like blockchain and crypto assets, and I'll build on that too, AI, for example, are core to the strategies that banks and other financial market participants need to leverage and look at as they lay out those strategies for the next 5 to 10 years. We talked about yield and year-to-date performance, and I wanted to do a little bit of a comparison for those of you who may not have seen some of this data. And when you look at some of the common existing classical markets, S&P 500 up over 18%, and this was a week ago, I think it's a bit higher now, NASDAQ over 16%, the Dow over 15%. In any normal given year, these are fantastic numbers. Who wouldn't want 15% year-to-date return, year-over-year return on the Dow? And I had a conversation, sorry, let me just interject for a moment. I got this data from Into the Block. We have no working relationship with them. For those of you interested, though, they have fantastic resources on both the crypto and classical financial markets as well. And I had a conversation with a colleague that came out of banking, was in the hedge fund world for a while, and now runs a crypto hedge fund. And I had explained to him, I said, you know, the Dow and the S&P, they're doing really, really well. And when I showed him this data, he said, yeah, that's cute, which was kind of weird to hear. And then I tried to put that in context and I realized why. When you look at Bitcoin, for example, it's greater than 98% year-to-date price performance. A, this data is already a little bit old, and B, we still have the rest of the year to go. Ethereum's even more. Ethereum is up over 386% year-to-date when I put this chart together. You can't ignore either bankers, financial market participants, retail and institutional people, and investors can't look away from yields like this. Neither can the government. And again, regulators and legislators are trying to understand, how do we make return on investment and price performance like this available in a safe and compliant way? And I'll talk a little bit about that as well when we talk about the regulatory landscape. But I did want to put these price charts together. And again, I really encourage you all to take a look at that website. Great work that they're doing to help us understand how crypto is changing the financial marketplace. What about blockchain in the banking industry? Our argument is that and you've seen me use this word so many times, the world of banking, the world of financial markets, and quite honestly, far beyond, they are evolving. Innovation, and I think it's a colleague, Barry Melanson at AICPA often says, the pace of innovation will never be as slow as it is today. And I remember hearing that several years ago, and it's borne out every single year. The pace of innovation in blockchain and crypto is accelerating. And you can see that in the conversations we're now having with banking participants. US Bank, the 5th biggest, largest retail bank in the nation, I think by assets, announced that its cryptocurrency custody service is available to fund managers. That would have been an unheard of conversation in 2013. Other players, many, full disclosure, who are members of the WSBA, Bank of New York Mellon, State Street, Northern Trust, we're having this conversation with mid-size and smaller and community banks as well, have all announced plans to, in this instance, custody digital assets. And our argument is that banks of every size need to be prepared to answer the question of, what are you going to do in a blockchain world? Bank of America, we had the privilege of meeting with them several years ago, colleagues there. They have an entire team. They recently launched cryptocurrency research coverage, calling the market simply too large to ignore in a note to clients. And I have to digress for just a moment. I very specifically remember conversations with folks at B of A, and certainly I think everyone's seen Jamie Dimon in the news still saying something like Bitcoin is totally worthless. But it's really interesting to see how the tone and tempo of the conversation has changed. Acknowledging while there is crypto volatility, but crypto showing signs of maturity. It's becoming more commonplace in investment portfolios. It's becoming more commonplace in the conversation around how do retail and institutional folks maintain value and hold on to value in a low interest rate environment. And the comment coming out of the report, and it's worth checking out the press release, is that their view is that there could be more opportunity than the skeptics expect. And speaking for myself, certainly, I believe that to be very true. Financial players of all stripes across all industries are beginning to accept cryptocurrencies as a legitimate asset class and something they need to prepare for. The end is near for money. I think I've seen this type of headline for a long time, and I remember my father many years ago saying something similar. When credit cards came out, for example, in the 50s or 60s. But it's interesting to see how some of the survey data is bearing that out. And while I certainly don't think the end of paper money is nigh upon us, you can imagine that it is coming. 76% in the Deloitte survey, which is really worth the read. I suggest everyone take a look at that if you can. 76% of surveyed banking executives said that digital assets will quote unquote rule in 10 years. No one's defined what rule is to me yet, but I suspect it will certainly be much more a part of their business and everyday life. Likewise, 76% of financial service respondents agree that we'll no longer be using physical money within 10 years' time. We'll be using blockchain-based tokens and various forms of digital currency. And I'll talk about this a bit later on as well. That's bearing out in an international way. I believe it's the next Winter Olympics is being held in China. And for those of you who've been watching the news, the Chinese government has, pardon me, mandated that anyone conducting commerce at the Winter Olympics has to do so using a digital yuan, which is a central bank digital currency, pardon me, created by China. You won't be able to buy soda, for example, without using a crypto wallet based on a Chinese cryptocurrency. And again, 73% of financial services execs noted that they will be at a competitive disadvantage if the industry, and I would argue even in individual professional roles, doesn't begin looking at the adoption of blockchain and digital assets. You just don't want to be the organization, and I say this to my colleagues across different industries, you don't want to be the professional who doesn't have an answer to that customer who walks in and finally says, I'm involved in crypto, what do I do? I'm involved in blockchain or DeFi. What does your organization offer? Our argument is that you need to be able to answer that question. And it's interesting because we also talk about this from the perspective of, we've certainly talked about it from the perspective of enterprise. What are our enterprise members and colleagues in banking and markets and law and accounting doing? We've often tried to do work to have the conversation on the consumer side. And it's interesting, when you look at the data, 17% of United States consumers own Bitcoin or some other form of cryptocurrency. That's 46 million people. And among those who already hold that crypto, 60% said they definitely would use their bank if it offered them the opportunity to invest in cryptocurrencies. That's astounding to us because it so represents the importance of those banking relationships. Banks, like accountants for so many people, are the trusted source. And it's a generational conversation. I think banks need to be prepared for the fact that there are retail and institutional customers waiting for you to be part of this conversation. And it's interesting to see the dichotomy between what's happening at the retail and institutional level, the customer side of it all, and what I would argue is the banker's side or banker's perspective. I don't have the source here. I should have cited, I think it was April of 2021. It might be the Deloitte survey, I'm not sure, but senior bank and credit union execs surveyed, of those, 8 out of 10, 80% of them had no interest in offering cryptocurrency investing services at all to their customers. You can understand some of that. You can understand that from a legal and a regulatory perspective, but that's far more than I would have anticipated, given the number of customers potentially that would want to be engaging their bank and in leveraging crypto assets and blockchain through their bank. And I think it's important that the industry and colleagues like Eide Bailly, colleagues certainly at the Wall Street Blockchain Alliance, begin to compress or at least bring those numbers together over time. Again, this is a strategic conversation about what will we be doing in the future in our industry. It's interesting to talk about focus as well. Consumers and businesses are much more focused on crypto than they were even a year ago. Investments in crypto among Americans have increased, particularly with the advent of relatively compliant crypto exchanges. And I'll tell you what I mean about relatively later on. But it's interesting, 48% of crypto holders in the United States have purchased their crypto within the first half of this year. When you look at some of the crypto exchanges like Coinbase that connect with banks to allow for deposits, for example, they have in some instances more accounts than E-Trade, for example, some of the standard brokerage firms. And again, to this idea of a demographic and generational shift, younger consumers are especially interested in what's happening here. 37% of investors 18 to 44 who have not yet bought a digital currency are very or somewhat interested. And why not? We're looking at capabilities like Robinhood and other gamification capabilities that are giving them access to investment capabilities, savings capabilities, banking capabilities. And I think that's important, again, when we look at that strategic roadmap, to keep that in mind. And it compares to just 19% of those over 60 years old. Younger consumers, future customers for all of us on this call, are much more comfortable with new assets like crypto. And another interesting report, the payments report, again, I shared the link here, it's worth reviewing. 93% of financial institutions surveyed believe that their business clients would use digital currencies, my apologies, for both investments and transactions. That's very telling to us. And the reason that's telling us to us is that it's not just about speculation. It's not just about, I want to buy Bitcoin because I want to be a Bitcoin millionaire. It's about, I will have customers, I will have employees, I will have partners and vendors that will transact in these different types of assets based on blockchain technology. What is our access to that technology? What is our access to blockchain? What is our access to crypto? And I would argue those are the questions we need to work together to answer. The other thing I would suggest is that the availability of banking services is evolving as well. At its core, a lot of these conversations in my mind really are, what do we mean by banking? And how will the banking industry answer that question? Coinbase, again, that exchange that I mentioned, very large exchange, they will be letting US users deposit any percentage of their paychecks directly into their Coinbase accounts. They can deposit it either in US dollars or immediately transfer it into crypto with no fees. The model for what banking is changing, and Coinbase's work and others are working to capitalize on that. Crypto platforms offering high yield savings account with interest rates far outpacing a lot of traditional savings accounts. And again, I don't want to minimize some of the regulatory challenges here. There, as a matter of fact, as of today, the Attorney General in New York issued cease and desist orders to a couple of those platforms. And to be clear, I'm not talking about two platforms, a couple of technologists in a basement somewhere in New York creating a new exchange. These are fully funded, licensed, deep legal teams, deep technology teams, deep regulatory expertise that are engaging in offering these types of savings accounts. They're also beginning to offer secured loans that are collateralized by different types of crypto assets. So again, for the audience, what I would advise and offer up is that it's worth thinking about, what are our business lines? What are the industries our customers are in? And will that industry change in the wake of things like crypto secured loans? The other aspect of this is appealing, especially for unbanked and low credit customers. I think I'll talk a little bit about it later, but I'm happy to mention it here. There are a significant number of unbanked and underbanked in the United States. The last data I had seen, I believe, was from 2019 or so, something on the order of 65 million people are unbanked and underbanked. That's opportunity, particularly leveraging things like crypto assets and blockchain. And as I mentioned a bit earlier, there are certainly regulator and legislative concerns about things like stability, and consumer protections. And we understand that. We work with regulators, we work with our industry participants. No one in the industry, the crypto asset or blockchain world, is looking at this and saying we shouldn't have regulation. I think what the industry needs is logical regulation that defines what is a security, what is a crypto asset, what is a commodity. And as regulators and legislators begin to do that, I think we'll begin to see deeper engagement across the banking industry and other industries as well. What are the benefits? Why should banks be involved in this? And I realize I'm running short on time. Gary and Cheryl are probably going to yell at me after this because there's so much to talk about. But firstly, the prospect of billions of dollars in new deposits. Entire industries are going to be transformed, and they need to have access to banking services. The banks that we're talking to, the bankers on this call, should really begin to understand what's that strategy around making those new deposits available to those customers. The recognition that the future of payments is digital. Tokenization, taking an asset and putting it on the blockchain, the tokenization of US dollar deposits will modernize business-to-business payments. And I was astounded by some of the data I saw here. $23 trillion a year in B2B payments in the United States, 42% of them are still made by check. I have colleagues that have small technology startups, and they use QuickBooks for invoicing, and they'll get paid by QuickBooks. And maybe I'm over-personalizing this a little bit, but a friend of mine is stunned when a QuickBooks payment takes 3 to 4 business days or 2 to 3 business days to clear. And he literally approached me last week and said, well, why don't I just transact and have them pay me in Bitcoin? I would get it instantaneously. Those are questions that bankers need to be at the table to answer. So again, tokenization removes existing limitations on slow, antiquated payment rails. We all know that the technology of our payment rails is decades old, as well as the challenges around workflow, cutoff times, overnight or multi-day processing. Technology is making those challenges evolve away, and banking, like so many other industries, need to be prepared for that. And our argument also is that cryptocurrencies and their related payment rails, think Ripple, for example, R3, who we are partners with, again, we have no economic interest there, but it's worth looking at some of these. They will coexist with ACH, they'll coexist with Fedwire. Traditional rails and digital rails will interoperate, and I promise you that the work at a technology and product level is happening now to make that happen. It's also interesting when we talk about consumer stickiness. Every industry looks to make their customers sticky. It's always more expensive to get new customers. We all know this. Blockchain-based systems are giving business customers the ability to embed things like B2B payment capabilities directly into their service offerings. What if they can do that working with their banker? That, to me, is really the ecosystem that makes customers sticky. And I think, again, the longer range strategy around why that's important is something we should all be discussing. Again, clearance and settlement, the average bank transfer, and CB Insights had a great report. You should see the link there about how blockchain is disrupting. I would use the word evolving. I use that much more than disrupting banking. The average bank transfer, based on their research, took 3 days to settle. Depending on the blockchain technology, serving as that decentralized ledger lets them settle directly, lets them settle almost instantaneously, and it aids in that cross-border transactions in a far shorter period of time. And I think what's lost in the conversation, pardon me, particularly with regulators, particularly with legislators, but also across different industries, is what does that transactions in a shorter period of time mean? To us, that means it opens up the velocity of transactions. It opens up the use of capital. Our argument is that over time, our hypothesis rather, is that we'll see far more assets in a much higher speed way. We'll be able to see capital move much more quickly, much more efficiently. And at the end of the day, the participants in that ecosystem, including banks, will reap the benefit of that, including benefit in greater revenue. Lending, blockchain-enabled lending, both from the perspective of managing the paperwork and the process, a more secure way of offering things like personal loans to a larger group of customers. The loan process, and I don't have specific data, I believe the CB Insights report focuses on some of this, is not cheap, not particularly efficient, but leveraging blockchain, and there are some platform providers doing this. I think BlockFi might be one. There are 2 or 3 others. I'm happy to do some research with all of you. Makes that process cheaper, makes it more efficient, makes it more secure. Paper documentation is going away, and the tokenization of the paperwork associated with loans is enabling faster loan turnaround time. Blockchain technology is also offering the possibility of peer-to-peer loans, which really bothers regulators. But think about the opportunity to make faster, more secure loans peer-to-peer directly with other participants. So the FTC has estimated, concurrent with this, that 1 in 5 Americans also has a potentially material error in their credit score that negatively impacts their ability to get a loan. What if an immutable ledger makes those quote unquote potentially material errors go away? I don't think there's any of us, I've certainly had to deal with something that showed up on a credit report many years ago that had nothing to do with me. What if we could make economic activity more beneficial for them by giving them that secure immutable data for things like loans and credit reporting? And then lastly, the potential, something I mentioned a bit earlier, the potential to borrow money against a blockchain-based asset as collateral. And I don't just mean Bitcoin. We can have conversations about things like non-fungible tokens. Art is being written to a blockchain, and large insurance companies, large funding organizations are writing loans based on blockchain-based assets as collateral. And yes, there are the challenges of how do you value, how do you report, how do you custody that? But I would argue that over time, what we even consider collateral for lending purposes is changing and evolving as well. Know your customer, KYC and fraud prevention, onboarding customers, verifying their identity, ensuring that that information is accurate, very time consuming, very costly. One of the things that we're beginning to see is what if there's a unified ability to KYC AML customers across an entire industry like banking? What are the cost benefits to that? US banks, this is Banking Exchange, another great report, spent between 0.4% and 2.4% of total 2018, I think was the last year, of operating expenses on anti-money laundering and other compliance. That's $500 million a year easily. But when you look at leveraging blockchain technology for things like AML, for things like KYC, BSA reporting, blockchain's estimated to bring those costs down for up to $160 million a year. And those costs demur directly to the bottom line. Again, it's worth looking at some of the solutions there. It's worth talking about how KYC and AML and fraud prevention is done today, and asking the question about whether or not there are blockchain and crypto asset-based solutions for your business and your bank. Rising fraud and cyber attacks. Again, I mentioned the Colonial Pipeline. It's a leading concern, certainly for the banking industry, and quite candidly for so many other industries. And one of the risks I would point out to my banking friends and colleagues, and I do this to other industries, is many of you are working with centralized ledger systems that store customer information because it made sense. It's operated for us for decades. Hackers are becoming much more efficient, much more savvy, much more effective. Their ability to target centralized ledger systems is growing exponentially. And other organizations, I'm happy to point you to some of the resources, will show you that the graph, the trend of cybersecurity attacks is going to be increasing at an exponential rate over the next decade. By decentralizing the storage of information, remember that network of nodes I talked about earlier. By decentralizing that information, blockchain technology could prevent a hacker from getting easy access to that information all at once. So it's worth looking at some of the solutions around blockchains, storing customer information on different blocks. Think about that consortium I mentioned. We're looking at solutions that involve banks and insurance companies and AML KYC providers. It's worth looking at whether or not that fits into your longer term strategic plans. So what about some of the other newer innovations that we've been talking about? What is a central bank digital currency, for example? Well, it's a CBDC, or central bank digital currency. It's issued or proposed to be issued by a sovereign central bank. For the most part, these are still in conceptual or trial stages of development, minus China, who claims to have the Chinese yuan available. Interestingly, the Bank for International Settlements, again, that's another great report that's worth reading, noted that CBDCs, central bank digital currencies, are envisioned by most to be a new form of central bank money that is different from the balances in traditional reserve or settlement accounts. Now, that's pretty vague, depending on who you talk to. And it's certainly meant to be inspired by Bitcoin and similar blockchain-based cryptocurrencies. But I think what's happening is we're beginning to see reserve banks and governments struggling to understand, how do we make digital assets part of the ecosystem of reserve banking that we know. Now, again, for the blockchain and crypto asset purists, CBDCs don't make sense. In the real world, and certainly for regulators and legislators, maybe they do. Are we talking about faster direct payments for things like financial aid or social security payments or other types of relief? Think about the COVID payments that went out to people. Potentially blockchain-based central bank digital currencies might make that more efficient, more cost-effective, more directly impactful to the economy. The other difference to keep in mind when we talk about CBDCs, and again, I'm really starting to talk about some of the stuff that's at the very outer fringe, the cutting edge of some of the conversations that we're having in the blockchain and crypto asset world. A CBDC would be issued by a state, essentially, and have official legal tender status. Many of you might have seen the news about El Salvador stating that Bitcoin would be legal tender in El Salvador. And I remember so many of my colleagues in financial markets were calling me and saying, well, that's ridiculous. Why would they do that? They do forget that El Salvador has used the United States dollar as legal tender for over 20 years. So it's really worth not minimizing what CBDCs could offer as a solution to particularly third world nations, for example. The interesting part from a technology perspective is that they may or may not use distributed ledger technology. So I'm always hard pressed to call them blockchain based, but it really depends on the solution offered. And again, more than 80% of the central banks that we've researched, and again, Bank for International Settlements does a lot of this work as well, are looking in some way at CBDC. So this is not the last you'll hear of them. Decentralized finance, and for those of you who are deeply familiar with this, I suspect we can have really interesting conversations, but DeFi, as it's more popularly known, a blockchain-based form of finance, DeFi is more purely related to the vision of what blockchain and crypto assets is meant to be, not relying on central financial intermediaries. Again, clearly and candidly, brokerages, exchanges, or banks, but offering traditional, quote unquote, traditional financial instruments or capabilities. Leveraging technology through smart contracts to offer those instruments at a retail level, and in the future, don't minimize it, I would suggest, at an institutional level as well. DeFi is offering people particularly the ability to lend and borrow funds from others directly, the ability to trade crypto assets again directly, speculate on price movements. And again, this is very risky stuff. I do not suggest anyone plunge headfirst into the world of DeFi. I've had conversations with my family and it didn't go well. It was, Ron, we're not getting involved in DeFi, but it really is changing how we interact as economic beings, how we spend our money, how we invest our money. The ability to have access to new assets and derivatives, the ability to earn interest on quote unquote savings like accounts. And again, there is a regulatory concern, but so many around the world are interested in participating in DeFi because it offers them economic opportunity they don't have right now in global financial markets. Pardon. So DeFi uses, again, the layered architecture. It's built on top of blockchain, which, to remind all of us from a technology and product level, is built on top of the internet. Everything we're talking about is an iteration of the evolution of the internet. One of my colleagues, I think it calls it Internet 3.0. Some promote high interest rates. I'm always a little leery when I see 12% month over month interest rates, but there are billions in that space now, but it's subject to high risk. They don't have some of the insurance that we have in the classical financial markets, and they are subject to increasing regulatory scrutiny. That said, when I put together this PowerPoint, the current DeFi market size was $90 billion and growing. And it's always interesting to dismiss numbers like that in the context of global financial markets as they exist. But we made that mistake when we talked about Bitcoin in 2018, and now it's a $2.5 trillion market. Stablecoins, which is really one of the premier focal points that we have in global financial markets. And interestingly, I haven't read the report, but apparently the SEC has come out with a report today on their perspectives on stablecoins. Stablecoins are where cryptocurrencies, cryptocurrencies where the price is calculated to be pegged or connected to a cryptocurrency, fiat currency, commodities, potentially baskets of commodities. Stablecoins were really meant to be the bridge between crypto and traditional finance. designed to minimize that volatility of crypto asset usage. And again, that makes sense. Not all of us can participate in a marketplace where the price moves 20% a day. Collateralized stablecoins pegged to another asset. We've seen them pegged to the dollar. We see some of them pegged to a barrel of oil, believe it or not, pegged to a basket of other crypto assets. Oops, pardon me. And it's interesting because stablecoins may benefits may include better anti-money laundering management. Again, think back to the benefits of blockchain that we talked about. If stablecoins allow for better AML capability, better client data protection, better tax compliance, there are conversations happening right now where tax authorities around the world may participate. Again, that network of nodes. Complex conversations about whether or not taxes can be collected at transaction time, for example. And again, there are challenges. I don't want it to sound like there's not some challenges associated with this, particularly around the auditability of an underlying asset. Many of you may have seen the news earlier, late last week, I believe it was, the CFTC fined Tether. Tether was one of the first, or if I recall correctly, potentially the first stablecoin that claimed to be dollar for dollar pegged to or backed by a US dollar. Problem was, part of the audits realized that wasn't necessarily true. And it's cost them $42 million in penalties. So we understand why things like stablecoins might be a concern. That said, there are more and more providers and participants who have reserves one-to-one against the US dollar for things like stablecoins. So there is that increasing government and regulatory scrutiny, worries around crypto asset users and the risks. It's interesting, the systemic risk to the global financial system. I remember conversations with bankers and certainly regulators in the early days of this who said it's never going to be big enough to matter. And now the conversations are, it's a risk to the global financial system. And in an interesting turn from our perspective, the FDIC is said to be studying deposit insurance for stablecoins. So that's actually welcome news to us. The ability to have some level of insurance that matches what we're used to in classical financial markets, we argue would really help stablecoin adoption. I realize I'm running close to time. I'm sorry about this, Amy. There is, from the regulatory landscape perspective, increasing interest across law enforcement agencies, FBI to DEA to IRS, across the board, tax authorities and regulators around the world. But it is interesting, they are staffing up to understand the impact of crypto assets and blockchain. If you're not having those conversations with them and you have that access, it's worth having those conversations. And while they're struggling to understand how crypto fits into their existing frameworks, we're all making progress. Federal and state regulators, members of Congress, you may have seen, Senator Toomey has requested information from the industry. For those of you who have not had the opportunity to do that, it's worth having the conversation with the staffers there. We do it on a regular basis to really educate them about how to make it compliant, make it safe, and certainly make it accessible to banking customers and financial markets customers. That said, our concern is that regulators are still behind. Innovation, again, is accelerating. It's important for us to work with regulators. It's important for us to work together across the industry. It's part of the mission of the Wall Street Blockchain Alliance to really help answer these questions and educate colleagues over time. The concerns about leaving consumers and financial markets vulnerable, they're valid, but I would argue that much more work is being done behind the scenes to validate these capabilities than certainly popular media is showing. Regulators, again, working on stable coins. That's the report I meant to reference a bit earlier. I didn't realize it was coming out today. The SEC, for those interested from the equities perspective, the new administration has certainly taken a decidedly tougher stance on crypto assets. And we've met with Chairman Gensler's office. Many colleagues that we have known Mr. Gensler for years, very smart, but really looking at cryptocurrency trading and lending platforms. He stated, interestingly, that they shouldn't think they can avoid regulation. That's interesting from our perspective, because no one that we've seen in the ecosystem is trying to avoid regulation. Quite bluntly, they're trying to understand the regulation. So what I would argue, for perspective from bankers certainly and others in financial markets, understanding what is banking, what is a security, what is a deposit, what is an asset, that's changing over time. And I think it's really important for all of us to be at the table for those conversations. Other regulators are doing similar. China has banned crypto entirely. And I don't mean this to be insulting, but apparently China woke up and realized that they were communist again. I get in trouble every time I make that comment. They've banned crypto mining, which was a boon to the United States because most of that crypto mining moved to the United States and is creating value and jobs as well. but it's worth understanding the international landscape also. And interestingly, the Securities and Exchange Commission recently approved a crypto stock ETF. The stock ETF that I'm referencing here is related to regular, quote unquote, regular public equities that have some crypto, pardon me, some crypto exposure. So think MicroStrategy, think Tesla, think IBM, for example, packaged into an ETF. Interestingly, I believe tomorrow, a crypto futures ETF will begin trading as well. So again, the conversation went from crypto is bad to it's beginning to seep in a compliant way across our marketplaces. So the industry is working with their banks across all bank sizes and offerings, working with regulators. And really, the US has to consider the challenges of regulatory arbitrage. We have this conversation a lot with our members in London, other parts of Europe, certainly in Asia. We don't want to be left behind. So our argument is that banks should be at the table with all of us, talking with regulators and legislators to move these things forward. But finally, how do you adapt? And I'm happy to take very specific recommendations offline with any or all of you. What does blockchain mean for your business? And I have this conversation across so many different industries. Blockchain is not a buzzword, I promise you, certainly not for the banking industry. Banking and securities and financial markets were some of the first to adopt blockchain capabilities in what we call the back end. But you don't need to be engineers. Again, that's why I left out consensus methodologies and all the complex technology. Most of the vendors you already use are in some way working with blockchain technology. And if they're not, I would offer up by way of friendly advice for whatever it's worth, ask them why not. The technical implementation will be handled by the vendors you already know or new vendors that we will all come to rely on. I would really strongly advise assign a thought leader. And again, it's difficult to assign innovation budgets, and I fully understand that across so many different industries, but you need to understand what this technology is, how it's changing, what it offers, because our argument is that it offers you opportunity within the banking sector. The other side of that we would suggest is canvass your clients. Again, you don't want to be the bank and place the firm here, law practice, accounting firm, technology firm. You don't want to be that company that has a significant customer walk in and say, what are you doing with blockchain and crypto, and not have an answer? And I'm happy to have conversations about ways to engage that. And then finally, we focus internally as well. We've often told our members, use blockchain, use crypto assets, use the conversation as an opportunity to grow your talent. Pardon me. You have to consider the impact of blockchain on your businesses, on your clients, and the generational challenges it will pose as you put out that long-term strategic roadmap. So I think I'm just about out of time. Here's some of my contact information. Pardon me, sorry. Please feel free to reach out. Happy to help and answer any questions. Cheryl and Gary and Ken are all talking to me on a fairly regular basis, but I'm happy to answer any questions we might have, Ken.
Yeah, we have a couple here, Ron. The first one, if just about every major institution in the United States has been hacked, what makes blockchain more secure than, say, Target or the Pentagon, Democratic National Committee, and scads of others? Is it just a matter of time before they get hacked?
Yeah, it's a good question. And I know some colleagues that are computer scientists that bring up quantum computing and other stuff that kind of gives me a headache. But again, I would suggest to Bob, it's a great question. Thank you so much. Think back to that model of network of nodes again. When we talk about network of nodes, if some hacker, Ken, if you're a hacker and you hack one particular node on a blockchain because you want access to Ron and Bob's information, remember that consensus. Remember that if you were to change that information and say, Ken doesn't have 10,000 Bitcoin, he has 10 Bitcoin because the hacker tried to steal it. The entirety of the network, Bob, in that example, would realize that that's not a correct entry. That's not a correct data set, and would reject the transaction, would reject the opportunity to have access to that data and change that information. Now, Ken, I will say one thing to that very quickly. Cybersecurity does not go away in a blockchain or crypto asset world. So in the same way, your password shouldn't be password in today's day and age, your private key, one of the things that we didn't talk about much here, but really is your password to get access to blockchain and crypto assets, you need to secure that. So Bob, to your point, hacking Ron's computer, if I'm dumb enough to leave my private key unsecured there, will have money and funds taken out. So when you look at some of the Bitcoin hacks, again, it's not the blockchain, it's someone left their private key and allowed it to be accessed by a hacker. So a complicated topic. Bob, I think it's a great question. Thank you, but I'm happy to discuss that in more detail.
And then one more question here. Can you walk us through the details of how blockchain would provide higher interest savings account? And is there any FDIC coverage? And then what about monthly statements?
Yeah, so that's a really good question. And I don't know if I have time for the entirety of the answer. Norland, what they're doing right now is something that's called staking. And what they mean by staking is if, Ken, you were to open an account at this potential platform, you would buy Ethereum, you would buy KenCoin, for example. And what these platforms are offering is if you stake that balance, I'm going to deposit 10,000 KenCoin, they're offering a return on investment denominated in KenCoin. So by way of example, you could deposit BTC in a certain platform. You can quote unquote stake it, which is essentially putting it in a type of savings account. And that company, that platform will pay you interest in Bitcoin, sometimes on the order of 8%, 9%, 10%. And you'll see your balance change over time and have a higher Bitcoin balance in that example. And then colleagues are taking that Bitcoin or that Ether and selling it for dollars. Some of them have monthly statements. Again, Coinbase and some of these others offer statements online. And I think the other part of the question, Ken, is are you using cash or Bitcoin? You're using Bitcoin type of assets, Norland, but again, you need cash as the on-ramp to engage and buy Bitcoin and then deposit the Bitcoin on Ken's platform, for example.
And then one last question. Elon Musk came out recently with concerns about anti-green aspects of cryptocurrency. Is that a legitimate concern?
Oh, Elon, every time he puts out a tweet, Ken, I've got about 15 phone calls and emails. So it is a concern. And look, in all due respect, Elon's a brilliant guy, in my opinion. There is that concern. And certainly in the popular media, you hear Bitcoin's terrible because it uses proof of work and it's destroying the planet and it has a large carbon footprint. And that's true because it does use a lot of electricity, but I would put that in context. The last study I had seen, I can dig it up, is that Bitcoin uses on an annual basis 4% of the carbon emissions and electricity, carbon emissions output and electricity that regular Wall Street does on an annual basis. So it's a relative matter, Ken. That said, a lot of the mining I talked about is much of it is moving to renewable energy sources as well. Things like flaring, wind and solar certainly playing into this space. So a lot of work's going to make Bitcoin mining and proof of work mining renewable.
Okay. With that, Amy, I'll turn it to you for getting us started on our break. Okay, back from break, and we got 2 more sessions to go down the home stretch here. Our next session is a regulatory compliance update, S.A.F.E Act and BSA, and Ann Rockswold is a certified regulatory compliance manager and is a principal at Eide Bailey in our Fargo office with more than 30 years of banking experience. Ann works with financial institutions setting up and monitoring all aspects of their regulatory compliance program. Ann is a frequent presenter of compliance-related topics for external bank seminars and internal bank training at Eide Bailey. Ann?
Hey, thanks, Ken. It's nice to be here today. I am just getting set up here and I will get started. Okay. Well, so like Ken said, I am giving an update today on regulatory compliance, and it was perfect placement for me to follow Ron. He's got a lot of things to keep us all thinking, how do we approach compliance in this changing marketplace, and how to be on top of all these changes and be involved with the fintechs and the growing technology and the changes. So, and compliance is going to come right along with that, and the need for compliance and tools. So I'm going to give you guys an update today on just some hot topics, some things that are front and center, some things that we're seeing under the Biden administration, the new head of the CFPB, and where to focus some of our time on and what things to look at. So, so we're going to talk about the S.A.F.E Banking Act. That's a significant piece of legislation that'll change marijuana banking, and we'll talk some updates on that and where we're at with that. status of banking marijuana related businesses, where are we at today and what does it look like? FinCEN priorities on the BSA side. So what is FinCEN looking at, and what are things that we need to make sure that we include in our programs and identify as we look at those risk assessments and make changes. Small business lending data collection, a proposal out there. A lot of times I say we don't spend a lot of time in proposals, but this particular one is worth us spending some time on. It's going to be a significant change to the way we operate, the way commercial lending is going to look at things. And it's important to make sure that we are prepared for that. Fair lending, some food for thought there on fair lending and what to look at. Juneteenth, and some more hot topics. And then common violations to watch for as you're working through your programs. So let's talk about the SAFE Banking Act. The act will implement the ability of the federal banking regulators to intervene in actions on the depository institutions dealing with cannabis-related legitimate business. So we talk, when we review that piece of legislation and where we're at, it passed the House and now it's kind of stalled out and we don't know, we're looking for that to get passed. And what that'll essentially do is create an environment where financial institutions can bank legitimate marijuana related businesses without the risk of repercussion. It does not legalize cannabis at the federal level as a controlled substance, but it would create a different environment for financial institutions to more actively start banking those. Although we've got a lot of financial institutions in that arena already, it's just going to create some safe harbor there. And then we talk about legitimate cannabis related businesses. So regardless of whether the Safe Banking Act passes or not, we all know that banking cannabis is, that's a significant, we need to have controls in place in order to identify risks related to it, identify any potential risk for money laundering. So, it could be following state requirements and but it's that illegal activity. Similarly, if we are banking a cash intense business, there's going to be significant oversight. There will always be that oversight in those cannabis related businesses. Concerns with the Safe Banking Act. The act would not decriminalize marijuana use as a controlled substance under the Controlled Substance Act. Marijuana related businesses, their officers, directors, and employees could still face federal criminal prosecution, even though it's legal at the state level. But banks would be responsible for ensuring that their marijuana related customers are operating in compliance with all the applicable state laws, since state law compliance is a precondition of legal protections. So state laws, and there's a lot of different approaches to those state laws depending on the state that your financial institution is in. Some of them they're all taking different approaches for safe harbor. And then each state is implemented, some states have implemented controls that are in place. There's licensing and reviews, annual reviews, and these are all things that depending on what state you're in, you'll have a different level of access in order to do your due diligence on those marijuana related businesses. And but with the Safe Banking Act, some of that is going to be clarified, but those state requirements will not go away. And then the Controlled Substance Act makes it illegal under the federal law still to manufacture, distribute, or dispense marijuana. And really that's the concern that they have, even though it's being legalized at the state level. So what's the current status of the banking marijuana related businesses? So I just want to talk a little bit about hemp. Prior to the Farm Bill last year, hemp was considered a controlled substance, and that has since been changed. So it kind of opened the door for banking hemp-related business, whether it was manufacturing, production, cultivating, whatever that might be. You know, making sure that you're vetting out that those hemp-related businesses are following any state mandates that they're required to follow as far as your due diligence on the bank secrecy side, but it lifted some of that under that farm bill. So you're no longer required to file regular marijuana related SARs with anything related to hemp. You are required to do your due diligence as if you would for any other business, and then identify any of those potential risks. Just a couple, what's the status of marijuana related businesses and banking? So in 2021, FinCEN publishes a report and looks into the number of banks or institutions that are banking marijuana related businesses. In 2021, there was 510 banks and 174 credit unions. And you'll see that in 2021, they were slightly higher. One of the things, and then from 2019 to 2020, there was a significant jump in the number of banks that were banking marijuana related businesses. One thing I want to point out is that the way the 90-day and the 100-day ongoing SARs, that marijuana related SARs that need to be filed, this article from FinCEN stated that, you know, part of it the decline might be in the fact that where those are reporting and how they're reporting in their numbers as well. So probably a little bit more stagnant where, you know, we've seen a peak here and maybe it'll plateau here. But so these are the financial institutions at this time that have chosen to operate or bank those marijuana related businesses. Although cannabis companies will always present compliance challenges to financial institutions. I'm going to put down this polling question, so make sure you catch that. They'll always present those compliance challenges. So, you know, whether the State Banking Act passes or not, it's good to know that, but there is significant rewards if you're willing to invest in the infrastructure and the requirements in order to manage that related risk related to marijuana related businesses. But controls have to be in place, and it does, the due diligence required is significant, and the infrastructure should be there. You know, looking at the audience today, I was thinking I was going to have predominantly California folks here, and we've got other states here. So I just wanted to note that legalized medical and recreational in California at this time. And in Colorado, same, Minnesota, medical, and also in North Dakota, it's been legalized on the medical arena. South Dakota recently passed both medical and recreational, but that's being challenged. So that's yet to be seen. I know there's some other states out here, but you know, making sure you're looking into any state provisions that your particular state has, and making sure that as you do your due diligence, you're outlining your program and your expectations should you choose to bank those marijuana related businesses. And then hemp and CBD, again, on the Farm Bill of 2018, that did pass, that it's no longer considered a controlled substance. Other proposed legislations. Now, I just listed a list of proposed legislation here just for information. These deal with not just with protecting the banks, but either legalizing on a federal level or requiring the federal government to abide by state law legislation related to the legalization of marijuana related business. So just some legislation here, food for thought, not much activity we're seeing, but at some point, you know, they're still pushing the agenda to get some, that Controlled Substance Act revised, but there's a lot of challenges facing that prior to making those changes. So Couple of things I want to talk about. Many of you might be familiar with what we call the Cole Memo. Cole Memo was set forth in 2013, and it was revoked in January of 2018. Cole Memo basically set out, just a footprint that said that financial institutions banking cannabis, had to follow due diligence and identify their risks and, certain steps that had to be made. And based off of the Cole Memo, we ended up with the FinCEN guidance from 2014 that clarifies the customer due diligence really expectations and the SAR reporting requirements for financial institutions seeking to provide services to those marijuana related businesses. Although the Cole Memo has since been rescinded, FinCEN guidance is still out there. It does reference the Cole Memo, but what we hear from FinCEN is that that has not been removed. So still to consider that, and that's kind of our footprint for the requirements or the expectations of, how we're managing those marijuana related businesses, and then the customer due diligence, the expanded due diligence. A couple of things to note, marijuana related SARs, those ongoing SARs, a crucial part. And when I talk about the infrastructure that has to be in place, it's, largely in order to track, monitor those deposits from those marijuana related businesses and ensure timely filing of the required SARs and the SARs that are ongoing. So there's 3 different varieties of SARs that are related, and acronyms that have to be included in those SAR reporting, and making sure that if, maybe you're currently banking marijuana related businesses, maybe you're an institution that have been approached by some of your customers and you're considering it, making sure that you're building into your program, the amount of SARs and the need for those SARs to be filed on a timely basis. Let's talk about some FinCEN priorities. FinCEN on an annual basis publishes a list of priorities where they're going to focus their energies. And then based on that, guidance is typically issued related to those and how they're going to address significant concerns related to money laundering and the risks associated with that. Corruption was top on the list, and they know that corruption and what controls the financial institution has and how to identify that corruption. Cyber crimes, virtual currency, Ron talked about the changing technology and the changing ways. He talked about blockchain also, is that, identifying those customers and how we're addressing that. But cyber crimes and the risk associated with those cyber crimes and identification. Foreign and domestic terrorist financing, fraud, with the pandemic and all that surrounded the COVID-19, we are seeing fraud on a high basis related to unemployment fraud and PPP fraud, but making sure that you have controls in place to identify those situations and make sure that those SARs are being filed appropriately. What kind of risk does your institution carry based on your product, service, your locations? But fraud is a high priority. Transnational criminal organization activities, OFAC screening, OFAC watches, making sure that those controls are high and you're identifying those risks related there. Drug trafficking organization activity, human trafficking and smuggling. Human trafficking, we're seeing, they published in the last 6 months some guidance on, how to file SARs on those human trafficking and what resources to include in some of those narratives that you're using. But human trafficking and smuggling, they know, is on a rise. Proliferation financing as well. Another area is elder abuse. We continue to see that creeping up. That didn't meet the priorities list on this last year, but last year that was mention. So making sure that, you know, you identify your risks, looking for that, and then, you know, guidance will be forthcoming in some of these areas, knowing that FinCEN's paying close attention to these particular areas, among others. FinCEN priorities, how to incorporate these priorities are due to release by year end 2021. So some guidance that they'll share with the financial institutions. Really important to look at that guidance when it comes out and say, you know, is my risk assessment meeting all the objectives, and based on that, are my internal controls set appropriately, or do we need to make changes on that? And you know, really changing that program and making that evolve with changes in the industry, you know, products, services, delivery, you know, use of third parties, whatever that might be. So effectiveness and paying attention to FinCEN priorities. Let's move on to some of the small business lending. So small business lending is a data collection proposal that's out there. What we're seeing is the purpose is the facilitation and enforcement of fair lending laws to enable the identification of businesses and community development needs and priorities for women-owned, minority-owned, and small businesses. So similar to HMDA, the Home Mortgage Disclosure Act, there's a data set of material or of items that need to be collected and reported on an annual basis. And within this proposal, it's really going to fall on, you know, commercial lending, and commercial lending how we see it today. A lot of, you know, regulation is exempt from loans made to commercial borrowers, and commercial borrowers over the years have, you know, maybe we had looser application processes, or the documentation wasn't as noted, you know, and it followed through a different process. But as we look at, you know, small business lending and this data collection requirement, it's really going to change the expectation for how those commercial lenders are taking applications, the data that they're going to have to collect. And so it's going to be, in my opinion, a game changer for, you know, how we operate those commercial lending areas. And I included the link there to the proposal itself. Couple things about the small business data collection is that collect, report, and make certain public information concerning credit applications made by those women-owned, minority-owned, and small businesses. So a couple things to note. At first, you know, with HMDA, we have you know, financial institution has to have an office in an MSA, and then there's a asset size threshold, and then there's activity threshold. But what we see in this proposal, now remember, this is just a proposal and it can change, but in this proposal, what we're seeing is that they're just talking about the number of loans to small businesses, and it's at least 25 covered credit transactions to small businesses in each of 2 of the prior calendar years. So the 2 prior calendar years, you would have to have at least 2 of these small business loans. So in order, one of the things, if you jump down to the last bullet on my slide there, 5 million or less in gross annual revenue for the preceding fiscal year. So that's how we're looking at whether we're going to classify these businesses as small business or not. So you see 5 million or less is really going to pick up a lot of those borrowers. And so I see that this impacting a lot of financial institutions, and the exemption might be harder to reach. So the data collection points are 24 points to collect, and then filed annually like HMDA. Right now, the proposal is stating that you would have to file your data in June of each year, which was nice to see, because right now we file HMDA data in March to spread that information out. But it would be required to be filed in June. And then covered transactions, we're looking at loans, lines of credit, merchant cash advance, ag purpose loans. So credits and credits that would fall under HMDA reporting as well. So, you know, it's not just, it's commercial ag, any of those types of loans are going to fall under that, and the $5 million or less. So watch for that and stay tuned. The proposal did say the requirements would be applicable 90 days after the rule was final. So, but we're still waiting for the final version. So small business data lending, why are we looking at the collection of that small business data lending? Again, it's another avenue for collection of data to look at pockets of concern related to fair lending. So really, are we making lending available to all areas, all types of individuals, all size of individuals? So there was some concerns in some articles you may have seen over the PPP process that those small businesses weren't given, with the sheer volume, unintentional as it was, is that some of those small business borrowers maybe didn't get the same attention as others. So, really looking out for that type. But fair lending is overall is an unbiased treatment of all customers. Fair lending laws require financial institutions to provide fair and uniform services and credit decisions. So fair lending can happen in any portion of the transaction. It can be at the point where I contact the bank. It could be at the point where I'm going through the application process. Once I'm approved, it could be in the process of collecting payments or communication, or it could be in the fact of types of services that are available to individuals. It could be in the servicing, and now with some of the COVID relief, making sure that the servicing of those loans, are we treating people fairly, equally, and all that information is at an equal playing field. When we talk about fair lending, we talk about the Equal Credit Opportunity Act and the Fair Housing Act are the two regulations that really govern the fair lending laws. And then the data collection is under CRA and HMDA. And once the small business data collection, that would be a third area of data collection that would help. Information would be published and could be, regulators would use this information in their examination processes. Fair lending priorities. Another polling question just popped up for those of you. It's late in the day, I know. So regulators' top priority in 2020 are redlining. I know in Minnesota there was a big case. Financial institution in inner city metropolitan Minneapolis area chose to not branch and kind of went around an area. They had clear justification noting that those areas were extremely overbanked, and their business model didn't include that, but they ended up settling outside of court, and they've agreed to do certain things. So just really make sure that when you're looking at branching, or right now it's not even so much branching, it's closing branches. Like, what does that look like as you're closing branches? Are you pulling out of lower income areas and not other areas? So redlining is still a priority and has been and will continue to be. Another note of mention, the prior 4 years, we haven't seen a lot of fair lending enforcement actions, whether it be FDIC, Fed, OCC, NCUA, escalated cases to the Department of Justice. It's really been down, but under the Biden administration and what we're seeing right now as directives, we anticipate that, or I anticipate that that's going to change. And so pay attention to fair lending and making sure that analysis of, products, procedures, programs, doing internal reviews to identify any potential concerns to be reactive, to react to those appropriately. Steering applicants, creating discrimination in underwriting and pricing. You know, if you're working with any type of third party, you know, with some of these products or fintech access to some of those, you know, making sure that their underwriting matches your internal underwriting. What does that look like? You know, how are we weighting incomes? How are we collecting proof of that and making sure that, but those are areas. HMDA data integrity. If you're a HMDA data collector, make sure that you use the information and the data you're collecting to look for concerns. Mortgage origination, that continues, you know, what's the access to credit and how are we originating those credits, not, you know, and no type of discrimination in that process. Small business lending is going to be that priority. We're going to see some changes in those rules. Student loan origination, if any of you are in the market of originating those student loans, make sure that you're reviewing those programs. If you're doing any type of indirect, you know, maybe it's point of sale lending, maybe you're working with third parties, you know, to generate loan revenue. Just making sure you know what those third parties are doing and include that in your valuation of your fair lending. Pricing, use of rate sheets, and rate sheets kind of an outdated term, or rate models, I should say. You know, what are those models looking like? Do you use individuals who review those models and make those pricing decisions, or is it automated, making sure the automation is following that, and then doing some review of how loans are priced to make sure there's consistency and your process is working. Range of rates, if there's, you know, if you offer a range of rates and there isn't a lot of concrete information based on whether they end up at the high end or the low end, we've seen some concerns with that because certain lenders are always going to give the lower rate or the higher rate, and then potentially we could end up with discrimination depending on the mix of their customer base. How are pricing recommendations communicated to lenders? You know, what kind of training do you have around pricing, fair lending? What kind of underwriting, you know, whether it's those mortgage loans, how is that communicated and how is that followed up on? Lender discretion, we're always going to have lender discretion. Automated systems, we see less lender discretion. Manual systems with an rate criteria and pricing criteria, but we're always going to see that, making sure you're taking credit and you know what % of those loans fall within those lender discretions, and if the % is higher or lower, you know, making sure that you're adjusting those rates accordingly if need be, and if the lender discretion is allowed, making sure you're documenting why particular loans are getting that lender discretion. Documenting reasons for rate exceptions. You know, maybe you're matching a rate, maybe it's a very competitive market, maybe there's a lot of reasons why, but making sure that you're taking credit for that and you're documenting that in your loan process. Waived loan fees, similar to pricing. If you're seeing waived loan fees, you know, what was the reasoning? You better document why those loan fees are being waived, or, you know, maybe your institution just says, we just don't waive loan fees. But if you do allow waived loan fees, make sure you're tracking to make sure. Margins on adjustable rate products, looking at the difference in the margin. We've seen some fair lending concerns where minorities are getting wider ranges of adjustable rate differences as difference. So an area to look at there. What also with fair lending, you know, as we see some of these changing models and these newer products, you know, what is, how do we really do a fair lending review? How do we do our risk assessment? How do we test to make sure that our customers are being treated equally? And so we're seeing a little bit more with some secret shopping. We're seeing more with customer interviews after the fact. on a secret shopping sense, but, really looking at being creative and, how you're going to test your fair lending within your organization to build a level of satisfaction with where your program is and to be able to drive you to make changes appropriately. Customer complaints is always a great area. I always say with customer complaints are an opportunity to be better. So listening to your customers and fair lending on the complaint side is a driving factor, and also UDAP violations. We see a lot of times come out of customer complaints. So what is your customer complaint policies, procedures, who reviews them? And if changes are made based on those customer complaints, how you're documenting that and such. But fair lending is no stranger to that. So make sure you're utilizing those opportunities from the customer communication. Train your frontline staff to be able to identify it, make sure they can report it to the appropriate parties to be addressed as well. Sometimes those customer complaints are just comments that you're hearing, whether working with customers on the front line, or maybe they can also be as formal as filing a complaint with CFPB or one of your federal regulators. So patterns of complaints received, make sure you're tracking that, higher probability that there's a problem if you're seeing more complaints. And then the complaint resolution, does that go to management? Does who gets that report? Does audit committee, does the board of directors get that report of monthly, quarterly complaints, or is it a committee that addresses it and takes it to management? But just make sure that whatever that process is, it's in writing, it's reviewed on a periodic basis, and it's documented. Third-party relationships, there's going into, some of the priorities now are guidance on those third-party relationships, them acting on your financial institution's behalf. So if they're acting on your institution's behalf, what's the risk to your institution? So including a review of that relationship and how that impacts you in your fair lending, and making sure you're aware of it, vetting out any risks or concern prior to entering into those relationships. And then once you have entered into those relationships, it's really important to maintain that ongoing due diligence and oversight to identify any of those concerns ongoing. So let's talk about Juneteenth. So the 11th federal holiday. Great, because we probably get another day off at the bank, but it did offer a few challenges this year. The point that Juneteenth was approved and mortgage lenders having already given disclosures, whether it was rescission or timing on TRID disclosures, or hold time periods on Reg CC hold, it did create some challenges for us. But they did come out after the fact with some guidance, and we're seeing a little bit of leniency on what happened in 2021. But starting 2022, it will be observed on June 19th. So just keep that on your radar. Some more hot topics to talk about. Couple things I want to address. CRA. We know that there's going to be changes with CRA. The OCC came out with some guidance, and in May of 2021, the OCC would reconsider the 2021 ruling, allowing the OCC opportunity to consider additional stakeholders' input. So, and then September of 2021, the OCC issued a proposal to rescind the entire rule, and then revert back to the 1995 rule. One thing we all are, CRA has not evolved with the changing framework of banking, and we know that it can be a challenge trying to meet those CRA directives. So this is a change that we're anxiously waiting. I can say for myself that, we will see CRA changes, but right now that proposal the OCC has been rescinded. And so stay tuned on changes to CRA coming. Mortgage servicing for foreclosures and COVID-19. Special COVID loss mitigation provisions allowed servicers to streamline loan modification to borrowers with COVID related hardships. It came at a perfect timing. We had a lot of customers that were seeing hardship due to, lack of employment or changes, caused by COVID-19. So financial institutions saw an influx of forbearance modifications, changes with those. It allows streamlined loan modification to borrowers with COVID-19 related hardships. So a lot of them, the mortgage servicers were seeing them at huge record volumes. So they were making modifications to those loans. So there was, and guidance in the small entity guide was published and updated. And some of the things to consider with COVID-19, consistency, whether the consumer requested that, now that we're starting to work individuals out of some of that, those modifications and get them back on their payments, CFPB is strongly encouraging financial institutions to work with their borrowers to help them step out of this and get them back in a payment stream, and look at what that looks like going forward. So there was guidance that came out related to that early on, telling us, work with your customers, you can streamline some of this. And now of late, there's some guidance, recently updated FAQs related to, how to walk them out of this, making sure communication is front and center, like allowing the customer to understand, are you gonna just extend the maturity date? Are you going to re-amortize? And giving the borrower some options and making sure it's options that the borrower can tolerate, consistency and all of that is. But there's a lot of guidance out there on that. Fair Debt Collection Practices Act. We have a final rule there and it's effective November 30th, 2021. Generally, it applies to only third parties, but some of the things in that information that we're seeing is that generally it affects third parties, but one of the, there is also some directives in there that indicate that there has to be some oversight by the financial institution if you are outsourcing this to a third party. So what does that look like as you outsource some of that to a third party, making sure that there's due diligence and oversight of those of that activity of that third party. Also, it talks about you're prohibited from false, deceptive, or misleading representation or means. You cannot falsely say communication is from an attorney. I know we've all seen that. Some of these loss mitigation letters coming in, whether it's on the Fair Credit Reporting Act, on information you've reported, but they can no longer use some of those means, can't misrepresent character, amount, or legal status of debt. And then also cannot state that wages will be garnished unless the creditor actually has the legal ability to do so. So unfounded threats cannot be done. And then unfair or unconscionable means, post-dated payments can't be collected, but there's a few things in there. A couple other considerations. We talked that generally it's related to third party, but we have some institutions that are servicing loans through the Federal Home Loan Bank and other agencies. So if you retain the servicing of those loans that you're selling, they're making sure whether if you're doing any of that collection or any of that information, does the Fair Credit or the Fair Debt Collection Practices Act now trigger some requirements on your side. So making sure that you're looking into that. So that's November 30th, but for the most part, unless you're collecting for a third party, a lot of these rules will not apply to you. It'll apply to those third parties. Look, I advanced, okay. HPML escrow exemptions. The rule exempts certain insured depository institutions from requirements to establish escrow accounts for certain high-priced mortgage loans. So in addition to the small creditor exemption, there is an additional exemption for small institutions. Similarly followed, you would be insured, I'm sorry, not small institutions, insured bank exemptions. So if you're an insured financial institution and there's certain criteria, you could potentially be exempt from requiring those escrow accounts for those high-priced mortgage loans that you're originating. So proposal guidance on third-party relationships. A lot of the guidance we're seeing, or some of the guidance we're seeing, really is focusing on the fact that they know that we're going to see more activity with those fintechs and fintech relationships, third-party relationships, the changing footprint of financial institutions and our involvement with others. But third-party guidance on those relationships, proposal seeks to framework in and around the risk management principles to assist banks in managing those third-party relationships. Some of those third-party relationships right now, without this framework in place, doesn't offer you a lot of protections in entering into those relationships. So in order to comply with regulation requirements and then entering in those relationships, this would offer some protections to the financial institutions and give you guidance as far as what controls should be in place. So a proposal for false ads, misrepresentation and misuse of the FDIC name and logo. So we're starting to see a lot more non-traditional financial products and services. This proposal just seeks to make sure and make it clear that non-banks offering bank products may not use the FDIC logo or misrepresent that in any way. So a lot of this is aimed at those non-traditional financial institutions, but also be aware that if you're partnering with them, if you're doing, products, make sure you're evaluating that and where you are placing the FDIC insured logos and using that in any types of advertising that it's appropriately placed. So it could have a residual effect on financial institutions and how they're using the logo with partnerships and such as well. New interagency Q&A regarding flood or the private flood insurance. They're proposing 24 new private flood insurance Q&A for public comment. Those will be added to the already, I think there's like 113 flood Q&As right now, but these are largely related to the private flood insurance, and it helps financial institutions. If it does have the private flood insurance statement on it, was one of the questions I had reviewed, that is that enough that the bank can move on and no additional due diligence related to the insurance itself if it's being presented by your borrower. So those 24 private flood insurance Q&As will be helpful as we manage that. We still see a lot of violations on the flood insurance side. So, and we're starting to see more and more of that private flood insurance offered. It comes in at a reduced pricing, but they haven't had losses. And so making sure that if you are collecting private flood insurance on those loans, that they're being evaluated and the statement's applicable and it meets the criteria. But hopefully these once comment period closed in May, so hopefully those are published soon. Third-party relationship, conduct due diligence, and fintech company. Not different than the proposal, but this was guidance that was issued in 2021, and it talked about conducting due diligence on third-party relationships. Those third-party, a few things they noted in those third-party relationships There were 6 categories that they felt were significant for managing those relationships. Business experience, qualifications, financial condition, and market information on that company you're entering into a relationship with, legal and regulatory compliance. What we see in articles that I've read are that a lot of times these third parties in the fintech arena not being subject to the regularly scheduled examinations that all of you are subject to, their compliance isn't maybe to the isn't as robust as you would expect to see it in a financial institution. So understanding the legal and regulatory compliance and how their programs are set up, and if they meet your expectations. Risk management and controls, what does that look like? Information security, again, Graham Leach Bliley hasn't gone away. And the expectations on, if you share customer information, how are you going to protect that, and making sure your vendor due diligence on that side is covered. Operational resilience. So, what's the ability to operate and manage that manage that relationship as well. So mortgage servicing, back on that, I know I talked about some guidance. There's a small entity guide out there related to mortgage servicing, and then also Fannie Mae, Freddie Mac, they've all got guidance out there on monitoring these. Examiners are going to be paying close attention to what we're doing on the mortgage servicing side. A reminder to take necessary steps to prevent avoidable foreclosure for millions of homeowners currently in forbearance. Really looking at what your program looks like. When I've talked to a couple of institutions that I work with, it's, do we have enough staff on board to, continue with this communication and ensure that we're offering the services and the resources to kind of help them tiptoe out of these forbearances and get them back on track, paying these mortgages to try to avoid some of these unavoidable foreclosures. Steps include being proactive, working with borrowers, addressing language access, evaluating income fairly, handling inquiries promptly, and preventing avoidable foreclosures ultimately is what we're looking for there. So CFPB is monitoring, and examiners will be paying close attention to this. So so make sure that programs are in place to meet those needs. Discrimination on a basis of sexual orientation and gender identity. I apologize, my link to this interpretive ruling, I must have fallen off, it's not there, but it clarified that the prohibition against sex discrimination under the Equal Credit Opportunity Act, or Reg B, includes sexual orientation discrimination and gender identity discrimination. Now, that wasn't clarified prior to this in the Equal Credit Opportunity Act, so it was just an interpretive ruling clarifying that. What are we doing on time? So let's talk about a few common violations. So some Equal Credit Opportunity Act and Reg B, we're seeing a couple of violations here related to the appraisal delivery on the commercial side. So we have, when the appraisal delivery rules changed, that you will give the customer notification that they'll be provided promptly an appraisal notice upon completion or within 3 days. Where we're seeing the exceptions are on those first lien dwellings on the commercial side. Commercial typically has been providing those appraisal notices to the consumers. It's the documentation and making sure that those appraisals are either provided 3 days before closing, or the customer signs a waiver that they will waive the 3 days and then you'll provide it at closing. The rule does state that you will provide that disclosure within reasonable time period, or at least within 3 days. So making sure that if you're getting those disclosures early on, that they're being provided promptly. Fair Credit Reporting Act, Reg V, reporting of disputes on the consumer side, whether they be direct or through eOscar or another model, making sure that they're being reviewed and you're responding to those consumers in a timely basis. So Fair Credit Reporting Act, you know, the use of those credit reports, how you're reporting the validity of the information on that credit reporting data. HMDA, I had to throw HMDA on here. HMDA is just one of those regulations that I anticipate the small business data collection will be similar. You've got all these intricate fields that you're collecting data, and then you have to document the accuracy of the data in those files. And there's a lot of points that have to be met in that. So making sure that your HMDA program, you've got evaluation and review of that. You know, what that looks like. But HMDA can be really expensive, as can flood insurance for non-compliance with the civil money penalties that are attached to it. So HMDA, we still see common violations there, and it's typically on the data integrity side. Flood insurance, we still see flood insurance exceptions, making sure you're documenting and you're collecting that insurance at the applicable levels prior to closing, and then maintaining that flood insurance throughout the life of that loan is crucial. Tickler systems, staff, you know, make sure you're educating your frontline, your closers on those loans, that, you know, insurance, you have to have proof of insurance before closing those loans. And again, flood insurance, expensive. There's CMPs, so the civil money penalties can get quite costly for non-compliance with flood. Truth in Lending Act, RESPA, TRID, the TRID disclosures, there's a lot of information there, and regulators still pay attention to that, looking at technical exceptions, but making sure that under Reg Z and RESPA, those TRID disclosures are accurate. You've got ongoing training and you know, curing those exceptions or violations if you've got reimbursable situations. Reg E, Electronic Funds Transfer Act, we're seeing more and more activity go through electronic means. We're seeing more disputes, making sure that your dispute management, you're reacting to those requests when consumers notify you that there was an inaccuracy in a card transaction that was processed through them, and making sure those investigations are conducted timely and the borrower is getting use of that provisional credit. So Reg E, you know, the volume there is going up. Truth in Savings, more and more UDAP violations we see on the Truth in Savings. Another polling question just popped up for those of you. I'm going to clear it. So Truth in Savings, on the overdraft side, we're seeing making sure that if an item can be presented multiple times, make sure that you're not describing those overdraft charges as per item, per presentment should be included. But Reg DD seems to be an area that making sure how those fees are being applied, testing different holiday scenarios and such. So UDAP, unfair and deceptive or abusive acts and practices. This is the bucket where regulators, and if it just doesn't look right, we just throw it in the unfair and deceptive. We've seen enforcement actions in the last several years under UDAP, and the reputation risk is significant. So, you know, making sure you're having, you know, when you're launching new programs or changing fee structures or applications of those fees, UDAP can really show up anywhere within your institution. It can be in advertising, it can be in product delivery, but whatever that might be, being proactive and looking at those things and identifying concerns there. So UDAP will continue to be an area that we see violations, and you know, the Eide Bailey compliance team, as we see stuff or comments or recommendations for changes, we get those out to our clients as well, making sure we're having those discussions. If we're seeing something on particular core systems and such in the UDAP arena, communication's key on that. So best practices, compliance management system. What does that look like for your organization? You know, what does that look like? You know, monitoring those lines of defense and how they operate and what those controls look like. Continually looking at changing that compliance management system as you evolve and change. And so CMS, robust program, approved, reviewed regularly, updated regularly, constantly looking at, you know, where's the needs? Do we need more staff? Are we testing enough? Are we identifying the concerns? Are we making concerns based on audit results proactively? And whatever that might be. Change management, products and services. What's the next new and wow product? I ask my team and I talk regularly about those kinds of things. Like in the last 5 years, I feel like banking, and in the last 2, especially banking, has rapidly changed. The landscape has changed. So, you know, change management is going to be a key. As a compliance leader, you know, how do we comply with these changes instead of how don't we comply, or how do we stay away from the changes, because the changes are inevitable. So really looking at change management and how we can embrace this changing technology, these changing products, and what that looks like to your institution. What's your institution's level of risk, and really writing your programs and embracing that change management. And then your risk assessment update, part of your CMS system. I know most of you have already done this, but making sure that, you know, what impact did it have? You know, maybe you've changed your risk assessment in the last 2 years, but now that we're in a different landscape for COVID, what does that look like for your institution? Or, you know, what are those changes? So in the beginning of COVID, we saw an exodus of our customers coming into organizations. And even now that we're open and granting access, are we seeing those customers coming back, or are they staying remote and online, and use of those other technologies? So, you know, it's gonna evolve. And one thing I know for certain is, I tell myself regularly is that we just don't know what normal looks like. And I think we're going to be working through what's going to take us to, you know, what is our new normal for several years. So. Okay, Ken, did we have any questions? And I went over, I apologize.
No, we did not have any. So.
Great. I just want to say that my contact information is on there. I would welcome if anybody wants to reach out to me, phone, email. I'd love to have a conversation, or if you had any questions come up, or if you think about them in the next few weeks, consider me a resource. So, and here's to us all heading to happy hour after this presentation next time around. So.
Thank you, Ann.
Yep.
Okay, I guess we'll get started on our last section. So we got Brian's on. Let me make the introductions while Brian and Kent and Kirk gets on line here. So first part of our presenting team will be Kent Fisher. He specializes in public and privately held institutions throughout California and the surrounding states. These financial institutions range from $100 million to approximately $2 billion. He has developed several areas of expertise, including Basel III, acquisition accounting, SEC filers, allowance for loan losses, and TDRs. When you work with Kent, you can expect responsiveness, guidance on the technical matters, and dedication to quality control. Ken is frequent writer and speaker on a variety of topics at venues such as WIB CFO and Directors Conference, CB Resource Webinars, CBA Lenders Conference, and Banking CPA's annual conferences. Another presenter we have is Brian Finley. He's a senior manager in our Minneapolis office. Brian recently joined us in 2020, bringing 14 years of public accounting experience at the Big Four level. He is a senior manager in the Financial Institution Servicing Group. Providing his clients auditing, accounting, and consulting services. Brian has extensive experience in project management and has led audit engagements for financial clients with up to $30 billion in assets. He also is a thought leader in accounting and auditing topics, presenting at various training programs and seminars. And then we have Kirk Bryden with us. He's a bank executive with over 30 years of industry experience. Prior to Banker's Caddy, Kirk was the founder, president, and CEO of Champion Bank in St. Louis, Missouri. He also served as executive vice president of commercial banking for Montgomery Bank in St. Louis. His tenure includes managing commercial bank groups at Allegiant Bank, Commerce Bank, and Cass Bank. He began his career in the corporate training program at Boatman's National Bank. Kirk received his undergraduate and finance degree from Cal Poly San Luis Obispo and an MBA from Washington University's Olin School of Business with Beta Gamma Sigma honors. He is a recipient of the 2008 St. Louis Business Journal 40 Under and 40 Award. He is a sports enthusiast and he especially enjoys golf and travel. He resides in St. Louis, Missouri with his wife Susie and his 4 sons. So at this point in time, I'll turn it over to Brian for CECL, and the warm method is their topic.
All right, perfect. Thank you, Ken. And looking forward to closing this this session down today. I know everyone's favorite topic is CECL. We've been talking about it for years. And so we've got one more time here. And today we're going to keep it pretty high level. I'm mostly going to talk about some of the different methods that banks that we're seeing our clients use, and give kind of the pros and cons for those various methods. And then also talk about preparing for your auditor and your regulator, and making sure that you've got your ducks in a row so that you can answer our questions and the regulators' questions, and be prepared for a successful audit or exam. And then lastly, we're going to hand it over to Kirk, and he's going to take us through an actual example so we can see this CECL thing in action. And he's going to go through the warm method and in the Banker's Caddy software, but to show everyone what CECL looks like, so that, I mean, it's hard to visualize. We've been talking about it for a long time, but I think it's going to be pretty helpful for everyone to actually see it in place. And then hopefully we'll have some time, a little bit of time at the end for some Q&A. And now we'll go into just very high level. The dates you need to keep in mind: 1/1/23 is when it's going to be effective for everyone but the large accelerated filers. Just a other thing that I like to mention is keep in mind the regulatory impact to the phase in there of the impact on your regulatory capital. This is the timeline that we've kind of thrown out there. If I would have presented this a year ago, I probably would have had almost everything in the earlier bucket. So hopefully you've picked your team already of folks that at your organization that are going to work through CECL and figure out how to apply it, and are working on selecting a method or vendor. And hopefully part of today's talk can help with that discussion. And then getting those policies and internal controls and other parts of your organization ready to successfully adopt CECL. These are all things that everyone should be working on kind of ASAP. And then next year, hopefully you'll have your models up and running, and you can go and fine tune it and understand sort of what are the nuances of your particular model, and clean up any data that you need to so that you're successfully able to adopt in the beginning of 2023. This is really high level. The main difference here between the old incurred loss model and the CECL model is the forecast element. So looking forward, and it does change terminology. So you're not just, we won't be referring to ALLL. It'll be the ACL going forward. So new under CECL, you've got, like I said, expected loss versus incurred loss. One thing that I think not everyone, it certainly isn't the first thing that comes to mind, but your held to maturity securities, it will impact them as well. So make sure you're taking that into account when you're planning for adoption. The Q factors, which are a very important part of the old allowance model, are still around and still will impact how you calculate your allowance going forward under CECL. It's just different. Some of them are built into the models. Some of them are going to be outside of the model. It depends on what model you're using, and we'll talk more about those. The other point I want to just mention quickly is purchase credit impaired loans are now changing terminology to purchase credit deteriorated. So PCI becomes PCD, and there's some slight changes as well in what qualifies and how you would account for them. So just know that if you're looking at purchasing loans that are in that purchase credit impaired bucket, or acquiring a different bank or financial institution that might have some of those loans and they'll be in your loan portfolio, that there's additional considerations that you'll need to look into. And then economic trends. This is the big thing that, at least when I first heard about CECL, I thought that it was an exciting development. Okay, now we're going to have to try and model economic things, and how's that going to impact your loans and your reserves? And I think the main takeaway here is there's a lot of things to consider, but you need to make sure that your economic data that you're doing ties in and makes sense with what you're trying to model. So if you're looking at housing prices, that you're probably looking at housing prices in your region. If you're that has a similar footprint, if you're a California bank, you're looking at California housing prices. You're not looking at housing prices across the US, because that probably wouldn't be tied all that closely. So you need to be able to explain why it would have an impact on your allowance, and think about that critically. Don't just be picking whatever economic trend makes sense, or whatever economic trend you can get your hands on. And the other thing to keep in mind is you need to know where the data is coming from and that it's reliable as well. So you don't want to find something on some website. You'll have to be able to explain to your regulators and your auditors how you know that information is correct and is good for you to use. And then forecasting.
Hey, Graham,
yes. Yeah,
before you go on, I wanted to interject there on the forecast, the economic trends and the forecast data.
Sure.
You know, one thing that we learned when we audited the one that we did together, as of 1/1/2021, I was surprised at how little the impact was of this. You know, it's kind of the big new kid on the block when it comes to the calculation, but I was surprised at how minimal the effect was. Partially because you only projected for the period of time where you think you can reasonably forecast it, and then you revert to the historical number after that period. And so the bank, I think, that we looked at, I think it was a 4-quarter or maybe an 8-quarter ramp, and then they reverted to the historical. So I mean, it just was a fairly brief period of time. And even though we were in the middle of a pandemic, the forward look really had very little impact on the allowance. And so I was sort of surprised at that. So I don't know, was that your take as well?
Yeah, exactly that. And that's sort of the takeaway here on the forecasted element, that it is in there in most of the models, but it doesn't have as big an impact as you would think. So that was one of the takeaways that we had from a client that we audited. Disclosure takeaways. The big thing here is just know that the disclosures change. You can't take your incurred loss model allowance disclosures and then expect that you're just going to put new numbers in them. Some of them that might be true, but there are other disclosures that go away. There are disclosures that need new information, and there are new disclosures. So as you're preparing to adopt CECL, make sure you're also thinking through the disclosures, mocking up those disclosures, and making sure that you've got access to the information that you need and controls around that information as well, so that you can get that disclosure right in the first period that you're implementing it.
And Brian, the other thing before we move on to this section is the impact. One of the changes from CECL is for those that have had acquisitions in the past, and for those that have acquisitions, business combinations in the future, there is a pretty dramatic change from the current incurred loss model. For those, and basically that's because CECL does not allow you to take into account the credit component of the purchase discount. And so for acquisitions that occur post-adoption, you'll have the fair market value, including typically a yield and a credit mark. But then that is not to be considered when you go to the next day. You basically have to, through a provision for loan loss, fully provide for the acquired loans. And that's not currently the case now. So it's a bit of a double dip. I'm not sure that it makes theoretical sense, but it is a result of CECL being adopted and the rules that are laid down. And so for those that had a business combination coming into the adoption, there's probably not a reserve being provided for in the allowance for loan loss. And so those institutions we've seen where they modeled it, that there is a bigger impact upon adoption than as compared to those institutions that did not have a business combination and have acquired loans on their books at the day of adoption. So that's a pretty big difference if you've had a business combination or if you're going to have a business combination. So just to acknowledge, that particular big change.
All right, thanks. Next, we'll talk about selecting a model or service. And people I get asked pretty often, which one is the best or what should I do? And there isn't a good answer to that question because it depends on your institution. And there's pros and cons to each of these different models. And we'll talk through that. But I think the main thing here is just thinking through what would be best for your institution based on your size, your complexity with the types of loans you have, and acknowledging what those shortcomings are of each of the models and of the model that you ultimately select, so that you take that into account and you have good documentation to address those shortcomings. So common approaches that we see, scale tool is the Fed's new tool. We'll talk about that. Came out in July. And these are kind of in order of complexity. Weighted average remaining maturity, couple Bankers Caddy and Forma. We're going to have Kirk go through and show an example of that one, so we won't talk about that as much and let him talk about it since that's his area of expertise. Discounted cash flow, that's a pretty common one as well that we're seeing, especially in some of our larger banks. And then the others that you probably heard about that are a little less used, vintage analysis, that sort of thing. And those, we'll talk about the shortcomings there, but you need a lot of your own data, and you've got to be pretty darn big. So most of the Eide Bailey clients wouldn't be able to use one of those other methods very easily. So scale, in summary, this is the formula, but the way I look at it is they really are taking the CECL reserve of these larger banks that are over $1 billion that have to submit this form that we'll talk about next, but they take the larger bank's allowance and that's your starting point. And it looks like we've got a little bit of scale, a little more warm, some discounted cap, a little bit, yeah, pretty much everything across the board. So we'll talk about all of it quick. So you're starting with the starting point of what's the ending reserve, and then you adjust from there, the ending reserve of these other peer banks. And the data comes from this form RAC that banks over $1 billion have to fill out every quarter. And currently there's 150 institutions that are using this, or that have adopted CECL and are filling this out. The Fed expects there to be 700 in the $1 to $10 billion range once it's out there. They don't have anything on their site yet. I checked this morning. They still don't have the information available. So I'm not sure what format these will come in. One thing that I see as a pretty obvious shortcoming is there's only a couple loan categories here, so you don't get all the categories that you would in your call report. And depending on the types of loans you hold, maybe they would align pretty closely with that. But if you're an agricultural lender or something, then those ag loans probably don't line up all that well with whatever bucket they're going to end up on in here. And they may not compare very well to some of the peers, because you'll only have those peers from the $1 to $10 billion range. And the Q factor component here is you need the Q factors for these larger banks. They're already embedded in what they put in here for their allowance. So your job, if you're using scale, is to apply a Q factor that captures why you're different, or how different you would be from those peers, which is a bit of a challenge, but is doable, I suppose. It just depends on your type of institution, and there's several ways you could work to that. The pros, very simple, at least in its calculation. The cons, that it's more complicated once you start thinking through the logistics of how you document and work through everything. And the biggest pro, I guess, that people were most excited for is that free exclamation point there. So that's kind of scale in a nutshell. I don't know, Kent, if you had anything else you wanted to add.
No, other than
scale.
I think maybe it might be appropriate for small banks that maybe are not subject to, maybe an audit requirement, perhaps. I don't know, but maybe just a director's exam.
Yeah.
It feels awfully macro. It's basically a peer macro sort of approach, and I don't know. It's just maybe you get what you pay for on that one. I don't know. Not sure.
Yep. Yeah. And who knows how the regulators will look at it. So I think management will have its work cut out for them to document why they think it's appropriate, and captures what it needs to for their bank. Doable, but probably best for some of the smaller institutions. WARM, weighted average remaining maturity. We'll let Kirk kind of talk through the details in this, but really you're just taking your loans and looking at what your annual charge-off rate is, and then how long is that loan going to be out there, and you figure out what your expected historical loss is, and you apply that to your portfolio, and you can figure out how much you expect to lose on each loan. This one is more sophisticated than scale by a long shot. You're able to use peer data that comes from call reports that's not just in those 4 or 5 categories, but would have all the call report categories. So you'll have many more peers to pick from, and you can pick peers in your area or that to be similar to you. you can get up and running quickly. It's not a very expensive solution. The cons that we see are the prepayment remaining life portion is a little bit challenging to calculate and support. And depending on how large you are and how complex your portfolio is, it could be looked at as being a little bit too simple of a solution. So that's it in a nutshell, but I know Kirk will have more to say and be able to talk through WARM a little bit more.
Well, I think one of the benefits, Brian, is that I think is you're using a unit, the banks are going to be using a unit that they're used to dealing with, which is a annual historical loss rate, as opposed to, applying it to an existing balance, you're applying it to a moving forward, future life balance, but it's still using the same metric that we're always used to calculating, which is an annual loss rate. So that's the beauty of the WARM method, is that, we're very comfortable with that. We've been using it under the incurred loss model for a number of years. And so that you don't have to go to like a vintage loss rate or some other sort of terminology or different, calculation as the basis for your CECL calculation. You can work with a metric that you're used to working with. You're just pushing it forward as opposed to applying it to a point in time.
Yep. The discounted cash flow. Now, this is another one that we've seen pretty regularly used, especially by the larger institutions. It's it depends on which service provider you're using, but it's more complicated. It does capture a lot of it. It captures pretty much everything. So there's a lot of inputs that you need to have that you'll need to be able to support. But because of all those inputs and the ability to tailor everything, you're able to come up with a very theoretically pure calculation. So it's sophisticated. If you've got the support for it, then I think you can come up with a pretty good reserve using this. It's a more expensive option than the WARM method as well, but also does allow you to use that peer loss data again. So that kind of the underlying component. Portions of it, though, are a little more black boxy, where you'll have a harder time explaining the math behind what's happening. The other approaches, these really require more of your own data than you probably have. And if you're keeping all that data, your core service provider is probably going to be charging you extra for it as well. So things to keep in mind there, but since we don't have many people that are going to be using that, we won't talk about it much. The main takeaway here, I think you just make sure that whatever calculation you're using, that you have a good understanding of what is happening behind the scenes. And so you're addressing all the decision points along the way, and you've got those documented so that they can be audited and go through an exam and get your regulators comfortable with what you're doing. Now, this is our approach to auditing, which I think management should be taking a similar approach, honestly. So with your internal controls around, okay, what are the things going into the model, and then how are you comfortable that they're getting input correctly and that it's good data going in, then what's happening in the model, and then what's coming out, and does what's coming out make sense? And if you've got controls kind of at each of those points along the way and understand how it's working, then your CECL model should be reliable and come up with a number that makes sense. This slide, I'm not going to talk about it, but it just is meant to show you some of the things that impact the calculation. And there's quite a few of them depending on the different model, but you really need to start with, okay, what's going into this model that drives a change in the outcome and the output. So work through that and figure out what your key inputs are, and then make sure that you've got controls addressing those.
Brian, we did find out in our little one episode that the prepayment and their curtailment rates are probably one of the biggest drivers of changed numbers. Changes in the prepayment speeds. And it makes sense. You're looking at a life alone, and of course, to the extent prepayments come in stronger than they actually would, will definitely change the numbers. So that's got a lot of variability and volatility associated with it. So just all the factors, that might be one of the bigger ones, right? Prepayments.
Yep. Yeah, exactly. And then just really make sure that you're documenting everything, all your decisions. And to me, the biggest one of the biggest drivers is your peers. Almost all of these models require that you have, you're using different peer banks and their information. So who did you decide to use and why? And document that and rationalize not just who you picked, but maybe who you didn't pick too, if you're filtering some folks out. That would be my advice there. And with that, we'll hand it over to Kirk and he can walk us through an example so we can see some of this CECL in action.
Great. Well, I appreciate you guys giving me the chance to visit with you here. Like Brian and Ken said, would like to give you kind of a practical example of what CECL could look like. And don't shoot me, I'm on your side. I'm a former bank CEO. I didn't come up with the idea of CECL, but several of our clients asked us to help develop a model that would make CECL easier to implement than some of the existing options out there. So we developed this 3 years ago, and I've got a couple hundred plus banks running it now, including some of the people I see in the group today. So there's a lot of people using it and vetting it, and a lot of good ideas coming from it to continue to improve it over time. But really want to do is give you a practical example. So if you decide you're going to build your own model, you certainly can. Hopefully this will give you some ideas for that. And if you decide you're going to use a vendor for it, then this will at least give you some ideas of what you might expect out of that vendor model. So to me, there's 4 key things that you really need to think about in using the WARM approach. This is the home page of what our model looks like. It should look a lot like what you're doing in the incurred loss model, meaning we break up a bank's loan portfolio by the different categories that we use, the call report categories that are found in your call report breakdowns. We show the balances in each of those pools. This is one of the key questions here is how you come up with a reasonable loss rate. And as Brian mentioned, most models are using peer data, and that's because one community bank on their own typically doesn't have enough loss data to have any kind of reasonable, statistically meaningful loss rate. And so what most models will do is use a combination of banks together. And when you combine them all together, you get a much more reasonable starting point for the rest of the model. Because a lot of community banks, when you divide them into multiple pools like this, have no losses or very little losses in certain pools, and 1 or 2 loans could cause their loss rate to go out of proportion really fast in other pools. But if you put them together, you usually get a pretty nice starting point. I'll show you how we do that in a second. And then, as Brian mentioned, one of the hardest things on a WARM model is calculating the remaining life of your pools and your loans. So I'll show you how we do that here. But if you take that annual loss rate from the peer data and multiply it by the remaining life of your pools, you'll end up with a lifetime loss number. So in the old incurred loss model, you're using this annual loss rate. Now you're using a lifetime loss rate. So again, the question is how you determine that lifetime. And I'll show you that in a second. But that's the backward looking portion of this model, what they call the WARM method, which stands for weighted average remaining maturities. The one weakness of the WARM method that is something to consider is it doesn't really fully comply with CECL, in that CECL also requires you to look forward. And the WARM method by itself is a backward-looking model. So we, in our model, will add a component for a forward-looking adjustment using objective economic data to project losses going into the future. And again, Brian and Kent both mentioned that this is a big part of what we need to do on CECL. So this isn't part of the quote WARM method, but it is a component that you need to think about adding to your WARM method if you're going to use the WARM method to fully comply with CECL. And then finally, they still want you to use your own human judgment, these custom factors. So you won't need to do as much work with your custom factors as you do probably in your incurred loss model that you're using today, because you're getting more work done by using pure losses and lifetime losses and this forward-looking adjustment. But you're still going to need to make some adjustment to those calculated numbers to show that you're using your human judgment as well. So we just combine that backward-looking lifetime loss ratio, our forward-looking adjustment, and our custom factors to get to the final loss rate. And that time, the balance for each pool would come up with a reserve for each of the pools. You add them all together and you'll get your homogeneous pool totals. And just like in your incurred loss model, you'll still take out any problem loans or other unusual loans. Some banks take out guaranteed loans as well out of these pools because these pools are for similar risk characteristics, and they'll look at those loans individually. So our model doesn't really get into the calculation because it's not changing under CECL. We just get the totals from our client, and then we add those to the homogeneous pool totals that we calculate for them here. And so you guys will continue to do your own individual looking at those loans and in terms of collateral and cash flow and guarantors and so on, determine what the final reserve should be for those loans, and then combine that with the quote normal loans in the pools to get to the final bottom line number here. So I mentioned there are 4 things that I think are really key. One is the coming up with a reasonable loss rate. The other is coming up with a lifetime calculation. The third big thing that's different here is coming up with a objective way of anticipating losses in the future. And then the fourth thing is, as Brian and Kent mentioned at the end there, is the prepayment rates, because that becomes a big assumption in the model. So there's got to be some way of coming up with a reasonable prepayment rate. And I'll show you how we do that here too. So let's start with the loss rate. You can see each of these pools have their own loss rate associated with them. If you drill down, what we do, as I mentioned, is combine a group of banks together, and then we'll show their combined losses. We use the trailing 12-month losses and their combined balances from the year earlier to come up with a trailing 12-month loss rate each quarter, going back as far as you want. The only thing I've heard the regulators really mention in terms of how far back to go, they want you to go back at least as far as the remaining life of your pools. For most banks, that's not terribly long. It's shorter than you might expect. And the problem with, if you don't go back very far these days, is we had a lot of big losses back in 2000, from 2009 through 2012, 13, 14. But then the losses got really small since then. So if you only go back, say, 5 years on your loss rate, you're going to end up with very little losses to look at. In fact, you're going to end up with recoveries, which they want you to include in your charge-off data, as well as the gross charge-off. They want you to get the gross recovery, so you end up with a net charge-off number. And in some quarters, even when you combine a whole bunch of peer banks together, you get more in recovery than you do in charge-off these days. So if you don't get the earlier charge-off, you're really not getting a full credit cycle, and it's really distorting the more recent quarters, or distorting what the real picture is, because there's a lot of recoveries, and you got to have that original charge-off to really make sense of it. But we'll average all of those time periods together to come up with that average loss rate. We show the bank's loss rate too, but the reason we like the peer number is, in this case, this is a bank, this is their largest pool. It's $130 million. For the peer group, it's over almost $3.5 billion. So obviously $3.5 billion can give a lot more information than 130 million can. So this is where it really gets helpful there. And then you can look at the detail. This is where your work is really going to be done, is going in and finding how do you get that $12.5 million in losses on 1.3 billion in balances, or 91 basis point. You would go into the call reports for each one of those banks, and they break out losses by loan type. And what we do is we combine all the losses and all the balances together as if they're branches of one big hypothetical bank. And you can see some banks with some fairly big losses, a lot of banks with no losses, and some banks with some small recovery during this time period. But you combine them together, you're going to get a more meaningful number than any one bank on its own can provide. So what we do is just go get the call report data, losses by loan type. The call reports are year to date. So in order to get that quarter's call report data, you'd have to subtract out the previous quarter's call report total, and then put 4 of those in a row, 4 of those quarterly numbers in a row, to get the trailing 12-month number that we're using right here. But you can go do that math and calculate that for each one of the banks in your area. Generally, what we use is 65 banks closest to a bank geographically that are between a quarter and 4 times their size. So a lot of parts of the country, you can get within 100 miles, 65 banks that meet that criteria. Not so much out west. There's a little more. Obviously, you're constrained by the ocean on one side, so you got to go out a little bit further geographically sometimes to get that many banks. But you can use whatever reasonable loss or peer group you want to use. The thing that I think is it's nice to get a fairly robust peer group, so not one bank had too much influence. and a night to get banks relatively close to you geographically. So you're getting situations that are going on around you and not a nationwide or region-wide peer group necessarily. So that's how we're coming up with the loss.
I got a question for you. Kurt? Can you
Yep.
hear me? Yep. Yeah, and I think the reason that everybody's going to peer is because they don't want to adopt on day one with a 90% Q factor sort of reserve. They want to have some sort of objective basis to record a day one adoption number, right? So most banks, if they didn't go to a peer group, would probably have to go to a very heavy Q factor based approach, which would be difficult to do, I think. So it seems like the incurred loss model, I think peer group, although it was sort of tacitly allowed by the regulators. I think if you go back to the Bible back, I forget the exact date of that, but back several years ago when they came out with their guidance, they kind of discouraged use of peer group. But I don't think that's the case with CECL. I think peer group is sort of encouraged. Is that your understanding?
I agree. Because the problem is if you end up with a zero loss rate in some of these pools, which again, a lot of banks have, if you break a bank down into a smaller pool, the remaining life portion of the model becomes moot. And so you're doing all your work in the custom factors. So I think they really want to see that remaining life portion of the model be relevant. And if you don't have enough loss data of your own, and I'd argue almost every community bank's in that boat, you got to have some reasonable starting point to calculate that lifetime loss number.
And are you going back? What are you going back to? Are you going back past the Great Recession then, typically?
Most of our banks are. Most of our banks are going back to the last recession so they get a full credit cycle. It's really up to the individual bank. Last time we went through an increase in loss rate, the regulators made everybody shorten their lifetime or how far back they'd look. And then when the credit cycle got better, they made everybody look back further. So right now the conservative way is look back, to the last credit cycle. But if and when the loss rates start going up again, I wouldn't be surprised to see the regulators pushing a shorter lifetime. Okay, so that's how we're getting the loss rates, and that's kind of the foundation of the model. The next step for us, as we calculated, is use those loss rates to calculate a reserve. We do the calculation at the loan level. I'm going to show you a pool level summary first, and then you can see how we do it at the loan level as well. So if you click on a pool name here, this is the combined balances for this bank in this pool today, and this is how much it's paying down each year. So the pay down comes from three sources: from the regular loan payment, an estimated prepayment, and the maturity dates. So all of those are combined, and we calculate all those at the loan level. And I think if you're going to build your own model, you should do the same. And I'll show you how to do that in a second. But when you combine all of those together, this is how much it's paying down each year from those three sources. And for CECL purposes, a balloon loan that you plan to renew is considered, the maturity date is considered the end of the lifetime. Same with the line of credit. So even though you plan to renew those, the lifetime ends at the maturity date. But when you put them all together, in this case, $28.5 million is paying off, and you subtract that from the starting balance, that'd be the next year's starting balance. And you just keep doing that math until your pool is paid in full. And then if you multiply that starting balance by the loss rate we just established each year and add them all up, you'll end up with a lifetime loss number for that pool. And that's as a percentage of their starting balance, 64 basis points. I'll show you the Q factors in a second. You add that or subtract those and do some rounding here in this case. And then that time the starting balance would be the 788 that you're seeing right there. So each one of those pools, you would do the pool level summary to show where you come up with this. And that slide right there comes straight off of a regulatory webinar when they did the Warren method. So this is exactly what they showed as an example for how to calculate that lifetime loss number right there. So the question becomes how you figure out how much it's paying down each year. And the only way I can figure that out is to do it at the loan level. And so if you drill down into the loans here, in our model, you'll see all of the loans in this pool in descending order by the current balance. So if I scroll down, you get to the smallest loan in this pool. Each loan we calculate a reserve for. And if you add all these individual loan reserves together, you get to the pool level totals. To figure out those loan reserve numbers, you can click on this loan number. This is the detail we need to calculate that number. And so you can use the same thing in a spreadsheet for each one of your loans. Basically, you would take the balance today and how much is scheduled to pay off from the regular payment schedule. So in this case, the monthly P&I payment of $78,000. So obviously a portion of that's going to interest, a portion of that's going to principal. So we need to see how much is coming down to principal, and then how much is going to pay down from an estimated prepayment. And again, as Kent pointed out, this is a big assumption in the model. You can see that's almost as big as the scheduled amort in this case. But if you take those two out of the starting balance, that becomes the next year's starting balance. And you just keep running that until either this loan is paid in full or it reaches the maturity date, whichever comes first. In this case, the maturity date hit. So then starting balance times the loss rate each year and add them all up, and you got your lifetime losses for that particular loan. So each one of these loans would go through that same kind of an amort schedule calculation. Obviously, sometimes you're going to have different payment frequencies, maybe level principal payments or interest only, and so on. So, or even construction loans that convert to perm loans or at the end of construction. So there's a lot of different possible payment structures that you need to consider in your amort schedule. But if you could build that kind of an amort schedule for each loan in the bank, that would then give you the idea. You can combine all of these pay down numbers for each one of those loans in the pool, and then you'll be able to get back to that pool level total of how much is paying down each year. So again, if you go to the loan level, the calculations are obvious, and then you just have to add them all up to get to the pool level. But that's how we're getting our reserves, is just multiplying that starting balance by the loss rate each year and adding them all up, and you got the lifetime loss number for that particular loan. And if you add them all together, you get the same for the pool level total. So that weighted average remaining life is just a total for all of these amort scheduled for every loan in the pool. And let me just show you, by the way, how to calculate the remaining life. So if you're wondering how to do this, on the pool level, this pool right here took 9 years to pay off, but the remaining life is not 9 years, because the weighted average remaining life based on the balances. You can see most of the balances are in the early years, and the balances pay down really quickly over time. The easy math way to calculate this is the annual or the lifetime loss number, that's 64 basis points, divided by the annual number, which is 21 basis points. So this one is just over 3 years. And you can see that also on the loan level. Again, let's look at that first loan we were looking at. This pays off in 5 years because of the maturity date. But because of those balances being bigger in the earlier years, it'd be the 69 basis point divided by 21 basis points, or just over 3 years remaining life, weighted average remaining life. So even though the loan pays off over that longer time period, the actual remaining life number, the weighted average remaining life number, is shorter than what you might expect. So that's something to keep in mind. It's not, we have a lot of 5-year loans, so it's a 5-year life. Is where are you in the actual amort schedule of your life, and what are the actual weighted balances each year? So it does become a complicated number to calculate, but it's one that can be calculated with addition and subtraction and multiplication. So it's not using calculus or anything like that to come up with it. It's just a lot of individual formulas. So that's the backward looking portion of the model. Let me just pause, Ken, and see if you guys want me to cover anything else.
Maybe explain a little bit, because I think your model will calculate the prepayment speeds based on, because is this an upload? Aren't you uploading the data? So this is a bit of a turnkey potentially, if you have enough data that you can turnkey this.
Yeah, so what we do for our clients, once they give us a year's worth of loan data, we'll calculate their prepayment rates for them. So we'll actually show them their average prepayment rate by loan type. The prepayment rate, by the way, a lot bigger than we were expecting when we started working on this a few years ago. And I think they're getting bigger recently because of all the PPP money and the lower interest rates and refis and so on. The bank doesn't necessarily need to use this as their prepayment rate just because it's their average historic prepayment rate, because a lot of it has to do with where you are in the interest rate cycle and so on. But they need to justified somehow. And I think the bigger concern is that they're not using too small of a prepayment rate. Too big of a prepayment rate, because the bigger the prepayment rate, the faster the life and the smaller the reserve is going to be. The smaller the prepayment rate, the longer the life and the bigger the reserve is going to be. And so this just gives banks a justification for what their actual history has been. So if they're using something anywhere below these prepayment rates, they're taking a fairly conservative approach to that. But we'll show them for each time period that we have a year's worth of loan data, what their actual balance was the previous year, what they were projected to be a year later, and what they actually were. So you get that prepayment rate each quarter that we have a year's worth of loan data. And then you can actually even drill down even to the loan level, see what the scheduled balance was supposed to be in the actual balance. And this is where I think you got to do to come up with a reasonable prepayment rate. And you can see for most of these loans, the actual balance is pretty close to the projected balance, where it's big differences if 1 or 2 loans pay off. and you add them all up, you end up with a fairly big prepayment number, bigger than you might expect. So most loans don't prepay very fast, but those that pay off early really affect that overall number. And so you're going to apply that prepayment speed to all of the loans in the portfolio, not knowing where it's going to actually happen in the coming year, but assuming that if you spread it across the entire portfolio, you'll end up with a fairly reasonable lifetime implications. So that's a good question, because that is one of the key assumptions that people are going to have to figure out. ALM vendors a lot of times will calculate your prepayment speeds by loan type too. So that's another resource. If your ALM vendor does that for you, it can help come up with a reasonable assumption for what you want to use in your CECL model.
And we got 5 minutes, Kurt. So I may want to get into the, I guess what the future look perhaps as to how you calculate that.
Okay, so yeah, the last big change in CECL is this forward-looking adjustment. You can see in some cases we're expecting lower losses in the near-term future, which is a negative number. In some cases, we're expecting higher losses, which is a positive number. And so I'll show you how we do this. This is not, by the way, the backward-looking portion, the regulators have given lots of examples on how to do that. So this is very clearly shown by the regulators. They have left the forward-looking adjustment completely wide open and up to the bank. So there's no standard out there that anybody's following. This is up to individual banks and vendors to come up with a reasonable approach. So this is what we do. If you drill down on that, this is the same pool level amort schedule we were just looking at, where the starting balance times the historic loss rate gives you a historical reserve. You add them all up and you get your lifetime reserve number. Now we have a new column for projected losses. And the same thing, starting balance times the projected loss rate gives you a projected reserve. Add them all up and you get your lifetime number. And the difference between these two after some rounding would be our number. So we're expecting lower losses in the near-term future. So we're making a downward adjustment from what the historic loss rate would tell us. So the question becomes, why are we expecting lower losses in the near-term future? And I'll show you that in a second, but let me first point out, as Brian pointed out in his presentation, they don't want you to go very far on these projected losses, only to the reasonable future. And so we'll do these projected losses for the first 1 to 3 years, and then after that we revert back to the historic loss rate. And so by that time the balances are getting smaller. And that's why, as you pointed out, the overall impact is typically not huge, because the balances have gotten smaller in the later years, and the first couple of years you have a little bit of impact, but it's not as big as you might expect. So anyway, to get to this projected loss rate, the way we do that is we go out and look at a number of different economic indicators. I'll show you a list. These are some of the indicators we consider. We'll add more, and Brian made the point, you got to make sure the source of your data is good. We use the Federal Reserve Economic Database, so it's called FRED for short. They put out a ton of economic data, and we go pick this up every quarter or every month, depending on how frequently the bank reports, and find all of these data points, and then we run a regression study against historic losses for each different loan type. So for this example, this is the best statistical fit in the past. For this peer group, the non-owner occupied commercial real estate loan, the best indicator of this was the United States employment rate. We look at the state and the national level, but in this case, the national number made more sense. It's the black line right here, the U.S. employment rate every quarter going back to 2007. The orange line is the non-owner occupied commercial real estate losses for this particular peer group for this same time period. The idea is that black line helped project the orange line, and of course it does. If the economic data gets worse, eventually the losses get worse, and then the economic data improve. Not right away, but eventually the loss data improve. So the next question is, how far in advance did the economic data change before the loss data changes? And statistically speaking, in this case, the best shift was 1.5 years. So if you move that black line over to the right by 1.5 years, that's how these two graphs match up. So we plot it all out here, this scatter plot. Each dot here is an individual quarter going back to 2007 with the economic ratio down here and the loss ratio on the y-axis. And then you can draw this regression line, which is the best fit for all these individual data points. So it gives us a starting point, a guess as to what, depending on what the current employment rate is, what the losses might be 1.5 years from now in this peer group for this loan type. Here's some statistical data about this. What we do is find the number that gives us the best correlation. So in this case, 69.3% of the past losses for this particular loan type can be explained by the U.S. employment rate 1.5 years earlier. So a statistician get excited about 50 basis points. A 1 would be a perfect fit, or it would explain 100% of the change. And obviously, you'll never find a 1, but we'll get whichever one gives us the best statistical fit. And then we'll use the most recent data point, in this case, 95%, come over here to 95, go up and over, and it will cross right around 10 basis points. So that's where that projected number comes from. And so then on our projection page, the 10 basis points, a year and a half into the future in this case, so we're actually putting it in between year 1 and year 2. So it's kind of tapering down until it gets to 10 and then tapered back up until it gets back to the historic loss rate. If the lag period was 1 year, then 10 would show up in year 1. If it's 2, it would show up in year 2, and so on, up to a half-year increment. So it just kind of put that projected loss rate out where you think the losses might be, and then taper back until you get back to that historic loss rate. And again, you add them all up and you get the difference. So let me just show you a couple other quick examples, and then might help. So let's say C&I loans. The best, and in this one, we're expected a little bigger losses. And the best indicator here with the United States rolling consumer sentiment number. And so when you push that forward by a year and a half, that's how the two graphs match up. It's got a 75% correlation. You can see we were not landing exactly on the line, but we're getting pretty close to that line generally every quarter. And so most recent number is about 80%. Come over here to 80%, go up and over, it's going to cross at 73 basis points. So we're saying a year and a half from now, the loss rate might be about 73 basis points. So that's what you're seeing in here. And then come back down until you get to the historic loss rate. One more pool, and then I'll let you guys ask some more questions. First mortgage, residential loans. Best indicator for this with the state, in this case, this bank's in Tennessee, rolling employment number. You can see how that data changes a little bit before the loss data changes. If you push it over again a year and a half, it's a pretty darn good match. In fact, a 91% correlation here. Most recent numbers, 95%. 95, go up and over, and it's going to cross right at 10 basis points. So a year and a half from now, we're expecting 10 basis points. So that's kind of in between year 1 and year 2. Taper down, taper back up. Add them all up when you do the starting balance times the projected losses, and you end up with a somewhat reasonable starting point for what future losses might be for that particular pool. So each one of these pools, you're going to have some, and the only thing we know about projections is they'll be wrong, but at least you got an objective starting point in terms of what a reasonable loss rate might be. If we start seeing the economy deteriorate appreciably, then you might start adding to your reserves, and vice versa. If the economy starts getting improved, then you probably should lower your reserve from what the historical numbers will say. And so a lot of this forward-looking adjustment depends on how far back you're going to. If you're only going back 5 years, the numbers now might be expecting bigger losses. If you're going back 12, 13 years like they do, might be expecting smaller losses because you've got some of the worst time periods in that historical period. And again, the bank would then add probably the most common custom factors we're seeing are the 9 that the regulators suggested several years back, experience of lending staff and so on and so forth. So it's a really soft, subjective number. You got to come up with something reasonable. These days, almost all of our clients, because the loss rates are so low, are coming up with having to come up with the upward adjustment to get to a number that they consider reasonable in terms of being able to sleep at night with their reserve. But if and when the loss rates start going up again, you can see because of these lifetime multipliers, the lifetime losses will go up faster in this system in anybody's CECL model than they did in the old incurred loss model. And so you will start seeing banks' reserves go up faster when the loss rates start going up than you did in the old system. And that's where the rubber's going to hit the road, is when we go through another credit cycle. Kent, any questions on that?
Yeah, I just would comment that the forward look element is, if we audited the Brigos, and it's sort of similar. It does the same sort of regression analysis. It's a little more, I don't know, I guess sophisticated and complex, but I mean it's still the same basic methodology. So that's pretty common. So
okay, good. Well, that's good to hear, because they have a whole bunch of PhDs that design their model. So I stopped at the MBA level.
Kurt, maybe before we wrap up, because I know we're just real quick. I mean, because you're in the industry, and what do you know when you see the scale model, or if you see the, I don't know, what's your take on some of the alternatives? It seems to me like the WARM method is a perfect fit for a smaller bank that the SEC doesn't need a real sophisticated model. But I don't know if scale is a little bit too simple. But what's your reaction to scale? Like, it's fairly nuanced.
My fear for the scale model is that you're taking banks that are completely different operational perspective, meaning These are big banks, over $1 billion, and multi-year community banks operate completely differently than big guys. And right now, if you calculate out your scale number, it's not a terrible number, but remember, we're in the best of time for losses right now. Eventually, we'll go through another credit cycle. And do you want community banks to follow the lead of the big guys in terms of how they react to the next economic cycle? And that's where my real fear would be. And as Brian pointed out, if you're an ag-based bank, you're comparing apples to oranges. They say you should use C&I loans as your example for your ag production losses, or commercial real estate for your farm real estate, and they're just completely different animals there. But the biggest thing is just how do you, as Brian pointed out, how do you justify where you are relative to the big guys? And most of the big guys are in other markets than you too, so they're completely different geographic areas. So I think there's some real challenges, not necessarily today, but you're going to get what you pay for in terms of free down the road when you end up seeing those reserve numbers jump up and having to justify some reason to bring that number down.
Is there any other questions or chats that we have here? So I don't think so. Ryan, I guess you can finish it up.
Yeah, no, it looks like no other questions. So thanks, Kirk, very, very much for coming on and walking us through. This was nice to be able to see a model in action and hopefully make a little bit more sense of what CECL is supposed to look like. And so if anyone listening has any further questions, feel free to reach out to myself or Kent or Kirk. With that, I'll hand it over to Gary to wrap us up.
Thanks, Brian. Ken, any comments from you before I wrap it up here? Just to give you a second there.
No, I think we're good. I think that was informative on the CECL, and we got a year to go for that, just a little over a year.
We're all looking forward to it, right?
I know you are.
You won't have to deal with it, right, Ken?
You won't have to deal with it.
That's right.
Timed his retirement perfectly.
Yes. All right. Well, again, thank you, and special thanks to Amy DeGeorge and Cheryl Knutson for all their work on this seminar, especially with Amy on the East Coast time zone and Cheryl in the Central. Thank you guys for all your hard work. And thanks to all of you, the participants, for joining us today. We want to thank our speakers, and we want to thank you for your time and attention. As always, thank you to our clients for your support of Eide Bailly and for your support that you provide in our communities that our employees live in. Remember to check out our November series of there's 4 virtual Eide Bailly Bank seminars at www.eidebailly.com/bank-seminar 2021. We'll see you at our next meeting, which is on November the 2nd, which will be our ag economist, Dr. David Cole. So have a great evening, and Amy, I'll turn it back over to you.
Thank you all so much for attending. Thank you to all of our presenters, and we hope everyone has a great day, and we will see you soon.